Please like, share, and subscribe. Wishing you happiness and good luck every day.
So, today, we're going to dive into a platform that's trying to solve one of the weirdest puzzles in the crypto world. We're talking about DYDX. It's a huge name in decentralized finance, and in this breakdown, we're going to see how it's completely changing the trading game and why that matters so much. All right, let's just start with the big, obvious question. The whole idea behind crypto is decentralization, right? You're in control, there's no single boss, so why on earth are we all trading these decentralized assets on totally centralized platforms? It just doesn't add up. It's a massive contradiction right at the heart of the industry. Yeah, and it's not just us asking this. Author Boris Weiser put it perfectly. It's a puzzle. This one quote just nails the exact problem, the exact frustration that DYDX was designed to fix. So here's how we're going to break this all down. First, we'll really dig into that centralized puzzle. Then, we'll see how DYDX swoops in with a solution. After that, we'll get into the nitty-gritty of its main feature, transparent margin trading, and look at two really important risk strategies. And finally, we'll zoom out and talk about why this whole decentralization thing is such a game changer for the future of finance. Okay, so let's really unpack this puzzle. You've got the whole philosophy of crypto on one side. You hold your own keys, everything is open, anyone can participate. But then, you look at how people actually trade, and it's all happening on these centralized exchanges that they go against all those core values. You know, for the longest time, everyone just kind of assumed that decentralized exchanges, or DEXs, were just way too difficult to use. The reputation was you basically needed a PhD in computer science to figure them out, or they were so basic they didn't even have the features a real trader would need. And that perception created this massive hole in the market. And that is exactly where DYDX comes into the picture. It was built from the ground up to be the answer. It's an open-source, non-custodial platform that gives traders all the powerful tools they're used to, but without ever asking them to hand over control of their money. So what is it really? Well, simply put, DYDX is a DEX built on Ethereum. Now, the most important words on this screen are non-custodial. All that means is that you are always in control of your funds. Your money never sits on a company's server. It's all handled by transparent smart contracts that anyone can look at. And look, this isn't some brand new project that just popped up yesterday. DYDX was founded way back in 2017, and it went live on Ethereum in May of 2019. And since then, the growth has been absolutely explosive. It's become one of the top 10 most used apps in all of DeFi. And you can see that the smart money believed in this from the get-go. The project pulled in over $10 million in seed funding from some of the biggest venture capital funds out there. That's a massive vote of confidence right from the start. And it wasn't just investors. The users followed big time. Right now, there's almost $19 million worth of assets locked into the DYDX protocol. That's real value that people have trusted the system with. But honestly, the number that really tells the whole story is this one. We're talking over $200 million in total volume traded since it launched. That proves this isn't just a cool idea. It's a real, living, breathing market that people are actually using. So, what's fueling all this action? Well, a huge piece of the puzzle is how DYDX handles a really critical tool for serious traders, margin trading. And this, right here, is where it truly leaves the old guard in the dust. Now, for anybody who's not familiar, margin trading is pretty simple. It's just using borrowed money, or leverage, to make your trade bigger. It's awesome because it can amplify your wins, but, and this is the really important part, it also amplifies your losses just as much. And here is the absolute game changer. On a typical centralized exchange, when things go wrong and a position gets liquidated, it's all handled by their own secret black box system. You have no idea what the rules are. With DYDX, it's the complete opposite. Everything is run by open-source smart contracts that are fully auditable. The rules of the game are out in the open for everyone to see, no secrets. Okay, so you're probably looking at this and thinking, whoa, wait a minute, up to 100x on one, but only up to 5x on DYDX. Why would anyone choose the lower number? That's a fair question, and it actually gets to a core difference in philosophy. It all comes down to risk. As the old saying goes, leverage is a double-edged sword. Sure, 100x leverage sounds thrilling, but it also means the tiniest little price move against you can completely wipe out your entire position. It's basically a coin flip. The 5x cap on DYDX isn't about limiting you. It's about enabling smarter, more sustainable trading instead of just pure gambling. But okay, it gets even cooler. DYDX doesn't just give you transparent leverage, it also gives you some really sophisticated ways to manage that risk. Let's look at two key options they offer: isolated margin and cross margin. Think of it like this. With isolated margin, it's like you're putting $100 into a locked box for one single trade. If that trade goes south, the most you can possibly lose is that $100. It's contained. Now, with cross margin, the system can use your entire account balance, all your assets, to prop up a losing trade and keep it from getting liquidated. It's definitely riskier, but it's a powerful tool for managing your whole portfolio at once. So when you step back and look at all these pieces together, the see-through liquidations, the sensible leverage, these advanced risk management tools, you start to realize they all point back to one big idea: the true power of decentralization. Let's put it all together. So here it is, the DYDX advantage in a nutshell. First, you get full control. You hold your keys, period. Second, you get total transparency because all the code is open source. Third, you get permissionless access. No KYC, no asking for permission, no one can stop you from trading. And it manages to pack all of that into a pretty user-friendly package. Oh, and it's versatile too. It also works as a regular spot market for some key pairs. It's really the whole shebang. And all of this brings us to one last really big thought. When you see a platform like DYDX successfully build a decentralized, transparent, user-controlled alternative that actually works, you have to wonder, is this the blueprint for everything? Are we looking at the future not just of crypto trading, but of all finance? That's the huge question a project like DYDX forces us all to think about.
So, have you ever looked at your crypto holdings and thought, could this be doing more for me? Well, today we're going to pull back the curtain on DYDX, one of the biggest names in DeFi, and really get into the nitty-gritty of how its lending and borrowing machine actually works.
Right, so you've got some crypto, but is it actually working for you, or is it just kind of sitting there collecting digital dust? We're going to explore how platforms like DYDX are built from the ground up to solve that exact problem, to let you put your assets to work.
Okay, so let's start with the big picture. The whole idea here is actually really simple. It's all about generating passive income from the digital assets you already have.
The deal is pretty straightforward. You supply your crypto to the platform and other folks can borrow it. In return for that, you earn interest. But here's the really cool part. That interest gets paid out constantly, trickling directly into your wallet. You're not waiting around for some monthly statement to show up.
Okay, but hold on. If you're lending out your hard-earned assets, the first question on your mind is probably, how do I know I'm going to get this back? And that's a great question. This brings us to the supply side and the key things that are in place to protect lenders. Now, this one word you see here is probably the most important concept in all of DeFi lending: over-collateralization. This is the absolute bedrock of the whole system. It just means that for someone to borrow, let's say, $100 worth of crypto, they first have to lock up more than $100 of their own crypto as security. And here's why that's so crucial. That extra collateral is a buffer. It's a safety net. If the market suddenly takes a nosedive and the borrower's collateral starts losing value, there's still more than enough locked up to pay the lenders back in full. It's all designed to protect the people supplying the funds. You know, this decentralized way of doing things is a world away from centralized lenders. With DYDX, there's no company sitting in the middle. The whole thing is run by smart contracts, which is really just code that runs itself on the blockchain. You can usually pull your funds out whenever you feel like it, unlike some places that lock you into term deposits. And all the rules, they're out in the open, not decided behind some corporate closed door.
Okay, so we've got the lenders covered. But for any market to work, you need demand, right? Someone has to actually want to borrow these funds. So who are they, and what are they using the money for? Let's flip the coin and take a look at the demand side of this whole equation. The engine behind all this borrowing and lending is something called a global lending pool. Just picture a giant digital pot of money for each type of crypto. All the lenders pour their assets into that pot, and again, it's not a bank managing it, it's all run automatically by those smart contracts.
So how does this system keep supply and demand in balance? Well, it uses a really important number called the utilization ratio. It sounds complicated, but it's not. It's just the percentage of the money in the pool that's currently being borrowed. So if there's 100 million in the pool and 70 million is loaned out, you've got a 70% utilization. Simple as that.
And this chart makes it super clear. The utilization ratio is like a live snapshot of what's happening in that market. A high number tells you there's a ton of demand. A lot of people want to borrow that particular crypto asset.
Now here's the crucial part. This ratio is what actually determines the interest rates. It's a living, breathing system. When utilization is high, it means money is tight, so the cost of capital or the interest rate goes up. This is great for lenders, you earn more, but it makes it more expensive for the borrowers.
All right, let's talk about the serious side of things now. For a system like this to not just completely collapse, it needs really strict, automated rules. This is where collateral requirements and the threat of liquidation come into play.
So, to even open a loan, you have to be over-collateralized by at least 125%. That's the bare minimum. To borrow $100, you need to post at least $125 in collateral. That's your ticket to entry.
But this is the number that really truly matters. If the market moves against you and the value of your collateral drops to the point where your ratio hits 115%, your position gets liquidated. Automatically, the system sells your collateral to pay back the loan. There are no friendly margin calls from a broker, it's just code doing its job.
And on top of that, there's a penalty. When a position gets liquidated, the borrower has to pay an extra 5% fee. This is a very powerful reason for borrowers to make sure they stay well-funded and keep a safe distance from that 115% cliff.
So why are the rules so tough? This quote really says it all. The whole point of liquidation is to protect the entire system. It's about keeping those lending pools solvent and making absolutely sure that the lenders, the people who provided the capital in the first place, are always made whole.
So when you put all of these pieces together, what you have is this pretty amazing, self-regulating financial machine. Let's just do a quick run-through of how it all flows together.
So first, you have lenders supplying assets hoping to earn a return. Then you have borrowers who lock up more than enough collateral to get their hands on those assets. Third, the real-time demand for borrowing is what sets the interest rate for everybody. And finally, those automatic liquidation rules are always standing guard protecting the whole system.
And what you're left with is a financial market that just runs on code. The rules are totally transparent, everything happens automatically, and there's no central company in the middle controlling the money or changing the rules whenever they feel like it.
Which kind of leaves us with a pretty big question. This model of transparent automated finance, it's really powerful. Now, it definitely comes with its own unique set of risks, for sure, but it really makes you wonder, are we getting a little glimpse of what the future of finance might look like? It's definitely something to think about.
Have you ever wondered if a decentralized exchange, or DEX, could actually feel, easy to use? Like as easy as the centralized exchanges we're all used to? Well, today we're jumping into DYDX to see how it's making margin trading in DeFi surprisingly simple.
So here's our game plan for today. We'll kick things off with a tour of the DYDX hub. Then we'll get you all prepped for your first trade. After that, it's the main event, placing an order and, just as important, keeping an eye on it. And finally, we'll wrap it all up with the key things you need to remember. Let's get into it. All right, first things first, let's get our bearings and take a look at the DYDX interface. And I'll tell you what, if you've spent any time at all on a centralized exchange, you're going to feel right at home here.
So what's the big deal with a DEX versus a CX anyway? Well, it really boils down to one huge thing. Who holds your keys? With a DEX like DYDX, you're in control. They're your keys, your crypto. On a CX, you're trusting them. And look, that's often been the trade-off for an easy-to-use platform. But DYDX is really trying to bridge that gap, giving you an interface that just feels normal. It makes that jump to self-custody a whole lot less scary.
And you can see all the usual suspects are here. You've got your order forms naturally. The order book is right there, showing you all the buy and sell orders in real time, so you can get a feel for the market. And, this is a big one, they've got TradingView charts built right in, which is just a massive win for anyone doing technical analysis. Okay, so you've got the lay of the land. The interface makes sense. Now let's actually get you set up to place a trade. Don't worry, it's a really straightforward process to get everything funded and ready to go. First up, just like any other DApp out there, you've got to connect your wallet. Whether you're using MetaMask, a Ledger, whatever, you just pick it from the list. Once you've done that, you just click to approve the connection, and boom, you're in. Simple as that. Now, here is a really cool feature on DYDX.
The second you deposit your funds, they're automatically put into a lending pool. What does that mean for you? It means you start earning interest on your money right away. Your assets are literally put to work for you from the moment they hit the platform, before you even think about placing a trade.
All right, your wallet's hooked up, your funds are deposited, and they're already making you a little extra on the side. Pretty sweet, right? Well, now it's time for the main event, actually executing your first margin order. Let's walk through it step by step.
So to get an order in, you're just looking at a few simple steps. First, pick your trading pair. Let's just say you want to go long on ETH against USDC. Next, you decide on your position size. Then you set your leverage. You can go up to 5x. And finally, in the advanced options, you'll want to define your max slippage.
So, what is slippage exactly? Think of it as your personal safety net, especially when the market gets a little wild. You're basically telling the system, hey, if the price moves against me by more than this much before my order fills, just cancel it. It's a crucial little setting that protects you from getting a way worse price than you expected. Now here's a super important detail you have to know. The trades on DYDX are not perpetual swaps, the kind you can hold open forever. Instead, these work more like traditional futures. That means they have a set expiration date. When that date hits, your position closes automatically. It's a key difference you absolutely need to factor into your trading strategy.
Okay, your order is in, it's live, and the trade is on. Now comes the really important part, keeping a close watch on your position and managing your risk. Let's talk about the one number that matters more than anything else right now.
When your trade is active, I want you to focus on one thing. There is a single metric that tells you the health of your position, and that is your collateralization ratio. This number is your vital sign. So what's a good number look like? Well, you might see something around 175%. That's a healthy position. The higher this number, the bigger your safety cushion is against any sudden market swings. It's your buffer.
But what happens if that buffer starts to disappear? What if the market moves against you and that number starts to drop, and it falls below that critical point? That, right there, is the core risk of trading on leverage.
And if it drops too low, you face the one word no trader ever wants to hear: liquidation. If your collateralization ratio gets too low, the system just closes your position for you. You're out of the trade, you take the loss, and you get hit with a liquidation fee on top of it. The way to avoid this is to be proactive. You can add more collateral to your position, or maybe close a piece of it to get that ratio back up to a safer level.
All right, we've covered a lot of ground, so let's bring it all home and do a quick mission debrief on the most important things to remember about trading on DYDX.
So here's the rundown. First, DYDX gives you that user-friendly SEX feel, but with the self-custody of a DEX. The best of both worlds. Second, your deposits start earning you interest right out of the gate. Third, you've got up to 5x leverage at your fingertips. Fourth, and this is a big one, remember, these trades have expiry dates. And last, the golden rule, always, always, always watch that collateralization ratio.
So there you have it. You've got the how. You know the mechanics, the buttons to press, the numbers to watch. The real question now is, what's your why? How are you going to take this tool and build it into your own unique trading strategy?
Welcome back to The Explainer. Today, we're going to break down DYDX, a decentralized exchange that is way more than just a place to swap tokens. We're talking advanced trading, earning some passive income, and yeah, we're going to get into the fees that make the whole thing tick.
So, you've got some crypto sitting there in your wallet, and you're thinking, okay, now what? Are we just going to let it collect dust? No way. If you're ready to go beyond just buying and holding, well, you're in exactly the right place. Let's unlock what DYDX can really do.
All right, first things first. Let's talk about the absolute foundation of any exchange, and that's trading. We'll start with spot trading, but trust me, with DYDX, it's not as basic as you might think.
Okay, so on the surface, yeah, spot trading here is pretty simple. You're just swapping one crypto for another. You've seen it a million times on other DEXs. But the real magic with DYDX is the control you get. It's kind of like going from a point-and-shoot camera to a full-on DSLR. You just have way more options at your fingertips. And here's exactly what I mean by more control. We're not just talking about a big swap button here. Nope, you can do a market order if you want in right now. Or you could be more patient and set a limit order to buy or sell only when it hits your price. And super important, you can use stop orders to protect yourself. It's this kind of stuff that lets you actually build a strategy, not just react.
Okay, now listen up, because this is a huge pro tip, especially if you're playing with leverage. Any spot trading you do, any of it, can mess with your collateralization ratio. Think of it as the health bar for your leveraged trades. You have to keep an eye on it, or you could get liquidated when you least expect it. Seriously, don't ignore this. All right, so that's the active side of things, but what if you're not trying to trade every day? Well, DYDX has you covered there too. Let's talk about putting your crypto to work and earning some passive income with lending. And the best part? It is ridiculously easy. You don't have to go through some complicated staking process or lock up your funds for months. The second you deposit your crypto onto the platform, boom, it starts earning interest, just like that. It's totally automatic. So you might be wondering, what's the catch? How does the platform stay safe? Well, DYDX takes a small 5% slice of all the interest it gets paid out. But this isn't just them taking a profit. That money goes directly into an insurance fund. It's basically a rainy day fund to protect the whole protocol if something goes wrong. A layer of security for everybody. And they're super transparent about it, which is great. The rate you see, that annual percentage rate, or APR, in your balances tab, that's the actual rate you get. They've already taken out that 5% fee, so there are no surprises. And the interest? It doesn't come once a week or once a month. It's paid out continuously. It's literally trickling into your account all the time. Okay, so we've covered earning money. Now let's flip the coin and talk about the other side, borrowing. This is how you can get your hands on some liquidity without having to sell your assets. And just like lending, they've made borrowing super straightforward. You just head over to the Borrow tab, pick what you want to borrow, choose how much, put up some collateral, and then just confirm it in your wallet. That's it. 4 simple steps, and you've got liquidity. And you're never in the dark about where you stand. Right there on your dashboard, you can see exactly how much you've borrowed and the interest rate you're paying. Everything is laid out, nice and clear, so there are no nasty surprises.
Okay, with any platform, you have to ask, what's it going to cost me? And the story of fees on DYDX is actually pretty interesting. It's a real evolution from completely free to the model they have now.
You might not believe this, but back in the day, trading on DYDX was totally free. I'm serious, the platform paid for all the gas costs. But then they got popular, and the volume just exploded. At one point, in February 2020, they burned through over 40 grand in gas fees in a single month. Clearly, something had to change, and it had to change fast.
So what did they do? They switched to a classic maker-taker model. It's a smart way to encourage people to keep the market active. Here's how it works. If you're a maker, you're adding liquidity. You're putting an order on the books that isn't filled instantly. For doing that, you pay 0 fees. Zilch. But if you're a taker, you're the one who comes in and fills that order, taking liquidity away. You're the one who pays a small fee. It's a really common system to keep the order books full.
So how does this actually compare to the big guys, like Binance? Well, it's interesting. For smaller trades, less than half an ETH, DYDX is actually a bit more expensive. But, and this is the surprising part, once you get into larger trades, DYDX is actually a tiny bit cheaper. For a DEX, that's pretty impressive.
Now, maker-taker fees aren't the only ones. There are a couple of others to keep in your back pocket. First, if your position gets liquidated, there's a fee for that. And second, if you let a trade just expire instead of closing it, there's a 1% price spread. So just stuff to be aware of.
All right, so we've gone through trading, lending, borrowing, the whole fee story. So what's the big picture here? What's the final takeaway for you?
And really, it all comes down to this. These fees aren't just random charges. They're basically the price of admission for a truly decentralized and secure platform. That money covers the gas to run the network, and it funds the insurance that keeps the whole thing safe. It's what keeps the lights on for a powerful protocol like this. Which leaves us with one last big question at Shuan. Is this fee structure the right price to pay for what you get? For a platform that's truly decentralized and works this well. Finding that perfect balance between cost and decentralization. Well, that's really the big challenge that the entire DeFi space is trying to figure out right now.
All right, today we're jumping right into the fascinating world of automated crypto trading. Where bots can literally make you money while you sleep. We're going to focus on one of the biggest players, DYDX, and the seriously powerful tools it gives traders to get a leg up.
I mean, just think about that for a second. No more staring at charts until your eyes glaze over. No more waking up in a panic wondering if you missed a massive price swing. Just a program, executing your strategy perfectly all day, every day. This isn't some far-off sci-fi concept. It's the reality of crypto trading bots right now.
And that brings us right to the heart of it all, DYDX. This platform is a huge deal in DeFi, or decentralized finance, and it's basically built from the ground up to make this kind of automated trading possible. It's decentralized, so no single company is pulling the strings, and it's non-custodial, which is just a fancy way of saying you always have control over your own funds. It really is a trader's playground.
So, let's pop the hood and take a look inside DYDX to see what makes it such a heavy hitter in this space.
It really comes down to this killer 1-2 punch for serious traders. First, you can build bots for programmatic margin trading. That's where you trade with borrowed funds to amplify your potential profits and pull off more complex strategies. And second, and this is where it gets really unique, you can run something called a liquidation bot.
So what exactly is a liquidation bot hunting for? It's on the prowl for these under-collateralized positions. Let me break that down. It's simple, really. Someone has borrowed money to trade, but the value of their collateral, the stuff they put up to secure the loan, has dropped too low. Suddenly, that loan is at risk of going bad.
And this is the real incentive. When your bot finds one of these shaky positions, it can swoop in, liquidate it, paying back the debt and claiming the collateral. For providing this service to the network, your bot earns a 5% liquidation fee. In the world of automated trading, believe me, that is a massive opportunity.
And what's really wild is how accessible this is. DYDX doesn't just let you do this, they're actively encouraging it. They actually provide the open source code so you can get started building your own. They are literally handing you the keys to the car.
Now, of course, DYDX isn't the only game in town, so let's meet the other DeFi titans it's going toe-to-toe with. First up, you've got Maker, the powerhouse behind the DAI stablecoin. Now, it's primarily a lending protocol. And yeah, you can technically trade on its Oasis hub, but the source material is pretty clear. The feature is basic and kinda left wanting when you compare it to a dedicated trading platform. Next is Synthetics. This one is pretty cool because it lets you trade synthetic assets that track things like stocks or commodities, so you get a lot more variety. But, and this is a huge but, there's no margin trading, and the interface is, well, it's pretty basic.
And finally, we have Compound Finance. This thing is an absolute giant in the lending and borrowing world with enormous pools of capital. But that's its lane. You can't use it as a decentralized exchange, and there is absolutely no margin trading. It's just not playing the same sport.
Okay, so we've met the players. Now it's time for the showdown. Let's put them all side by side and really break down what sets them apart.
This table really tells the whole story, doesn't it? You can see each platform has its own strength. Maker's got the stablecoin, Synthetics has that awesome asset variety, and Compound has those super deep lending pools. But just scan your eyes down to that margin trading row. You see that? There's only one yes on the entire board.
So that's really the bottom line here. For an active trader, someone who wants to use leverage and build these kinds of sophisticated bots, DYDX is pretty much in a class of its own among these DeFi titans. The other protocols are fantastic at what they do, but they're built for different jobs. DYDX is built for the trader.
So, what's the final verdict for a trader who's weighing their options here?
When you boil it all down, it comes down to a few key things. The interface feels really familiar, especially if you're used to a professional, centralized exchange. It strikes this perfect balance of being simple to use without sacrificing powerful features. You get the whole package in one place: lending, borrowing, and that all-important margin trading. And of course, that unique and super lucrative opportunity to run those liquidation bots.
The final advice from the source is pretty direct. It says, hey, give DYDX a try, but it comes with a really crucial warning. Of course, be sure to manage your risk and never trade, lend, or borrow more than you can afford. Because in the world of crypto, things can move in the blink of an eye, and that responsibility is always on you.
And that leaves us with a pretty big question to think about. As these bots get smarter and faster, and as more and more of them are out there trading 24/7 based on pure logic and code, what does that mean for the future of the markets? Who or what is actually in the driver's seat?
Hey everyone, today we are diving deep into crypto trading bots. So, are they some kind of magical money printing machine, or are they just another tool in the toolbox? We're going to cut through all the hype and get to what's real. Let's get right into it.
You know, to really get why trading bots are even a thing, we have to start with a super basic question about crypto itself. Does the market ever just stop? I mean, unlike the stock market with its opening and closing bells, crypto is this relentless 24/7 global beast.
And right there, that's the problem, isn't it? The market just keeps going
and going and going. But we're human. We have to sleep, we have to eat, we have to, live our lives away from a screen. And that creates this huge gap where big opportunities can just, poof, disappear.
So yeah, this brings us to the first massive challenge that every single crypto trader faces. How do you deal with a market that literally never closes?
Oh man, if you've ever traded crypto, you know this feeling deep in your bones. You go to bed, everything's quiet, and you wake up to find you missed that gigantic price swing, a perfect trade that happened while you were asleep. It's got to be one of the most frustrating things out there.
So what's the solution to this? Well, this is where the machines come in. Let's actually break down what these automated tools, these trading bots, really are. At its heart, a crypto trading bot is actually pretty simple. It's just a computer program, a piece of software that you give a list of instructions to. Honestly, think of it like a super fast, super obedient personal assistant who does exactly what you tell them to, the second you tell them to, and they never ever get tired.
So how does this whole thing work in the real world? Okay, step 1, you're the brain. You set the strategy. You decide the rules, like, hey, buy this coin if it drops to X price, or sell that one if this indicator does that thing. Step 2, you connect the bot to your exchange account with something called an API. And step 3, the bot just sits there and watches the market for you. The instant your conditions are met, boom, it executes the trade. No hesitation.
Now that sounds pretty incredible, right? A trading assistant that never sleeps. But this is where we need to pump the brakes and separate the shiny marketing promises from the actual, on-the-ground reality. So let's talk about some cold, hard truths.
I mean, the promise is so tempting. A bot can trade for you while you're sleeping, so you never miss out again. It can take all the emotion out of it, no more fear of missing out, no more panic selling. You can even test your ideas against years of old data to see if they would have worked. I mean, on paper, it sounds like the perfect trader.
But here comes the reality check. And this quote from our source material just absolutely nails it. So many people have this idea that trading bots are just magical money printers. You just switch it on, sit back, and watch the cash roll in. That is absolutely not how it works.
And this slide just lays it all out perfectly. The biggest myth? Set it and forget it. Yeah, you can forget about that. A good bot strategy needs you to constantly monitor it, tweak it, and adjust it as the market changes. And the idea of guaranteed profits? No way. A bot is only as good as the strategy you give it. If you automate a bad strategy, you've just built a machine that loses money for you, but faster.
And the risks don't end there, not by a long shot. Markets move in cycles. The strategy that was killing it in a bull market could get absolutely crushed when things turn bearish. Plus, the internet is just flooded with scam bots, or bots that are so badly made they're basically useless. And here's a big one. For the bot to work, your money has to sit on an exchange, which, as we know, carries its own risk of getting hacked.
Okay, so I know that sounds pretty serious, because it is. But if you do decide you want to go down this road, there are absolutely ways to protect yourself. So let's talk about how to do this safely.
So the key to your security is that API connection we talked about earlier. See, you're not just giving a program your password. The API lets you set very specific permissions, which means you have total control over what that bot is allowed to do, and more importantly, what it's not allowed to do.
And right here, these are the most critical settings. First, and this is totally non-negotiable, you have to disable withdrawal permissions. I'm going to say it again. A bot should never, ever be able to move funds out of your account. Set its permission to trade only. And if you want to add another layer of security, you can even lock the API down so it only listens to commands coming from your own computer. Okay, and here is a giant flashing neon red flag to look for. If you ever see an ad for a bot that guarantees you'll make money, especially if it's for some cheap one-time fee, run. Just like the source material says, run for the hills. Real tools don't make impossible promises.
So, after all of that, where do we land? What's the final verdict here? What's the one thing you really need to remember?
It all comes down to the single crucial point. A bot is a tool for execution. It is not a replacement for being a smart, informed trader. It can't cook up a winning strategy for you. It can't predict the market. It can only execute the plan that you create. The brains of the operation, that still has to be you.
And so that brings us to the end, and a final question that's really just for you to think about. Now that you know the promise, but also the very real risks and the work involved, you can make a smart choice.
Is a trading bot the right tool for your strategy and for your goals? Thanks for tuning in.
All right, let's talk about something every crypto trader has thought about. Could a bot actually do this better than me? Today, we're putting TradeSanta under the microscope. We're going to see if this super popular trading bot is really the secret weapon for automating your crypto strategy. So let's dive in. I mean, let's be real. The crypto market is a 24/7 monster. It never sleeps. But you have to, right? You can't be glued to your screen all day and all night. So the big question is, can a piece of software, a bot that never gets tired and is always watching, actually beat a human at this game? Well, let's see what the numbers behind TradeSanta have to say. Okay, first off, we're not talking about some obscure, little-known tool here. TradeSanta has a massive community of over 45,000 active users. That's a huge number, and it tells you one thing right away. A whole lot of people trust this platform with their hard-earned money. And get this, it's not just a bunch of people who signed up and then forgot about it. Nope, at any given time, there are more than 14,000 bots actively running, actively making trades. This thing is being put to work, around the clock.
But this is the number that really makes you stop and think. Over 1.8 million completed trades. That is an incredible track record. Having a bunch of users is one thing, but successfully executing that many trades, that speaks volumes about how reliable and effective this platform might actually be. So with those pretty impressive numbers as our backdrop, let's get down to it. What exactly is TradeSanta? What's all the fuss about? In a nutshell, it's a cloud-based tool that puts your crypto trading on autopilot, 24/7. Now, a little heads up here. The source material is pretty clear that because it's so powerful, there's a bit of a learning curve. It might take you a little while to get the hang of all the bells and whistles. But the idea is that the payoff is worth it. Okay, so how do you actually make this bot work for you? Let's pop the hood and take a look inside the toolkit. At its core, it really boils down to two main strategies. You've got the long bot, which is your classic buy low, sell high move. You set this one up when you're feeling bullish and you think prices are heading for the moon. And then you've got the short bot, which is the exact opposite. It sells high, planning to buy everything back when the price drops. It's your go-to tool when you think the market's going to take a dip. But here's where it gets really powerful. You're not just flying blind. You can use technical indicators like Bollinger signals to fine-tune your timing. You can set up filters for trade and volume, so you're only making the moves you really want to make. Plus, you get real-time tracking, clear analytics, and even notifications sent right to your phone through Telegram, so you're always in the loop no matter where you are.
Of course, a bot is pretty useless if it can't trade where you trade, right? Well, TradeSanta connects with a whole bunch of the major players. We're talking Binance, Bitfinex, Huobi, OKX, you get the picture. That gives you access to some pretty massive markets.
All right, this all sounds pretty cool, but it's time for the million-dollar question. Or, hopefully, the not-so-million-dollar question. What's it going to cost you? Let's talk money.
And here's some really good news. You can actually try it before you buy it. They give you a 5-day free trial, which is awesome. It lets you get in there, kick the tires, play with all the settings, and really see if it's a good fit for your style before you spend a single dime.
After that trial period, you've got a few options. There's a totally free plan, which lets you run 2 bots with up to $3,000 in monthly trading volume. Perfect for just getting your feet wet. Then there's the basic plan for $14 a month, and this is a huge step up. You get 49 bots, and this is the key, unlimited trading volume. And for the real power users, the maximum plan gives you unlimited bots for $70 a month. Now, if you're wondering which one to pick, our source material points right at that basic plan. It seems to be the sweet spot for most people. For just $14 a month, getting that many bots and unlimited volume? Yeah, that's a pretty compelling deal.
But hey, nothing's perfect, right? So to give you the full picture, let's get real and take a look at both the good and the bad. So on the plus side, you've got tons of automation options, a really clean interface that's great for beginners, and the biggest pro of all, it saves you time. A lot of time. Plus, that active community is a huge bonus. But on the flip side, it doesn't support some big exchanges like Kraken or KuCoin. There's no support for decentralized exchanges either. And if you're an arbitrage trader, this just isn't the tool for you. Finally, it's not open source, which might be a deal breaker for some. So definitely some things to weigh here.
So when you put all of that together, who is this actually for? Is it the right tool for you? Let's try and figure that out. Well, based on everything we've seen, it looks like Trade Santa is a perfect match for a few types of people. First, crypto day traders who are focused on spot trading, not futures. Second, anyone who's ready to get serious about using bots in their strategy. And you know what? Because it's so easy to use, it's also a fantastic starting point for total beginners who are just dipping their toes into the world of crypto bots.
So what's the bottom line? Trade Santa looks like a powerful, user-friendly, and pretty affordable tool that could be an absolute game changer for the right trader. And really, that just leads to a much bigger question for all of us, doesn't it? With tools like this making automations so accessible, is this the real secret to success in crypto? Well, that's a question only you can answer.
All right, let's talk about something that drives a lot of crypto investors absolutely crazy: trying to manage a portfolio that's all over the place. Today, we're diving into a tool called Shrimpy that says it can make all that chaos, well, a whole lot simpler. Let me ask you something. Are you juggling crypto on a bunch of different exchanges, watching prices fly up and down, and feeling like you need to be glued to your screen 24/7? Yeah, keeping your portfolio balanced can honestly feel like a full-time job. It's a huge pain point, and it's exactly what we're tackling today. So what's the answer to all this chaos? Well, meet Shrimpy. It popped up back in 2018, and it's basically a social portfolio manager and trading platform. It was built on this really cool idea: give regular people professional-grade tools, make them affordable, and automate the whole process to make life easier. But here's the thing. Is Shrimpy for every single crypto investor out there? Nope, not even close. It's actually designed for a very specific type of person, and figuring out if that person is you, well, that's the key. Think of it this way. Shrimpy is all about playing the long game. It's built for the hodler, the investor who wants to set a strategy, automate it, and just keep an eye on the big picture. In a market that's driven by so much hype and fear, this kind of hands-off, automated approach is amazing for taking emotion out of your decisions. Now, if you're a super active day trader, someone who lives for charts, signals, and detailed stats, you're probably going to find Shrimpy a little too simple for what you need. And look, that simplicity, it's completely intentional. Other platforms just bombard you with a million different indicators and tools, and it's overwhelming. Shrimpy just cuts right through all that noise. It focuses on the core stuff, the long-term growth strategies, which makes it perfect if you're just starting out or if you're just tired of how complex most trading bots are. Okay, so how does Shrimpy actually deliver on this promise of simplicity? Well, it really comes down to three main things. You can automate your portfolio, you can copy the pros, and you can test out your own brilliant ideas. So let's start with automation, because this is the real set it and forget it magic. You can automatically rebalance your portfolio, which keeps your assets weighted exactly how you want them. You can use dollar cost averaging to invest consistently over time, and you can set up stop losses to protect your investments. It's basically putting your entire strategy on autopilot. And then we have social trading. This feature is a total game changer. Maybe you're not super confident in your own strategy yet, or maybe you just want to see what the experts are doing. Shrimpy lets you literally copy the portfolios and strategies of other successful traders on the platform. I mean, with this feature, you can tap into the brains of people who live and breathe this stuff. It's like having a seasoned pro guiding your portfolio, but, without having to pay them a fortune. But maybe you're thinking, hey, I've got my own master plan for the market. Awesome. Shrimpy's backtesting tool lets you put that plan to the test. You can see how your custom strategy would have performed against real historical data. It's a fantastic way to check your ideas before you risk any real money. All right, this all sounds pretty impressive, but let's talk about the big question. What does it cost? Let's break down the price of all this simplicity, starting with what you can get for free. And you know what? The free plan is actually pretty great. You can link up as many exchange accounts as you want, track your whole portfolio's performance, and see all your balances in one spot. You can even tell the bot to ignore certain assets you don't want it to trade. But, and there's always a but, right? To unlock those powerhouse features we were just talking about, the automation, the copy trading, the backtesting, that's when you'll need to jump up to a paid subscription. So what does that look like? Well, the professional plan is going to run you $19 a month if you pay as you go. But if you decide to go for the annual plan, that price drops all the way down to just $13 a month. Honestly, for the kind of power you get, that's a pretty reasonable deal. Okay, But no tool is perfect. So let's get real for a minute and take a balanced look at the good and the not so good. What are the real benefits, and what are the things that might make you think twice? So on the plus side, you get a ton for free, the paid plans are affordable, and the automation can save you just a massive amount of time. And getting access to what top traders are doing, that's huge. Now, for the drawbacks, it's not open source, so you do have to put your trust in their code. A big one for some people, there's no mobile app. And, like we've said, if you're a day trader, this is definitely not the tool for you. So, let's bring it all home. After all that, what's the final verdict? How do you actually decide if Shrimpy is the right tool for you to add to your crypto strategy? Here's the bottom line. If you are a long-term crypto investor and you want to put your portfolio on autopilot or learn by copying some of the best in the business, Shrimpy is an absolutely top-tier choice. It's simple, it's focused, and it's really, really good at what it's designed to do. And that leaves us with one final big question to think about. In a market that's as crazy and emotional as crypto, could automating your strategy, taking your own gut feelings out of the equation, be the real key to long-term success? It's a powerful idea. Thanks for tuning in.
All right, today we're jumping right into a popular tool in the crypto world, the Gunbot trading bot. We're going to break down what it is, what it does, who it's for, basically everything you need to know. Let's get into it.
So, have you ever wished you could just take the emotion out of crypto trading? Let an algorithm do all the heavy lifting? That's really the whole idea behind trading bots. They can work around the clock, 24/7, executing your strategy without getting tired or, panicking. The big question, though, is, which one do you choose?
And that question brings us right to our main topic today, Gunbot. It's a pretty well-known name if you've been looking into crypto bots, so let's get a crystal clear idea of what we're actually talking about here.
So, at its core, Gunbot, you might also see it called GunT, is a piece of software that automates your trades for you. What's super helpful right off the bat is how compatible it is. It doesn't matter if you're on a Mac, a Windows machine, or even running Linux. You can get this thing up and running on pretty much any computer out there.
Okay, so what can this bot actually do? This is where it gets interesting. Let's kind of pop the hood and take a look at the key features Gunbot gives its users. So first thing you notice is that it comes loaded with a ton of pre-built trading strategies, which is awesome for just getting started. But, and this is a huge plus, it doesn't lock you in. You can completely customize them or even build your own from scratch. It's also got a mobile-friendly interface, it connects to all the big exchanges you'd expect, and there's a whole world of add-ons you can get to expand its capabilities.
And just to give you a feel for those built-in strategies, what are we talking about? Well, the source mentions a few by name, like Step Game, Gain, and Ping Pong. You can basically think of these as plug-and-play game plans. They let a new user get started trading immediately, without having to know a single line of code.
Now, of course, a bot is useless if it can't connect to where you actually trade. Gunbot's got you covered here. It integrates with a whole bunch of top-tier exchanges, and the source specifically calls out Coinbase Pro. And even more importantly, for the more advanced traders out there, it supports margin trading on platforms like Kraken, OKEX, and BitMEX. That opens up a whole different level of trading possibilities.
All right, let's talk about the price. How much is all of this going to set you back? Because this is where Gunbot really separates itself from the rest of the pack.
And here it is. This is the absolute game changer for Gunbot. There are no monthly subscription fees. Zero. Unlike so many other bots that hit you with a recurring charge, with Gunbot, you pay a one-time license fee. You buy it once, it's yours forever. This is probably the biggest factor you need to consider.
So how does that one-time fee actually work? Well, it breaks down into a few tiers. You can get in the door with the starter pack for 0.02 Bitcoin. That gets you running on one exchange, but you only get the free strategies. If you want to unlock all the strategies, you'd have to jump up to the standard package, which is 0.05 Bitcoin. Still just for one exchange though. Then you've got the Pro package. For 0.075 Bitcoin, you get to trade on 3 different exchanges. And this is huge. You get access to backtesting, which lets you test out your strategies on old market data to see how they would have performed.
Okay, so we've got the features, we've got the pricing. Let's put it all on the scale. What are the clear upsides and downsides to going with Gunbot?
So, on the Pro side, you've got that massive library of strategies, both built-in and custom. It's also known for being pretty easy to use, which is great for beginners. And of course, connecting to all those popular exchanges is a major win. The main con, well, it's that price tag, that one-time fee. Even though it might save you a ton of money in the long run, that initial investment can feel pretty steep compared to just paying a small subscription every month.
Which of course leads us to the final and most important question of all. Taking all of this into account, who is Gunbot actually for? Is it the right tool for you?
The source material actually gives a super clear answer here. It says Gunbot is for, quote, basically anyone who wants a beginner-friendly crypto trading bot that intends to be trading crypto seriously for a long time. And that last part, for a long time, that's the key. That one-time fee really only makes sense if you're in this for the long haul.
And that's really what it all boils down to. The choice to go with Gunbot isn't just about its features. It's about your own commitment. Is paying that big cost up front worth it for a tool you could be using for years and years to come? That's the question you really have to answer for yourself.
Trying to keep up with the crypto market, it's like a full-time job, right? The volatility, the fact that it never sleeps, honestly, it can be totally exhausting. But what if? What if you could put some of that trading on autopilot? And I mean with some seriously powerful, professional-grade tools.
Have you ever just wished you could use those expert-level trading tools, but without having to learn how to code? Really, who has the time to become a programming genius just to automate a few strategies? It's a huge hurdle, and it's what stops a lot of people from really leveling up their trading game.
Well, today we're going to explore a potential solution for exactly that. It's a trading bot called CryptoHopper. Our source material digs into it, and it claims to be the answer to that very problem. So let's dive in and see what it's all about.
All right, so first things first, the toolkit. What's actually under the hood here? They throw around this term pro level, but what does that even mean for a trading bot? Let's break down what features CryptoHopper is actually bringing to the table.
So our whole analysis today is coming straight from this source text, which really does a deep dive into the bot's capabilities. And you can see it highlights some pretty advanced stuff right off the bat. So let's get into what that means.
Okay, now this is where it gets really interesting. We're not just talking about a simple buy low, sell high kind of bot. No, this is way more advanced. You've got things like market making. That's where your bot is actually providing liquidity to the market. Then there's exchange arbitrage, which is a super cool strategy where the bot looks for tiny price differences between exchanges and profits from them. And on top of all that, you get trading templates, fully customizable strategies, and something called marketplace signals. And that signals feature, it's maybe one of the coolest parts. Basically, you can subscribe to professional analysts, real people who do this for a living. When they spot an opportunity and send out a buy or sell signal, your bot can automatically execute that trade for you. You don't have to be the genius in the room, you can just follow their lead. It's literally like having an expert co-pilot for your crypto portfolio.
Plus, you're not chained to your computer. They've got apps for both Android and iOS, which is a huge plus for trading on the go. And just look at the list of supported exchanges. We're talking about all the big players: KuCoin, Binance, Coinbase, Kraken, the list goes on. This wide support means there's a really good chance you can just plug it into the exchanges you're already comfortable with.
Okay, so it's definitely packed with features, that's for sure. But the big question is always, what's it going to cost? Let's take a look at the pricing plans.
And right off the bat, something that's a really big deal, there's a 7-day free trial. This is awesome because it means you can actually take it for a spin, test it out with your own strategies, and really get a feel for it before you even think about paying for a subscription.
So the plans are tiered, and it really depends on what you want to do. The basic plan starts at just $16 a month. Perfect for most day traders. If you want to get into that more advanced exchange arbitrage we were talking about, that tier is $41. And if you're a pro and want the full market-making toolkit, that's going to run you $83 a month. So they've really structured it around the specific type of trading you're looking to automate. All right, we've seen the cool features, we've seen the price. But now for the really crucial part, the verdict. Let's look at the pros and the cons that the source points out.
Okay, on the pro side of the list, it's apparently pretty easy to set up, it's priced well, and that marketplace with signals and strategies is a major win. Plus, the support for different coins and exchanges is excellent. But there are a couple of cons. First, not everything in that marketplace is free, so you got to watch out for extra costs. And then there's the big one, a real lack of transparency.
And this quote from the source material really hits the nail on the head. If I was to have one gripe, it would be that I cannot see who is behind the bot. Transparency goes a long way in crypto. And that is so true. In the crypto world, trust is everything. Not knowing who the team is behind a tool that's handling your money, that's a pretty big red flag.
We've all heard stories about anonymous projects that just vanish, the classic rug pull. Now, there's no sign of that here, but for anyone who puts security first, that anonymity is a serious drawback.
So, when you put it all together, what's the bottom line? Who is this thing actually for?
Well, according to the source, the answer is pretty much anyone who's interested in using a pro-level crypto bot at a reasonable price. Yeah, that transparency issue is a big deal, but the combination of powerful features and a good price point makes it a really compelling option, especially if you want to get into automated trading but don't want to learn how to code.
And that really leaves us with one final and pretty critical question to chew on. When it's your money on the line, how much trust can you really place in a bot, especially an anonymous one? The tech is impressive, for sure. The potential is definitely there. But in the end, it all boils down to trust. How do you balance these powerful new tools with the need to keep your own assets safe? That's the real question, isn't it?
All right, today we're jumping into one of the most popular crypto trading bots out there, 3Commas. We're going to break down what it is, how it actually works, and who it's really for, all based on a pretty detailed review of the platform. So, let me ask you something. Have you ever been in a trade, you've set a smart stop loss to protect yourself, but then the price just rips upward, smashes through what would have been your perfect profit target, and then comes back down, all while you were asleep or away from your screen? You missed out because you couldn't have both orders working at once? Sound familiar? Or, maybe it's the other way around. You set your take profit order, feeling good, but a sudden nasty price dip stops you out, kicking you out of the trade right before it turns around and skyrockets into what would have been a huge win. Ugh, it is a classic trader's headache. Okay, so here's our game plan. First, we'll talk about that common trading problem. Then we'll introduce the 3Commas bot. After that, we'll see how it can power up your trading. Then we'll get to the verdict, the pros and cons, and we'll wrap up with a really critical word of warning. All right, let's kick things off with Section 1, that common trading problem we just talked about. Let's call it the trader's dilemma. So here's the root of the problem. On a lot of crypto exchanges, you're faced with this fundamental limitation. You're forced to choose, do I set a take profit target to lock in my gains, or do I set a stop loss to protect my downside? You can't always do both at the same time, which is, to put it mildly, super inconvenient. And that's where tools like 3Commas come into the picture. So, Section 2, introducing the 3Commas bot. According to our source material, this is their #1 recommended solution for this exact problem. So, just how big is this thing? Well, get this. It has a user base of over 140,000 traders. That is a massive community trusting this platform. And those users are seriously active. The platform handles an incredible $65 million in trading volume every single day. Yeah, this is not some small-time operation. It's a major player. So what makes it so popular? Well, the review points to a few key things. A super intuitive interface, which is huge for something that's complex. It's packed with detailed analytics. It has a ton of functions, and most importantly, it gives you the power to create and run your own unique strategies. Okay, let's move on to Section 3 and really pop the hood here. Let's see how you can power up your trading by looking at the key features that make this bot tick. This right here is the star of the show, the smart trading feature. This one feature directly solves that dilemma we started with. It lets you enter a trade and set both your take profit target and your stop loss for protection, all in a single, unified order. Game changer. But it gets even cooler. 3Commas also has a trailing stop loss. So imagine your trade goes up 5%. This feature automatically pulls your stop loss up with it. It literally follows the price on the way up, locking in your gains while still protecting you from a sudden drop. It's a really powerful way to let your winners run. And the toolkit is just deep. You can backtest your strategies, you can set up DCA bots to buy in over time, and you can even keep a trader's diary. The review also highlights what they call a sweet signals marketplace, which is basically a way to copy the trades of other successful traders automatically. And, of course, you can do all this from their mobile app. And you're not just limited to 1 or 2 exchanges either. As you can see, 3Commas works with a whole bunch of the major players. We're talking Binance, Coinbase Pro, Kraken, you name it. That makes it super versatile if your funds are spread out. Okay, so what's it going to cost you? Well, the pricing starts at just $14.50 a month. And for anyone who's on the fence, they offer a free 3-day trial so you can take it for a spin and see if it's right for you. All right, that brings us to the big one, Section 4, the verdict. Let's really weigh the good against the bad and try to figure out, is this bot for you? So on the pro side, the source absolutely loves the interface, the copy trading, the huge exchange support, and of course, that killer smart trading feature. But the cons are really important to consider. Because it's so powerful, it is definitely not ideal for someone who's just starting out. And the big one, you have to keep your funds on an exchange to use it, and that comes with its own set of risks. I think the source really nails it with this quote that kind of sums it all up. It says, if you're an experienced trader looking for all the bells and whistles, you need look no further than 3 commas. It's really built for people who know what they're doing and want an advanced set of tools. And that leads us perfectly into our final section, and honestly, it might be the most important one, a critical word of warning. We have to talk about the risks. Okay, let's be really clear here. The number one risk of using any trading bot, and that includes 3 commas, isn't the bot itself. It's the fact that you have to leave your crypto on an exchange for the bot to do its job. And as we all know, exchanges can be vulnerable. That's a fundamental risk you take on. But you can be smart about it. The review offers some solid advice to lower that risk. First, don't put all your eggs in one basket. Split your funds across different exchanges. Always do your own deep research. Be incredibly skeptical of anyone promising guaranteed returns. That's a huge red flag. And finally, protect your API keys like your life depends on it. Because in the crypto world, it kind of does. And I think this is the perfect way to wrap things up. This is the right mindset to have. The source says, crypto trading bots definitely won't make you a millionaire, but if used correctly, they can equip you with the tools to improve your trading game. They are a tool, not a magic money printer. So we end with a final question for you to think about. Knowing its power, knowing it's for experienced traders, and understanding the risks involved, is this the right tool for your arsenal? Ultimately, that's a call only you can make. Thanks for tuning in. Hey everyone, and welcome. We have all been there, right? You get a hot crypto tip from a friend. They're promising you moonshot returns. And then you get that little voice in your head asking, wait, is this thing for real or is it a scam? Well, today we're going to build a super simple but really powerful first pass filter to help you sort out the potential gems from the absolute junk. So picture this. A friend you really trust comes up to you and they are buzzing with excitement about some hidden gem crypto that's supposedly on the verge of a 1000x return. You've got your trading account open, your finger is literally hovering over the buy button, that feeling of FOMO is just kicking in hard. So what do? I mean, really, what's your next move? How can you possibly know if this is a life-changing opportunity or just a massive mistake waiting to happen? Okay, let's just be blunt here, because the source material is. The very first thing you have to figure out is if you're about to pour your money into what the crypto world bluntly calls a shitcoin. You know, a coin that's basically all hype and has zero actual substance or use. That's the real problem we're trying to solve today. How do you spot those massive red flags before it's way too late? First up, let's talk about the 1000x temptation. We need to unpack this dilemma because it's a classic battle between a potentially huge opportunity and a really clever trap. Right, and this is where it gets tricky because the pressure is really on. You've got this story of a hidden gem, right? You've got the promise of these insane returns. Your friend is totally convinced, which makes you feel like you should be too. Everything is just pushing you to hit that buy button. But that one critical question is still hanging in the air. Is this thing actually worth it? Okay, so how do you actually figure that out? Well, next we're going to dive into the anatomy of these projects. The goal here isn't to make you an expert in 5 minutes, but to give you a solid framework for spotting the most obvious red flags right from the get-go. Look, the whole point here is to be efficient. We're just doing some basic due diligence to screen out the really bad apples early on. Think of it like a quick background check. There are certain characteristics that should just immediately make you stop and think. We are looking for the signals that tell you to run, not walk in the other direction. Okay, but here's a really important thing to remember from the source. This is not a zero-tolerance game. Just because a coin has one red flag doesn't automatically mean it's a scam. You know, some legit projects might have 1 or 2 weird things about them. The real danger is a pattern. When you see a coin that's hitting many of these criteria, that is when you should hear those alarm bells going off. All right, let's get practical. Our first tool is what I'm calling the exchange litmus test. This is a brilliant top-down approach that can save you a ton of time before you even think about reading a white paper. The question is super simple. Where can you actually buy this thing? So the big idea here is that you can kind of judge a project by the company it keeps. And in this case, the company is the exchanges that have listed its token. See, reputable exchanges have a business and a reputation to protect. They don't want to be associated with scams or so-called vaporware, those projects that are all promise and absolutely no product. And this slide just lays it out perfectly. A potential gem? It's probably going to be listed on multiple well-known exchanges, the ones you've actually heard of. But a major red flag is a coin with almost no exchange support, or one that's only available on these obscure, dodgy exchanges that you wouldn't even trust with your spam email address, let alone your hard-earned cash. All right, so we know what we're looking for, but how do you actually check it? Let's get into the digital tools you'll need to run this exchange litmus test and do it fast. The source points us to two big players here, CoinMarketCap and CoinGecko. Now, you can use CoinMarketCap, but the source suggests taking its rankings with a grain of salt. The real star of the show, for our purposes, is CoinGecko, and that's specifically because of a feature they call the trust score for exchanges. This is our go-to metric. And doing this is actually super simple. On CoinGecko, it's just 4 steps. You search for the coin you're curious about, click on the Markets tab, and boom, you'll see every single exchange it's traded on, right next to that all-important trust score. A sea of red or low scores? Well, that's a huge red flag right there. Okay, so let's put it all together. What we've just built is the first pass filter. It's not the end of your research, not by a long shot, but it is an incredibly powerful place to start. Now, I gotta be crystal clear about something. This is not the only due diligence you should ever do, but as a first step, it is incredibly powerful. It's designed to save you time and protect you from the most obvious, low-effort scams out there. If a coin can't even pass this basic test, you've saved yourself a ton of time and you can just move on. All right, let's recap the big takeaways from all this. First, always verify a hot tip, no matter who it comes from. Second, a top-down approach saves you a ton of time, and that means checking a coin's exchange listings first. Third, use CoinGecko's trust score as your compass. And finally, remember that a lack of support from reputable exchanges is one of the biggest red flags you can possibly find. This filter gives you a really solid tool to vet that next 1000x opportunity that lands in your lap. But that, of course, brings up the next big question. Once a coin passes this exchange test, what comes next? You've confirmed it's not some obvious piece of junk. So you've checked the exchanges and the coin passes. What's the next red flag you should be looking for to continue your investigation?
Have you ever looked at a crypto project and just wondered, is this thing for real or is it basically a digital ghost town? Well, if so, you are in the right place. Today, we're going to put on our detective hats and figure out how to see a cryptocurrency's real activity and, separate the projects that are actually thriving from the ones that are just elaborate fakes.
I mean, this is the question, isn't it? Before you even think about putting a single dollar in, you have to know, is there a real active market for this coin, or is it all just smoke and mirrors? Answering this one simple question can save you from a whole world of trouble.
The good news is you don't have to guess. There are 2 really crucial clues that help us solve this little mystery: trading volume and liquidity. If you can get a handle on these 2 concepts, you've got the key to telling a booming project from a deserted one.
All right, so let's jump into our first clue, and it's the one most people look at right away: trading volume. But there's a very specific way you need to look at it that makes all the difference.
You see, context here is everything. $1 million in daily trades might sound like a huge deal for some tiny, brand new project. But for something like Bitcoin, come on, that's a drop in the ocean. That's why we can't just look at the raw number. We have to look at it as a percentage of the coin's total market value.
So what's a good number to keep in mind? Well, here's a super simple but really effective rule of thumb: 5%. If a coin's 24-hour trading volume is less than 5% of its market cap, that's a red flag. It's generally considered pretty low and suggests there just isn't much real interest or activity there.
Okay, so you check the volume and hey, it's way above 5%. You're in the clear, right? Well, not so fast. What if I told you that high volume can also be a really carefully crafted illusion? This is where our investigation starts to get a little more interesting.
Yep, and this plot twist has a name: wash trading. This is the shady practice that dodgy projects use to make themselves look way more active and popular than they really are. They do it to create hype, to get that FOMO going, and to try and get listed on bigger, more reputable exchanges.
And look, this is the thing you really need to get. volume numbers on their own are not foolproof. They can absolutely be faked. Those sketchy projects that are desperate to create a buzz will often just generate fake trading activity to lure in investors who don't know any better.
So what is wash trading exactly? Well, imagine a project creates two wallets and just starts selling the coin back and forth between them, over and over and over again. There's no new money coming in, no real people are interested. They're just spamming the network to run up the numbers on the scoreboard, creating the illusion of a busy market.
And this analogy just nails it, doesn't it? Imagine you walk past a restaurant and it looks totally packed. You go in thinking, wow, this place must be great, only to find out everyone inside was literally paid to be there, the food's terrible, and you've been totally tricked. That's exactly what wash trading is in the crypto world. Okay, so if volume can be a total lie, what can we actually trust? We need a better tool, right? One that cuts through all that fake noise and finds the real signal. And that tool, my friends, is liquidity.
And this is the key difference right here. Liquidity isn't just about how much is being traded, it's about stability. It answers the most important question. If you wanted to sell your coins right now, could you do it easily and get the price you're expecting? Or would your sale just crash the price? See, high liquidity means the market is deep enough to handle big trades without a problem. That is the sign of a healthy market.
So how in the world do you measure this stuff? Do you need some kind of complex financial tool? Nope, not at all. You actually have a secret weapon right at your fingertips, and it's built into a tool I bet a lot of you already use, the CoinGecko Trust Score.
And honestly, it's super easy. You just search for whatever coin you're looking into, click over to the Market tab, that's where it shows all the exchanges it trades on, and then you look for that all-important Trust Score column.
Think of this score as your ultimate shortcut. CoinGecko is analyzing a whole bunch of factors behind the scenes to figure out if the volume an exchange is reporting is actually trustworthy and has real liquidity behind it. It's basically doing all the hard detective work for you. So here's the deal. This is what you need to look for. If you go to that Market tab and you see that most of the trading pairs for a coin have a low trust score, they're often colored red or yellow, that is a massive red flag. It's a really strong sign that you're looking at a low-interest altcoin, a project with no real market, and it's probably best to just steer clear.
So let's just boil it all down, okay? The core lesson here is pretty simple. High volume, it can be an illusion, a trick created by wash trading. But high liquidity, well, that's much, much harder to fake. It's a far more reliable sign that there's genuine interest and a real working market for the coin. And there you have it. You now have the tools to spot a crypto ghost town and avoid those wash trading traps. But remember, a busy market is only one piece of the puzzle. The next critical question you have to ask is, what is the team actually building? Is anyone even working on the code? Now that is a whole other investigation.
Hey everyone, and welcome. Today, we're going to demystify crypto due diligence. And don't worry, you won't need a computer science degree for this. We're breaking down a super simple way for anyone, yes, anyone, to evaluate a crypto project, all without touching a single line of code. So let's dive right in.
Okay, so this is the million-dollar question, right? You see a coin's price rocketing up, the hype is all over social media, but how do you actually know if there's anything real behind it all? How do you cut through the noise? Well, that's exactly what we're going to figure out today.
The secret is learning how to look under the hood. And we're going to do that with two simple but absolutely critical checks. First, we'll check the project's pulse to see if it's actually alive and kicking. And second, we're going to do a little detective work on the team pulling the strings behind the curtain.
All right, first up, checking the project pulse. I want you to think of this like you're a doctor checking a patient's vital signs. Is this project breathing? Is there a heartbeat? We need to see consistent signs of life because this is how you find out if anyone is actually building anything.
And you know, it really boils down to one thing. Is this place a bustling city of activity, or is it a digital ghost town? A healthy project has regular code updates. Think of them as entries in the developer's work journal. You'll see active discussions. A ghost town, on the other hand, crickets. Weeks, maybe months of silence. That is a massive red flag.
So where do you find all this activity? Well, you look in the project's public code repository, which is usually on a website called GitHub. See, the whole crypto space is built on the idea of transparency. The most successful projects in history have laid their code out for everyone to see. If a project keeps its code private, you really got to ask yourself, what are they hiding?
And listen, you do not need to be a coder to do this. It is way easier than it sounds. Seriously.
You just find their GitHub page, click on a tab that's usually called commits, and just look at the dates. Are things happening every day, every week, or was the last update 6 months ago? That one simple check tells you almost everything you need to know.
But hey, activity isn't just about code, right? You also want to check their blog, their social media channels. Are they putting out useful, substantial updates about their progress? Or is it just fluff? The classic announcement of an announcement. Look, if a team has nothing useful to say, it's probably because they're not doing anything useful.
And that brings us perfectly to our second critical check, the team. You can have the most brilliant idea in the world, but if the people executing it are sketchy or just not up to the task, the project is doomed. A bad team can sink even the most promising ship. So let's take a look at the who.
First things first, and this is basic stuff. Are the people listed on the website even real? Do a quick identity check. Can you find them on LinkedIn? Do their credentials actually check out? If the team is anonymous or you can't verify who they are, that is a gigantic red flag. Run, don't walk.
Okay, next question. Let's say they're real people. Is their experience actually relevant to what they're trying to build here? How long have they been in the blockchain world? I mean, if the team is full of marketing gurus, but they're trying to build a complex financial protocol, you have to be skeptical. Do their skills really match the mission?
And this one might be the most important question of them all. In crypto, technology is everything. Cutting-edge tech is what separates the real game changers from the pretenders. So if you look at the team page and it's 10 marketing folks and only one developer, how can you possibly trust that they can build what they're promising?
So, just to recap the big red flags with the team, you've got unverifiable identities, maybe a history of involvement in shady projects, or a team that is all marketing and no tech. And that last one is especially dangerous, because it is the classic recipe for vaporware. This is a project that is all sizzle and absolutely no stake. It looks incredible on the surface. Slick website, a massive marketing campaign, tons of hype, but underneath, there is no real product. Nothing is actually being built. And we have seen it happen over and over again. A great marketing team can push pure vaporware to insane valuations.
Okay, so you've checked the project's pulse, you've investigated the team, now it's time to put it all together with one final simple gut check. I call it the seed round test.
And here it is. This is the ultimate question you have to ask yourself. Forget the crypto hype, forget the token price for just a second. Based on the team's credibility and the actual activity you've seen, if these people walked into a room and asked you for money to fund their brand new startup, would you write them a check? Your gut answer to that question is usually the right one.
So there you have it, a simple framework to see past the smoke and mirrors. Check the project's pulse, investigate the team, and then apply the seed round test. In a world this noisy, the real skill isn't finding the hype train, it's learning to spot what's actually real. So my question to you is, what project are you going to investigate first?
Hey, welcome. Today, we are going to cut through all the noise and the hype in the crypto world. I mean, there are thousands and thousands of projects out there. So how in the world do you find the ones that are actually built to last? Well, we're going to break down a really simple 4-step framework that will show you exactly how to do just that.
And that's really the question, isn't it? The difference between a solid investment and just a risky bet. It pretty much always comes down to the quality of your own research. This framework we're talking about today is designed to help you get really confident in your analysis.
So here's how we'll break it down. We're going to start with the first big question, which is all about token utility. Then we'll dive into how to analyze partnerships, why a consistent vision is so important, and how to follow the money. It all builds up to a final checklist you can use on literally any project you're looking at. Okay, let's kick things off with the absolute bedrock of any crypto project. Seriously, before you even think about the tech or the team or the tokenomics, you have got to ask one very simple question.
Now, here's the thing about this slide. You'd be shocked how often the answer is just a flat no. So many projects seem to create a token just because they can. But you have to remember, a utility token's future value comes from people actually using it. If there's no real reason for it to exist, there's no real path for it to gain value in the long run.
And believe it or not, these are real ideas for projects that people have actually pitched. It sounds a little wild, right? But it makes a super important point. Just because you can slap a token onto an industry doesn't mean you should. You always have to question the fundamental need for it. You know, this right here is the ultimate stress test for token utility. It's especially true for projects built on big platforms like Ethereum.
I mean, if the whole point of the network is just to move value around, why go through all the hassle of creating a brand new token with its own headaches? A project needs a very, very good answer to this question to justify its existence.
And this really hits the nail on the head. So many projects will tell you, oh, our token is for staking to secure the network. But that's just a circular argument, you know? It's a mechanism, not a purpose. It's like saying the point of the token is, well, to have the token. Real value has to come from genuine activity happening on the network. Without that, getting mass adoption is going to be a serious, serious uphill battle.
So, okay, let's say a project passes that first utility test. The next logical question is all about adoption. How are they going to get people to actually use this thing in the real world? And that brings us right to our second point, business development and partnerships. You have got to learn to read between the lines here. A real partnership means there's some kind of concrete technical integration happening, a clear strategy that actually adds value. A hype partnership, on the other hand, that's usually just a fancy press release about a memorandum of understanding, or maybe they had a meeting that gets blown way out of proportion. You have to be super skeptical of announcements that are big on names, but really, really light on the details.
Man, this quote just says it all, doesn't it? A cool idea on paper is completely worthless without a practical plan to get it into the market. If the team can't clearly explain how they're going to get people to adopt their tech, it's a good sign they're running more on hope than on a solid plan.
All right, next up is something that becomes absolutely crucial for any project that's been around for a little while: consistency. A project's track record, or lack thereof, can tell you so much about its chances for future success.
Have you ever seen this before? A project that completely changes its identity every single year? This is a huge, flashing red flag. It shows they don't have real conviction in their ideas and they can't execute. I mean, if they couldn't make their first vision work, or their second one, why on earth should you believe they'll get it right with the third one?
And here you can see this play out in the real world perfectly. Projects like VeChain and Chainlink, they had a super clear strategy from day one, and they stuck with it. Now compare that to a project like Factom, which was all over the place, constantly changing its focus. And what happened? They ran out of money and eventually filed for bankruptcy. Consistency is such a powerful signal of a well-run project. And hey, consistency isn't just about the big vision, it's also about development. Here's a pro tip. Go and dig up their old roadmaps from a year or two ago. Did they actually deliver on what they promised? Or did those big milestones just kind of disappear without anyone saying anything? If a team has a history of under-delivering, you should probably take their grand future plans with a giant grain of salt.
Okay, this brings us to our final check. And trust me, it is a big one. This is especially true for projects that raised a ton of money in an initial coin offering, or an ICO. You have to ask the simple question: where did all that money go?
Let's look at a case study to see what I mean. Back in 2017, there was this project called Siren Labs, and they raised a staggering $157 million in their ICO. And their big idea? They were going to develop a blockchain phone.
They generated a ton of hype. They even got a major celebrity endorsement. I mean, with that much cash in the bank, you'd think they'd be set for life, right? You'd expect them to build a sustainable business. So, what happened to all that money?
And that is the terrifying part. They burned through that cash so fast they had to lay off a huge chunk of their staff. The phone was a flop, and the funds just vanished, with no clear public accounting of where it all went. It is a classic, powerful cautionary tale about what happens with irresponsible spending.
So here's the bottom line. Legitimate projects, especially the ones that have a foundation set up, they will provide detailed reports on how they're using their funds. If a project is being secretive about its spending, you have to assume there's a reason for that. Transparency here is absolutely non-negotiable.
Whew. Okay, we have covered a ton of ground here. We've gone from the big, abstract idea of a token all the way down to the cold, hard cash in a project's bank account. So now, let's pull it all together into one simple, actionable checklist.
Here it is, your 4-step playbook to bring some serious clarity to your research. First, question the token's very existence. Second, separate the real business deals from the marketing fluff. Third, look for a consistent vision and a reliable track record. And fourth, demand to see the books. Demand financial transparency. If you follow these steps, I promise, it will dramatically improve your ability to figure out a project's real long-term potential.
Look, this framework isn't just some theory. It's a tool, and it's meant to be used. So the only question left is, which project are you going to put to the test first? Thanks for watching. All right, let's dive in. You know, in the crypto world, it can feel impossible to tell what's real and what's just, well, noise. So today, we're going to put on our detective hats, we're going to learn how to spot the difference and really get to the truth behind all that hype.
So, picture this. You see a new token just exploding on social media, right? Everyone's talking about it, you got influencers yelling about it, and you start to feel it, that little itch, that FOMO, the fear of missing out. But you got to stop and ask yourself, is any of this for real?
And look, the hard truth, a lot of the time, it's just not. It's an illusion, right? Carefully crafted to make you feel all this excitement and demand that isn't really there. And that's exactly what we are going to crack open today.
So we're calling this one the case of the missing hype. And our number one suspect, it's something called an artificial perception of demand. It's a fancy way of saying that a project, instead of, building real interest, just decides to fake it. So the big questions are, why do they do it? And more importantly, how can we spot it?
All right, every good detective knows you've got to look for the clues. And believe me, when these projects fake their popularity, they leave a trail. So let's get into the nitty-gritty and check out the two biggest breadcrumbs they leave behind.
Okay, first up, we have something called page shells. Now think of these as like front operations. They might look legit, like a media site or another project, but their one and only job is to pump up a specific coin. The biggest giveaway? If you find some outlet that only, and I mean only, talks glowingly about one super obscure project and nothing else, well, that's not journalism, folks. That's a huge clue. It makes you wonder, is there any real organic interest here at all?
And clue number 2? This one's a classic, sock puppets. Yeah, these are basically the digital foot soldiers of fake hype. We're talking about fake online accounts created for one single purpose, to go out there and promote a project to make it look way, way more popular than it actually is.
And these sock puppets can be pretty tricky. It's not always obvious. Sometimes they're super sophisticated, like a really well-known influencer who just conveniently forgets to tell you they're being paid. But other times, it's much simpler. You'll see those really basic accounts, right? Generic name, no profile pic, and their entire post history is just one long hype train for a single coin. Come on, that's not a fan. That's a puppet.
Okay, so we've found our clues, we've got the page shells, we've got the sock puppets, but that brings us to the motive. I mean, why would a project go through all this hassle? Is this just some clever marketing tactic, or is there something a little more sketchy going on?
Well, when you boil it all down, it just screams desperation. Seriously. Creating all this fake hype is a massive red flag. Why? Because it tells you they have zero confidence in their own project. I mean, think about it. If your project had real value, real organic interest, you wouldn't need to fake it. For any smart investigator, and that includes you, this kind of thing is a huge turnoff.
And this is where we need to make a really important distinction. Look, there's nothing wrong with a project paying for marketing or getting an influencer to cover them. That's just business. But there's a right way to do it and a very wrong way. The right way, it's all out in the open, transparent, fully disclosed. The wrong way, that's manipulation. It's when they're secretly trying to build this fake story because they're desperate. At the end of the day, honesty is what you're looking for.
But hold on. Before we wrap this case up, a little word of caution. Any great detective knows you can't solve a mystery with just one clue. You can't just see one thing and immediately jump to conclusions.
And this is super important, especially for brand new projects. I mean, a new coin is probably going to have low volume, right? It might only be on a couple of exchanges because it's just getting off the ground. It's not going to have the same buzz as some big established coin, but that doesn't automatically mean it's junk. It could actually be a hidden gem. It all comes down to context. Context is absolutely everything.
And that really gets to the heart of it, one of the most essential rules. You have to look at the whole picture. Don't just write off a project because of one or two little things. You've got to take that holistic view, look at all the evidence together. That is the only way you're going to make a smart call.
So, you've gathered your evidence, you've thought about the context, now it's time for the verdict. And this is a big one. We have to draw a clear line between a project that's just junk and one that's a flat-out scam.
You know, it's really easy to throw that word scam around, isn't it? But we've got to be careful not to overuse it. Here's the thing. Not every bad project is a scam. It really all boils down to one critical thing: intent.
Let's really break this down. A junk coin is just, well, it's not good. Maybe the creators didn't mean any harm, they just made something that has no real value or isn't unique.
A scam, though, that's totally different. A scam is built from the ground up with malicious intent. It's designed from day one to deceive people. And here's why that difference is so crucial. A junk coin is something you just avoid holding to protect your own money. A scam, on the other hand, is something you report to protect the entire community. And that's really the bottom line for any crypto detective out there. Your job isn't just to find the outright scams. It's to find any project you don't want to be holding in your portfolio. Just because the creators weren't trying to be evil doesn't magically make it a good investment.
So there you have it. You've got the tools of a crypto detective now. You know how to spot the clues, you know how to analyze the motive, and you know how to come to a final verdict. So the only question left is, now that you're armed with all this knowledge, what are you going to investigate first?
Welcome to The Explainer. Today, we're cracking open the toolbox of one of the most talked about apps in crypto, the Crypto.com app. And I mean, with over 1 million downloads, it's pretty obvious this thing has grabbed the attention of a lot of people. So what's all the fuss about, really? Is it just a bunch of hype, or is there a seriously powerful set of tools inside that's making everyone talk? Well, let's find out. So here's how we're going to break it down. We'll start with a look at the all-in-one platform, then get into storing your money, earning interest, getting loans, and finally, how you can actually spend your crypto and keep track of it all. Okay, first up, let's just get a handle on what they mean by an all-in-one platform. The goal here is to give you a really clear picture of what this app offers so you can figure out if it's the right fit for you. All right, let's get down to the absolute basics of any crypto app, how you hold and move your money. And that all begins with your wallets. The app basically splits this into two. You've got your crypto wallet, which holds over 80 different coins. Then there's the fiat wallet. Now, fiat is just the fancy term for regular government money, like US dollars or euros. This is where you'll hook up your bank account to move cash in and out. Now, here's a really important detail when you want to withdraw your crypto. With some other platforms, you can pay a higher fee to make your transaction go faster. Not here. Crypto.com charges a fixed, flat rate. For example, the source mentions a Bitcoin withdrawal costs 0.0003 BTC. And it doesn't matter if the network is super busy or totally dead, that fee is what you pay. The process itself is pretty simple, but there's a nice security step built in. Before you can send any crypto out, you have to whitelist the address you're sending it to. It's a one-time thing where you add the address, then click a confirmation link in your email. Once that's done, sending funds to that specific address is super easy. And when we're talking about moving your regular money around, this slide sums it up perfectly. The good news? Crypto.com charges you $0 for bank transfers. But here's the catch. Your own bank might hit you with a fee, and it could be anywhere from $6 to $40. So yeah, that's definitely something you want to check with your bank about first. Okay, let's move on to one of the app's biggest features, something called Crypto Earn. This whole thing is designed to let you make passive income on the crypto you're already holding. I mean, you just have to look at this chart to see why it's so popular. A normal savings account at a bank will get you, less than 1% interest a year? Meanwhile, Crypto Earn is advertising rates up to 18%. That is a massive, massive difference. But, and this is a big but, that giant 18% number doesn't just happen automatically. Nope. It comes with some strings attached. So let's take a look at what you actually have to do to get that top-tier interest rate. Okay, so your rate really boils down to 3 things. First is the type of crypto. You get different rates for stablecoins, those are the ones pegged to the US dollar, versus other cryptos. And no surprise, the highest rates are for their very own CRO token. Second is the term length. You can have a flexible term or you can lock up your funds for 1 or 3 months. And third, you can snag a staking bonus, an extra 2% if you hold and stake a certain amount of their other token. And this quote from our source really says it all. The longer you're willing to commit your crypto, the more interest they'll give you. Committing to a 3-month lockup is how you unlock the highest possible rate for whatever coin you're holding. All right, what's next in the toolbox? It's another really powerful feature called crypto credit. This basically lets you get an instant loan by using your crypto as collateral, and you get to skip the whole slow, paperwork-filled mess of getting a loan from a bank. To really get this, we first need to understand what an over-collateralized loan is. And it's actually just what it sounds like. You have to put up collateral that's worth a lot more than the loan you're actually getting. The source material uses a perfect analogy for this. Think about a pawnbroker. You bring in something valuable, like some jewelry. They look at it, figure out what it's worth, and then lend you a chunk of that value, maybe 50%. They keep your jewelry, and if you don't pay them back, well, they just sell it to get their money. Crypto credit works the exact same way. You deposit crypto, like Bitcoin, as collateral, and in exchange, they give you a loan of stablecoins, those price-stable tokens we talked about, worth half of your collateral's value. But, and this is the really big risk, since the price of your crypto can go up and down, if its value drops too much, the platform will automatically sell it or liquidate it to pay back your loan. Okay, on to our final section. Let's look at how the app closes the loop, helping you not just hold crypto, but actually spend it in the real world and keep tabs on your whole portfolio. So they have this feature called Crypto Pay, and it's all about building a bridge from your digital assets to your everyday spending. You can buy gift cards for hundreds of brands, top up your phone credit, and even pay directly in some stores using a QR code. One of the most practical ways to use this, as pointed out in the source, is buying gift cards for things you need anyway, like groceries. It's a simple way to use your crypto for daily life. And if you use their CRO token to buy the gift card, you can even get cash back. Pretty cool. And of course, an all-in-one app needs to help you track everything. So it has a simple portfolio tracker that gives you this handy little pie chart, showing you exactly how your holdings are spread out across all the different coins you own. And it's not just about your own coins. You can also keep an eye on the entire market, with price data for all the top cryptocurrencies. A really useful tool here is the price alert. You can set it up to send you a notification for any coin, so you'll be one of the first to know if a price starts to take off. So after our tour of this pretty jam-packed toolbox, from wallets and earning to loans and payments, it all comes down to this. The app gives you a ton of convenience by putting everything in one spot. The final question, and this is one only you can answer, is whether all that convenience is worth the volatility and the risks that just come with playing in the crypto market. All right, if you're in the crypto world, you have almost certainly faced this problem. You've got these digital assets, which is great, but how in the world do you actually use them to buy, normal stuff? Well, today we're going to break down one of the most popular ways to do just that. I mean, right? It's the classic crypto problem. You can see all this value sitting in your digital wallet, but trying to get it from that wallet into the cash register for your morning coffee can feel, well, super complicated, if not impossible. It's that frustrating gap between the digital world and the real one. But what if I told you the solution is actually something you're already super familiar with? A Visa card. But this one is built from the ground up to connect directly to your crypto. So let's dive into exactly how the Crypto.com Visa card makes this happen. Okay, so let's get right into it. How do these cards actually manage to bridge that gap? How do they take something totally digital like Bitcoin or Ethereum and let you swipe for it anywhere that takes Visa? First things first, the basics. So who can get one? Well, they're available in a lot of major places: the US, the UK, Europe, Canada, and Singapore. And they let you spend some of the biggest cryptos out there, like Bitcoin and Ethereum. But the one to really pay attention to here is MCO, which is Crypto.com's own token, because it's the key to unlocking the really good stuff. Now, Crypto.com has a few different tiers of cards, but we're going to focus on the two that are the most popular and easiest to get into. We'll start with the first one, the Midnight Blue card, which is honestly a complete no-brainer for anyone even slightly curious about this. And here's exactly why it's a no-brainer. It is 100% free. Seriously, there are no annual fees, no hidden costs to get it or to keep it. It is the absolute zero-risk way to just dip your toes in and see what spending crypto is all about. So, what do you get for nothing? Well, for starters, you get 1% cash back on every single thing you buy. And that's paid back to you in that MCO token we just mentioned. You also get up to $200 a month in free ATM withdrawals. And here's a great perk for travelers: $2,000 a month in fee-free foreign exchange rates. Not bad for a free card, right? Okay, so the free card is a great start, for sure. But what if you want a little more? Well, let's move up to the next level, the Ruby Steel card. To really get why this card is so great, we've got to talk about a key crypto concept called staking. Now, staking sounds super technical, but I promise it's actually really simple. All it means is, to get the Ruby card, you have to buy and hold about $250 worth of MCO tokens in your app. The best way to think about it is like a security deposit. You're not spending the money, you're just holding it there to unlock all the card's benefits. And this is the most important part to understand. This is not like an annual fee that just vanishes into thin air. The source puts it perfectly. These tokens are only staked, and you can get them back later. It is a totally different game than a traditional card fee. Okay, so you've put down your refundable stake. What's the return on that little investment? What do you actually get for it? Let's break down the real-world value of the Ruby card. Right off the bat, your cashback doubles. Boom, 2% back on every single purchase. That is a highly competitive rate, even when you compare it to some of those premium credit cards that charge you hundreds of dollars a year in fees. And here's the next big one, a full 100% rebate on your Spotify subscription. Yeah, you heard me right. In the US, that's about $10 a month. Over a whole year, that free music adds up to about $120 in value, paid right back to you. So let's really put that 2% cashback into perspective. Imagine you spend about $1,000 a month on just normal stuff, groceries, gas, bills, you name it. Over the year, that's $12,000. At 2%, you would earn $240 in crypto cashback just for doing your regular shopping. So let's add it all up. You take the $120 in value from Spotify, you add the $240 in cashback from our little example, and you're looking at an estimated $360 of value every single year. And remember, that's all from a card where your initial stake is totally refundable. You know, beyond all the numbers, there's another benefit that's a little harder to quantify. The Ruby Steel card is actually made of metal. And the source notes there's something just, quote, super alluring about paying with a metal card. It's got that weight, that premium feel. It's a small detail, but it's pretty cool. So we've laid out the free, no-brainer option and the upgraded, value-packed option. And all of this brings us to the final big question. Which one of these actually makes sense for you? Let's just put them side by side to make it super clear. The Midnight Blue is free and gets you 1% back. The Ruby Steel needs that initial stake, but in return, it doubles your cashback, throws in the free Spotify, doubles your ATM and exchange limits, and of course, upgrades you to that slick metal card. The choice really just comes down to your own spending habits and which perks you value most. And really, that's the core question you have to ask yourself. Based on how you spend your money and how much you'd use those perks, does that jump from the free card to the staked card make financial sense? It's a calculation of value that now you are perfectly equipped to make for yourself.
So you've probably seen the ads for Crypto.com everywhere, right? It's pushed as the absolute easiest way to get into the crypto market. But one author did a really deep dive, and their review brings up some pretty fascinating questions. Is it really as simple and great as it looks on the surface? Well, let's dig into it.
First things first, what's the big draw? Well, the author kicks things off by saying it's all about how simple it is. Seriously. They say trading on the app is just a few taps, you hit the trade button, pick your crypto, and bam, you're done. It's clearly built from the ground up to feel super easy, especially if you're just starting out.
But you know how it is in the crypto world. Whenever something seems that simple, you kind of have to ask yourself, all right, what's the catch? And that's exactly where this review goes next, tackling a pretty huge accusation head on.
And there it is, the bombshell. The review dives right into this really serious claim that's been floating around online. Could Crypto.com be a giant Ponzi scheme? The author mentions that the platform's super high interest rates are a big part of why people are suspicious, and this question really becomes the core of their whole investigation.
So, is it a Ponzi scheme? Well, the author doesn't just throw that question out there and leave you hanging. No. Instead, they start building a really solid case for why the platform is, most likely, a totally legitimate business. And they start with some pretty convincing evidence.
The very first piece of evidence the author brings up is this number. Over $10 million. That's reportedly what Crypto.com paid just for their domain name, for the website address. And the author's point is pretty straightforward. Fly-by-night scams don't drop 8 figures on a URL. That's the kind of move a company makes when it's planning to stick around for a long, long time.
And the evidence just keeps piling up. The author points out that Crypto.com has been building out its whole ecosystem for years now. They've got major partnerships with huge household names like Visa and the security company Ledger. And this is a big one for users in the US, your US dollar balances are actually covered by FDIC insurance. You know, these are all signs of a real, established, and regulated financial company.
So after weighing all that evidence, the massive investments, the big-name partners, the insurance, the author comes to a pretty clear conclusion. They think it's highly unlikely that this is some kind of Ponzi scheme. But that does not mean the platform is perfect. And next, the review gets into the author's specific problems with it. And this right here brings us to what the author calls the single biggest issue with the app. And it's not about fraud or anything like that. It's about a really fundamental idea in cryptocurrency: control.
So the core problem, according to this review, is that the wallet inside the app is completely centralized. Now that might sound a little technical, but what it means for you as a user is huge. And for a lot of crypto purists, it kind of goes against the whole point of crypto.
Okay, so this is the crucial difference. Let's break it down. With a centralized wallet like the one on Crypto.com, you don't actually hold the private keys to your crypto. The author explains it's just like a normal bank holding your money for you. But with a decentralized wallet, you hold the keys. You are your own bank.
And that's the bottom line. When you use their app, you are making a conscious choice to trust the company to keep your assets safe. And look, while the author doesn't think they're a scam, they make it crystal clear that this is a major trade-off you absolutely need to know about. You're giving up custody of your own crypto.
Now, beyond that really big philosophical issue of control, the author also details a few other specific things they don't love about the platform's features and, well, its business model.
All right, let's run through these quickly. The author is not a fan of the fee you have to pay just to withdraw your cash to an outside wallet. They also point out that if all you want to do is track the value of your portfolio, there are way better dedicated apps for that. And finally, they note that the app is very obviously designed to push you into buying its own tokens, MCO and CRO, because you have to own and stake them to unlock all the cool stuff, like those popular metal cards.
So, after laying out the case for it being legit, but then hitting on the concerns about control and all these other dislikes, what's the final verdict from this review? Where does the author ultimately land on all this?
You know, the review actually comes full circle, right back to the very first point. Despite all the criticism, the author gives credit where credit is due. The development team has built an app that is, without a doubt, super well designed, smooth, and incredibly easy for literally anyone to pick up and use.
And this really boils the entire review down to one central dilemma. On one hand, you've got this beautiful, feature-packed app that makes crypto feel easy. But on the other hand, you have to accept that you're handing over control of your assets to a third party, and they're constantly nudging you to buy into their own ecosystem. It's that classic trade-off: convenience versus control.
So in the end, the review leaves us with this question. It doesn't give a simple, yes, you should use it, or no, you shouldn't. Instead, it just lays out all the facts as the author sees them, and then asks you to decide what you value more. Is that slick, easy convenience worth the fundamental compromise of giving up direct control over your own assets? That's the key question you have to answer for yourself.
We're all on the hunt, right? For that one altcoin, the one that could multiply our investment by 10, 20, maybe even 100 times. It's that moonshot that can totally change the game for your portfolio. So how on earth do you even start looking for it? Let's break down the absolute first step. I mean, let's be real. You're here because you've seen the stories, you've seen those crazy charts, and you're asking yourself, how can I find that next hidden gem before everyone else does? Well, you are definitely not alone. And you know what? The potential is absolutely massive. And look, this isn't just some crypto fairy tale. As this quote right here shows, real people have made life-changing money doing exactly this. But, and this is a big but, in today's market, it is so much easier said than done. So let's get serious. Finding that diamond in the rough means you've got to venture into what is basically a very crowded and, yeah, often pretty dangerous crypto jungle. The dream is real, but so are the risks. I mean, the sheer number of choices you have is just staggering. We're talking thousands upon thousands of altcoins out there. Trying to research every single one, that's not just hard, it's literally impossible. And here's the cold, hard truth from our source material. The vast majority of these projects, well, to put it bluntly, they're just not worth your time or your money. They're what the community calls shitcoins. But, and this is what keeps us looking, those golden nuggets are out there. So that's the million-dollar question, isn't it? With so much noise, so much junk out there, how do you filter it all out to find the projects that have real, honest-to-goodness potential? Where do you even begin? The answer is to use a top-down approach. You need a simple but super powerful way to screen everything and create a manageable shortlist. And your most effective #1 first filter is market cap. Now, for anyone who's kind of new to this, don't worry. It's simple. Market cap is just the total value of all of a project's coins combined. You just multiply the number of coins by the price of one coin. That's it. Think of it like a company's total value on the stock market. It's a crucial number that tells you how big the project is right now. So here's your game plan. It's pretty straightforward. You start with everything, the whole market. Then you apply your market cap filter, which instantly gets rid of thousands of coins you don't need to look at. This leaves you with a much smaller, manageable shortlist, and that's where your real deep dive research can finally begin. And the best part, you don't have to do any of this math yourself. There are awesome free tools out there like CoinMarketCap, CoinGecko, and CoinCodex that do all the heavy lifting for you. Our source material gives a special shout out to CoinMarketCap because it has a great feature that lets you filter by specific market cap range. Super useful. Okay, so you might be wondering, why are we so focused on market cap, and why are we looking for the little guys? Well, it's all about one thing. We are hunting for coins that have the most room to grow. The logic here is so beautifully straightforward. It's not some complex financial theory you need a PhD for. It all just boils down to basic arithmetic. And that's what makes it so powerful. Just think about the numbers for a second. Let's say you have a project that's already worth $50 million. For that to 10x, it has to become a $500 million project. That requires a massive, massive amount of new money to flow in. But a little $2 million project, to 10x, it only needs to get to 20 million. That is a much, much more achievable goal. So we know we want low cap coins, but how low is low? We needed to find a target range, a kind of golden zone, to focus our search. This helps us get rid of coins that are either too big to multiply or, frankly, too small and risky to be viable. The whole point of setting this range is to find projects that have a huge runway, enough headroom to grow exponentially if and when the rest of the market finally recognizes its value. So for the upper limit, our source material suggests a general rule of thumb, about $10 million. Anything much higher than that, and the odds of getting a 100x return start to get pretty slim. It's just the law of large numbers kicking in. And on the other end, the floor, the suggested lower bound, is around $5 million. Now look, this isn't a hard and fast rule. You might find a winner below this, but it's an incredibly useful filter. And here's why. It's because, as the source points out, most of the projects below this $5 million level are just noise. You're wading into a swamp. They have almost zero adoption, no community to speak of, and even if the tech is amazing, they're probably just going to get lost in the crowd and go nowhere. This filter helps you avoid that wasteland. So if you only take one thing away from this whole explainer, let it be this. When you're hunting for those high-potential altcoins, your first and your most powerful tool is the market cap filter. It is the absolute simplest way to cut through all the noise and create a short list of projects that actually have a realistic chance to grow. Of course, finding coins in this golden zone is just step one. It gets you to the starting line. Now you've got this great shortlist. But the really critical challenge is figuring out which of those projects has real value. So once you have your list, what are the fundamental signs of a winner? Well, that's the next step in the journey. All right, if you're in the crypto space, let's be real. You've probably asked yourself this 100 times. With all these thousands of altcoins, how on earth do you find one that could actually be a massive winner? It can feel impossible, kind of like looking for a needle in a haystack. Well, today, we're going to walk through a really simple but super powerful two-step method to do just that, to cut through all the noise and find those potential gems. And when I say haystack, I am not kidding. We're talking about a sea of over 9,000 different altcoins. And honestly, new ones are popping up every single day. It's just a completely overwhelming number, and there's just no way you could ever research every single one. So that's the big question, right? How do you separate the projects with real potential from all the scams and, the general noise out there? The trick is to start thinking like a prospector. We need to build a funnel, a system to filter this massive, messy list all the way down to just the gold. Okay, so our filtering process kicks off with one of the most revealing metrics there is, trading volume. This first test is kind of like our blunt instrument. It's broad, but it is incredibly effective for getting a quick health check on a project and spotting some huge red flags right from the get-go. The specific number we're zeroing in on is the volume to market cap ratio. Now, I know that sounds a little technical, but stick with me. The idea is actually super simple. All we're doing is looking at how much of a coin's total value gets traded in one 24-hour period. This single number tells us a whole lot about how active and legit that coin's market is. Now here's where it gets really interesting. There's a Goldilocks zone we're looking for, a sweet spot. If a project has a daily volume that's between 10% and 50% of its market cap, that's usually a pretty good sign of healthy organic trading. To put it another way, it means it takes about 2 to 6 days for the entire value of the coin to be traded. That's our healthy range. And this right here shows you exactly why that range matters so much. On the left, in that healthy zone, you've got what looks like real people actually buying and selling. But on the right, when you see a volume that's way, way too high, sometimes bigger than the entire market cap every single day, that is a massive red flag. It usually points to something called wash trading, which is just a fancy way of saying the value is being artificially pumped up. This simple check helps us immediately throw out projects that have fake-looking activity. And you want to know the best part? You can do this yourself in like 5 minutes. You don't need any special software. Just grab the data from a site like CoinMarketCap, drop it into a spreadsheet, and write one dead simple formula: volume divided by market cap. Then just filter for that 10 to 50% range, and bam, your list just got a whole lot smaller and a whole lot better. Okay, so just by filtering for healthy volume, we've already cleared out a ton of the noise. So now it's time to apply our second filter, the exchange test. Because how much a coin trades is really only half the story. To make sure that volume is the real deal, we need to know where it's being traded. This quote right here just nails it. For a project to have any shot at that explosive kind of growth, it needs to be seen by a lot of people. It has to be listed where the action is, on an exchange that makes it easy for a huge number of people to find it, get excited about it, and then actually buy it. So what are we actually looking for in a quality exchange? Well, you want to see things like a high trust score from ranking sites. You want to see deep market depth, which really just means there's enough money sloshing around that you can buy or sell without totally wrecking the price. And most importantly, you want to see a huge user base and a ton of web traffic. These are all signs of a healthy, buzzing marketplace. So this is the kind of thing that should immediately set off alarm bells. Let's say you find a coin that passed our volume test, but then you realize it only trades on one tiny sketchy-looking exchange you've never even heard of. That's an instant red flag. It's a huge sign of risk and, frankly, questionable legitimacy. On the other hand, this is what you want to see. Finding a coin listed on a major, well-respected exchange like Binance is a fantastic green flag. It's not just about the brand name. It means the project has access to tons of liquidity, millions of potential buyers, and the kind of traffic that can create real momentum. Okay, so let's put it all together. After running our list through these two powerful filters, you're not staring at a list of thousands anymore. You're left with a much smaller, much more focused, high-potential list of projects that are actually worth your time to research further. And this is the magic of the funnel in action. You start with that insane universe of over 9,000 coins. Our volume test alone chops that list down dramatically, probably to around 200 projects. Then, the exchange test refines it even more, leaving you with this focused, totally manageable list of about 50 projects. Every single one of them has now passed 2 critical tests for legitimacy and potential. So, you've done it. You've cut through all that noise and you've found the signal. You have your high-quality list. But you've got to remember, this isn't the finish line, this is the starting line. Now the real work, and honestly the real fun, begins. It's time to ask the biggest question of all. What makes these projects fundamentally valuable? Your deep dive? Well, it starts right now. Welcome to The Explainer. Today, we're going to cut right through all the crypto hype. I'm going to show you a really powerful, data-driven way to research altcoin projects. Pretty much any cryptocurrency that isn't Bitcoin. All right, let's picture this. You found a crypto project that seems promising. The idea is brilliant, the team looks top-notch, but how can you possibly know if anyone is actually using it? How do you tell if you've stumbled upon a bustling digital city or just a ghost town with a really fancy billboard? So, first things first, we've got to look beyond all that project hype. The biggest challenge, really, is finding real substance behind the slick marketing and flashy websites. With literally thousands of coins out there and every single one of them claiming to be the future, it's just so hard to separate the real contenders from the pretenders. We need a reliable way to check the claims and see how healthy a network truly is. So how do we do that? How do we gauge what's really going on? Well, the answer, it's right there in the blockchain's own data. That's where we find the truth. And this data, this is what we call on-chain metrics. Think of them like the vital signs of a crypto project, right? They're your direct window into its real-time usage, and it's all recorded on a public ledger for anyone in the world to see. And the source material really hits the nail on the head here. On-chain metrics help us figure out if a project is functional and active, or if it's just a nice concept on paper. It's all about what's actually being used, not just what sounds good in a white paper. And there are so many different pieces of data we can look at to really get a feel for a network's health. You can check out address activity, the total number of transactions, how many people are participating in the network, even stuff like staking activity for certain coins. Okay, so you might be thinking, do I need to be some kind of data wizard to figure all this out? And the answer is nope. Thankfully, there are tools out there that do all the heavy lifting for us. The source material we're looking at points to one specific platform that's actually designed for exactly this. Its whole purpose is to gather all this complicated data and make it easy to understand. It's called Into the Block. The source describes it as having an overabundance of data, which honestly is exactly what we want. It's a seriously powerful resource to have in your toolkit. This is where our real investigation can begin. All right, let's get into the fun part, the practical stuff. Let's see how we can actually use this to build our case for or against a project by looking at a few key metrics that tell a really powerful story. The source lays out this clear, repeatable process. Think of it like a 3-step investigation you can use for any altcoin. First, you compare the number of active addresses to the total number of addresses. Second, you track how addresses and transactions are growing over time. And third, you take a close look at who actually holds the tokens. So for that first step, what we're looking at is the ratio of active addresses to the total number of addresses. And what you see here, this is what you want to see. A big chunk of active users means you've got a living, breathing ecosystem where people are actually using the network, not just sitting on their tokens. But on the flip side, this is a huge red flag, a tiny sliver of active users. Well, it kind of suggests that nobody's really home, It's a sign that people might not be using the network for what it was built for. Now, beyond just that ratio, we've got to look at the trends over time. That's step 2. Are more people showing up to the party? Are more transactions happening? If both of these are trending up, that is a fantastic sign of a growing, healthy network. You're basically watching adoption happen in real time. And here's another little clue you can dig up with a tool like Into the Block: the time between transactions. It's a super quick and easy way to get a pulse on the network. The shorter the time, the more activity is happening. Simple as that. Okay, and finally, our third and maybe most crucial step, we've got to look at who owns the tokens. The source is really clear on this. Centralization is a huge risk. Why? Because if a handful of people hold most of the coins, they can basically control the whole market. And yeah, just to be super clear, that's whales with an H, not the country. In the crypto world, these are the big players who hold a massive amount of a coin. And trust me, they can make some very big waves. A few of these whales can create a ton of volatility and pose a really significant risk to a project's long-term health. So when you put all these pieces together, the activity, the growth, the distribution, you're not just guessing anymore. You're not just speculating based on hype. You're investigating with cold, hard data. This whole data-driven approach, it gives you a massive research edge. It forces you to look past the hype, use on-chain metrics to see what's really happening, track that growth, and, so important, spot those centralization risks before you invest. At the end of the day, the data doesn't lie. The blockchain is basically an open book for everyone to see. And now, you know how to read it. So the only real question left is, what story are you going to let it tell you?
In the crypto world, it's so easy to get swept up in all the hype. But how do you find the projects that are actually building something real, something with substance? Well, today, we're putting on our detective hats. We're going to learn how to research altcoins and separate the real deal from all the noise.
And this is really the big question, isn't it? The crypto space is just this massive sea of noise. For every one solid project, there are, dozens that are just pure marketing fluff. So how in the world do you find those actual gems? How do you pick out the real signal from all that static?
Well, here's a secret. The answer is not going to be on some wild skyrocketing price chart. Nah. Real research, real due diligence means you have to look under the hood. We've got to get our hands a little dirty, We need to examine the engine, the actual code being written, and, just as important, the people who are writing it. That's where you find the real story.
All right, first up, we follow the code. I want you to think of a project's development activity as its heartbeat. Is it strong, steady, and regular? Or is it weak, maybe even fading away? This is, hands down, the
the most transparent way to see if a project is actually alive and kicking.
So what exactly do we mean by development activity? Well, to put it simply, it's the public, verifiable proof that developers are constantly, actively working on the project. In a space that is just full of big promises, this is the hard evidence. This is what separates the real, impressive technology from all the empty hype.
And here's the best part. You can check this yourself, and you don't even need any programming skills. Seriously. Just find the project's GitHub page. From there, you go to the Insights tab and look for something called commits. Just think of these as saved updates. They show that work is constantly happening. Then pop over to the Issues tab. Is there an active discussion going on? Are people actually solving problems? This stuff tells you so much.
And when you look, man, the difference is just, it's night and day. On one side, you see a healthy, living project. You see a constant rhythm of activity, of building. On the other side, a digital ghost town. We're talking months of total silence, issues that are just piling up with no answers. That is a crystal clear sign of a project that's in decay.
Okay, but here's a really important caveat. A quiet public GitHub doesn't always mean a dead project. Sometimes the real work is happening behind the scenes, in private. So before you totally write it off, do this one last check. Go look at the project's official blog or their developer docs. If they're building in private, that's where they'll post the updates.
Now for our second pillar of investigation, the team. Because let's be real, technology doesn't just build itself. You have to remember, when you invest, you're not just backing an idea. You are backing the actual human beings who have to turn that idea into a reality.
This slide says it all, really. There's a reason the smartest investors in the world, venture capitalists, live by this rule. A brilliant idea with a weak team, it's probably going to fail. But a great team can take even a mediocre idea and turn it into a huge success. The team is everything.
So what's on our investigators' checklist when we look at the team? Well, here are the questions you need to be asking. First, do they have relevant experience? Can you actually find them online and verify who they say they are on places like LinkedIn? And this is a big one. Look at the team's balance. Is it developer-heavy? For a project that claims to be building cutting-edge tech, it absolutely should be.
And this chart right here gives you a great visual for what a healthy, tech-focused team should look like. As you can see, the scale is tipped heavily towards development. Now, don't get me wrong, marketing is important, business is important. But if the team is mostly marketers and not enough builders, that is a huge red flag.
Okay, so we've covered what to look for. Now let's flip that around and talk about what to run from. These are the critical red flags, the warning signs that as an investigator you absolutely cannot ignore.
Red flag number 1, the all-marketing team. I mean, if you go to the team page and it's just full of gurus and visionaries, but you can only find 1, maybe 2 lonely developers, you should be very, very skeptical. As the source material so perfectly puts it, this space doesn't need more shills, it needs builders. Next up, and this one is a classic, fake credentials. It is shockingly easy for someone to just invent a work history. The lesson here is so simple. Always verify. Just take 5 minutes. Check their LinkedIn. Look for their GitHub profile. Does their story actually hold up?
And the final, critical red flag, the anonymous team. Now look, I know what you're thinking, but what about Satoshi? And you're right, but Satoshi was a 1 in a billion exception. Today, an anonymous team means zero accountability. It is the classic setup for an exit scam, where the founders can just vanish with everyone's money and there's nothing you can do about it.
Okay, so let's take all of these pieces and put them together. Let's pack up your new investigator's toolkit.
You know, when it comes right down to it, it all boils down to these 2 pillars. It's that simple. First, follow the code. Check the project's heartbeat on GitHub. And second, investigate the team. Are they real? Are they qualified? And are they actually focused on building?
And by following this process, you have officially leveled up. You're not just chasing hype anymore. You're not just speculating. You now have a real framework for genuine due diligence, and that's going to allow you to make much smarter, more informed decisions.
But remember, the investigation, it never truly ends. You've confirmed the how and you've confirmed the who, but that just leads to the biggest question of all, the why. Are they building something that people will actually want to use? Now that is the billion-dollar question and the key to your next investigation.
All right, let's dive right in. Today, we're getting into the world of altcoin research, and we're starting with a document that, honestly, most investors just skip right over, the white paper. We're going to give you the tools you need to analyze any project like a seasoned detective. But let's look at this a different way. Reading a white paper isn't some boring homework assignment. It's your first step as a crypto detective. You're on the hunt for clues, and this quote points to our first big red flag. A document that's all marketing fluff and buzzwords with no real meat on the bones? That's a huge warning sign to just walk away. So, here's our game plan. We're going to break this whole investigation down into 5 key stages, from cracking open the paper itself to following the clues it leaves behind. This whole process is designed to help you uncover the real story behind any project. Okay, let's get into it. And look, you don't need to be some kind of crypto genius or study every single word. To get a real feel for a project's potential, you just need to focus your investigation on 6 key areas. Think of these 6 points as the essential tools in your detective's toolkit. They're designed to help you systematically go through the evidence in any white paper. And we're going to start our investigation right where every project begins, with the core technology. First things first, we have to examine the core evidence, the fundamental tech that everything else is built on. This is the project's foundation, and trust me, any cracks you find here can bring the whole thing tumbling down. Our first clue is the consensus method. This is basically the engine of the blockchain, and it tells us a ton about how the network stays secure and whether it's actually built for speed and efficiency. The consensus method really is the heart of the machine. It's the rule book that decides how new transactions get approved, and that one single choice dictates all the core trade-offs the network has to make between speed, security, and decentralization. So here's the big question you have to ask yourself. Did they actually innovate here? Is their method a real improvement on what's already out there? Or did they just copy and paste a standard off-the-shelf solution? The answer tells you a lot about how ambitious this project really is. Okay, our next clue is the project's architectural plan, the technology stack. This gives us a bird's-eye view of how the entire network is put together. This is the project's blueprint. So, are we looking at a simple little shed, or are we talking about a skyscraper with multiple floors? A deep, multi-layered stack is a sign of ambition, and it gives other developers a foundation to build new apps on top of it. Our third clue is all about playing nice with others. In the super connected world of crypto, a project's ability to talk to other blockchains is absolutely critical for its success. In today's crypto world, this is a huge deal. A project that can't connect with other ecosystems is like it's on an isolated island. It's totally cut off from all the money and users on the bigger networks. You want to look for a clear plan for how they're going to build bridges to those other islands. Okay, so we've checked the foundation. Now let's start looking for clues that tell us if this project can actually survive and thrive for the long haul. This is where we separate the projects that are just a flash in the pan from the ones that are built to last. And this next one, it's a huge factor: scalability. If a network can't handle a growing number of users and transactions, it's eventually just going to hit a wall. It'll get slow and expensive. And we've seen this exact problem happen to some of the biggest blockchains out there. So your job is to find their plan. Does their consensus method even allow for growth? Do they talk about specific solutions, things like layer 2s or sharding to handle more demand in the future? If their plan for scaling is vague or just doesn't exist, that's a major red flag. Now, this might seem super obvious, but you would be shocked at how many projects completely fail on this point. Having brilliant technology without a real purpose is like having a key without a lock. It has to solve a real-world problem for actual people to have any kind of value. This sounds like a joke, right? But a project like this actually existed, and it is the perfect example of what to look out for. You have to ask yourself, does this use case make any sense at all, or is it just a weird idea wrapped up in a bunch of crypto buzzwords? This right here just perfectly captures the issue. There is a world of difference between a theoretical use case and one that actually has demand in the real world. Remember, a technology that's just looking for a problem to solve is rarely a good bet. The final piece of evidence we're looking for inside the white paper is a roadmap. It's one thing to have a big, grand vision. It is a completely different thing to have a believable plan to actually make it happen. A good roadmap has clearly defined goals and timelines, kind of like the one you see here. This makes it possible for you, the investigator, to actually measure their performance. But, and this is super important, always check their website for the most up-to-date version, because the one in the white paper could be really old. you have to be really wary of projects that treat their roadmap like a list of suggestions. Look, delays happen in tech. I get it. But a consistent pattern of missed milestones is a huge warning sign. I mean, no joke, there are projects from the 2017 bull run that still haven't released a working product. And this brings us to a really vital point. The white paper is just the start of your investigation. It's just a snapshot in time. To get the real story, you have to follow the trail beyond the paper itself. To get the full story, you have to follow that trail. Check these channels to see what the team has actually been doing since they published the paper. Is the GitHub active? Are there blogs and social media giving you real updates? This is where you find out if they're actually working or just all talk. Because ultimately, this is the one question your entire investigation has to answer. By using this toolkit, you can look past all the hype, you can analyze the actual evidence, and you can empower yourself to find real, sustainable value in what is a very, very noisy market. All right, let's talk about finding that next 100x altcoin. Today, we're going to forget the price charts for just a second. We are diving into a really powerful and honestly an often overlooked research method, the community vibe check. Seriously, this technique might just be the thing that helps you spot the next big project before everyone else piles in. So let me start with a question for you. When you're sizing up a new crypto project, you check all the usual stuff, right? The tech, the tokenomics, the team. But what if a project's single most powerful asset isn't even mentioned in the white paper or hidden in the code at all? Well, that hidden asset, it's the community. We're about to break down exactly how the dedication and, the character of a project's community can show you its true long-term potential. Yeah, you really have to think of a project's community as more than just a bunch of fans. It's like a living, breathing indicator of its overall health. It tells you everything about the project's staying power and its real shot at adoption in a way that a white paper can only ever promise. Okay, so where do you even start when you're trying to size up a community? Well, the first and definitely the easiest step is to just take a quick look at the numbers. This is going to give you a baseline before we get into the really interesting stuff. It's a pretty simple two-step process. First, just head over to a site like CoinGecko. You can get a quick look at follower counts and get a general sense of how active they are. Then, if you want a bit more detail, go straight to the source, the project's official website, and see if they have a section with their own social stats. But here's the thing. For those newer or smaller projects, the numbers, well, they might not tell you the whole story. The data can be pretty thin. And that's our cue to go beyond the surface and really start to understand the quality of the community, not just the quantity. And this right here, this brings us to the real heart of this whole method, the community vibe check. This is way less about spreadsheets and a lot more about, being a fly on the wall. You're going to jump into their Discord servers, their Telegram groups, and just read the room. So as you're lurking in these groups, you got to keep these questions in your head. Are people having actual thoughtful discussions, or is it just a wall of when, moon, and price talk? Are they genuinely pumped about the technology? And this one is huge. How do they treat newcomers? Are they helpful, welcoming, or are they just hostile? These are the little signs that tell you everything. Now, all these little observations you're making can basically be sorted into two simple categories. Green flags, which signal a healthy project, and red flags, which, well, they signal danger ahead. It's like the ultimate litmus test for a community's health. This slide just lays it out so perfectly. On one side, you have all the green flags, thoughtful discussion, a helpful and welcoming vibe. And on the other side, you've got the big red flags, just endless memes, personal attacks, and that knee-jerk refusal to engage with any tough questions. The real skill is learning to spot which side a community is actually on. This quote from our source material absolutely hits the nail on the head. If every single critical question is immediately shut down with people screaming FUD, fear, uncertainty, and doubt, that is a massive red flag. It shows you that it's a community that can't handle a real discussion, and that should definitely give you pause. So why does all of this actually matter? What's the point? It's because a strong community isn't just some nice-to-have thing. It creates real, tangible advantages that directly fuel a project's success. This is where the real payoff for all your research is. A passionate, engaged community gives a project something we call staying power. These are the people who are in it for the long haul. They're not just speculators looking to make a quick buck. They are true believers, genuinely invested in seeing the project succeed and actually get adopted in the real world. And that passion, it translates directly into one of the most valuable things any project can have: free marketing. I mean, think about it. When a community truly believes in the vision, its members willingly spend their own time and energy educating others, sharing news, and spreading the word. You literally cannot buy that kind of authentic support. So, at the end of the day, screening communities is just an incredibly efficient way to do your research. In a market with thousands and thousands of projects all fighting for your attention, your time is your most valuable asset. This method helps you cut through all that noise and quickly zero in on the projects that have a real, solid foundation of human support. So, the next time you're looking at a potential investment, after you've checked the charts, after you've read the white paper, go check the vibe and ask yourself this one critical question. Is this community actually building the future, or are they just building hype? The answer to that, well, it might just tell you everything you need to know.
Hey everyone, we're all looking for that extra edge in the markets, right? That little bit of insight that no one else has. Well, today we're going to talk about a powerful and honestly, an often overlooked place to find it: the Bitcoin options market. I'm going to show you how you can use it to get a really unique read on where Bitcoin's price might be headed using signals the market literally gives away for free. Let's get into it.
You know, this quote really nails what we're talking about today. You don't always need some exclusive, super expensive report. We're going to give you the tools to decode what the market is already telling you, right out in the open, so you can be 2 steps ahead of the game.
So, first things first, why is the options market this hidden edge? Well, think of it less like a complicated trading venue and more like a real-time window into the mind of the market. It's where you can see the collective hopes, the fears, and the big bets being placed, and we can learn to read those bets.
I mean, we've all been there, right? You're hunting for some solid market intelligence, and you just keep hitting paywalls or finding stuff that's only for the big institutions. The solution we're looking at today is totally different. It's right there, it's accessible, and by the end of this, you'll know exactly how to start reading it for yourself.
Okay, but before we can start decoding any of these secret signals, we got to get the fundamentals down. So let's do a quick, super simple overview of what options even are. Don't worry, we're keeping it simple, just the absolute basics.
So the most important phrase here is right, not obligation. Think about it like putting a deposit down on something you want to buy. You secure the option to buy it later at today's price, but you don't have to go through with it. That flexibility, that choice, that's the whole idea behind an option.
And options really boil down to 2 basic types. A call option gives you the right to buy Bitcoin at a set price. You'd want this if you're bullish, if you think the price is going up. A put option gives you the right to sell it, and you'd want that if you're bearish, if you think the price is going down. It's that simple. Call for up, put for down. Now, of course, that choice, that powerful flexibility, it isn't free. The price you pay for that right is called the premium. And really, understanding what makes this premium go up or down is the key to unlocking everything we're going to talk about next.
All right, now that we know about the premium, let's break down what actually drives that price. And the single biggest factor is a concept called moneyness. It might sound a little technical, but I promise you, the idea behind it is incredibly simple. So what do you think it is? What's the number one thing that determines that premium we just mentioned? Is it how much time is left? Is it how volatile the market is? Well, before any of that, it all starts with one very simple relationship.
And the answer is moneyness. It's just a fancy word for a simple comparison. It's all about the relationship between Bitcoin's current price on the market, we'll call that the spot price, and the option's preset price, which is called the strike price. Basically, moneyness just asks, is this option already profitable, at least on paper?
This table breaks it all down perfectly. Let's go through it together. First, let's look at a call option, which is your right to buy. If the current spot price, let's call it S, is higher than your preset strike price, K, then your option is in the money. It's already in a profitable position. If S is below K, it's out of the money. Simple enough. Now for a put option, your right to sell. It's just the opposite. You're in the money if the spot price is below your strike price, because that means you can sell for more than it's worth. And at the money? Well, that's the easiest one of all. It's when the 2 prices are pretty much the same.
Okay, so we've got moneyness down. That's the foundation. But it's not the whole story. There are a few other key factors that have a huge influence on an options price. Let's take a look at the most important ones.
We're going to focus on the 3 heavy hitters here. First, there's delta, which is all about sensitivity. Then you have implied volatility, which is about the market's expectation. And finally, time, which is all about potential. Get these 3 and you'll really start to see the bigger picture.
So first up is delta. The easiest way to think about delta is as a responsiveness score. It basically tells you, hey, if Bitcoin's price moves by $1, how much will my options premium change? A high delta means it's super sensitive to price changes.
And here is where it all comes full circle. An option that is deep in the money is going to have a really high delta. It starts to move almost exactly like Bitcoin itself. On the flip side, an option that's way out of the money will have a tiny delta. It barely reacts to small price changes. See how moneyness sets the stage for everything else?
Next, we have implied volatility. I like to think of this as the market's fear and greed gauge. It's the market's collective bet on how wild the price swings are going to be in the future. So if everyone is expecting a ton of chaos and big moves, then the flexibility that an option gives you becomes way more valuable. And when it's more valuable, the premium goes up.
And last but not least, we have time. This one is pretty intuitive. The more time an option has before it expires, the more chances there are for Bitcoin's price to move in your favor. More time simply equals more potential for a big win. And that extra potential, well, it costs more, which drives up the premium.
All right, so we've just built our basic toolkit. We understand calls and puts, we get moneyness, and we have a handle on delta, volatility, and time. So now, how do we combine all this to give ourselves a completely new lens for looking at the market? Let's put it all together.
Okay, this is the real takeaway. You're not just looking at the price anymore. Now you can look at the options market and see something deeper. For instance, what if you see a massive spike in people buying cheap out-of-the-money call options, and the implied volatility on them is soaring? What's that telling you? It's a huge signal that traders are betting on a massive, unexpected price surge. They're placing low-cost bets on a lottery ticket. See? You're reading the expectation of where the price might be going. That's the edge.
And that really brings us to the end. You now have the foundational tools to look at the market in a totally new way. So the next time you're checking prices, don't just ask, what's the price? Ask, what's the implied volatility telling me? Where are people placing their out-of-the-money bets? The signals are right there, waiting for you. And now you have the framework to start reading them, and maybe stay 2 steps ahead.
Have you ever just wished you could, read the market's mind? Find out what everyone is really thinking? Well, today we're diving into a tool that gets pretty darn close, the put-call ratio. Let's break down how it actually works.
I mean, seriously, think about it. The market is just this huge collection of millions of people, right? All with their own opinions, their own hopes, their own fears. So how on earth could you possibly get a read on the collective feeling? Is everybody feeling optimistic, or is fear starting to creep in?
Okay, but what if I told you that you can boil all that emotion and complexity down to just one single number? A single figure that gives you a snapshot of the mood. That's exactly what we're going to unpack.
All right, let's get into it. What exactly is this market mood ring? How does the put-call ratio actually work?
So, at its most basic level, the put-call ratio is, well, it's pretty much exactly what it sounds like. It's a straightforward comparison. It just takes all the bearish bets, that's the puts, and stacks them up against all the bullish bets, the calls. It's designed to give us a quick snapshot of the overall market feeling.
Okay, so to really get this ratio, you've got to understand the 2 building blocks. First, you have puts. A put is basically a bet that a stock or an index is going to go down. It's a bearish bet. Then you have calls, and a call is, you guessed it, the exact opposite. It's a bet that the price is going to go up. So puts are bearish, calls are bullish. Simple as that.
Right, so how do we actually count all these bets? Well, there are 2 main ways to do it. You can look at volume, which tells you how many contracts were traded, say, in a single day. But a lot of people think a much better, more reliable indicator is open interest. See, open interest is the total number of contracts that are still open, that are still active. It gives you a much clearer picture of how traders are positioned for the long haul, instead of just the day-to-day noise.
All right, so now we know what it is and how it's calculated, but what do we do with the number? How do we decode it to figure out if the market's feeling bullish or bearish?
Okay, here's the absolute key to reading the signs. It's actually a really simple rule of thumb. If the ratio is greater than 1, so 1.1, 1.2, whatever, it means there are more puts than calls. In other words, more bearish bets than bullish ones. That's a classic sign of bearish sentiment. And on the flip side, if the ratio is less than 1, it means calls are in the majority, signaling a more bullish feeling in the market.
So that's all the theory, right? But what does this look like in the real world? Let's grab an actual number and see what it tells us.
Okay, let's just pull a number out of thin air. Let's say the put-call ratio is sitting at 1.36. Now, based on the rule we just talked about, that's clearly above 1, so it's pointing to bearish sentiment. But what does 1.36 really mean?
Well, a ratio of 1.36 is telling you that for every single bullish call option out there, there are 1.36 bearish put options. Let me say that another way. The number of bets that the market is going to fall is a full 36% higher than the number of bets that it's going to rise. So yeah, the scale is definitely tipped toward a more cautious, maybe even fearful outlook.
So why do we even care about this? Well, it matters because it's like getting a little peek behind the curtain. It shows us how options traders, a really active and influential part of the market, are positioning themselves for the future. It's a clue about which way they think things are headed.
But hang on, because this next part is maybe the most important insight of all. The real power of this tool isn't looking at the number on just one random Tuesday. No, the real value, the secret sauce, is in watching how it moves over time, watching the trend.
Yeah, you really shouldn't get fixated on the absolute number itself. What you should be watching is how it moves. That's the key takeaway. It's not about today's number, it's about the direction it's heading. Is sentiment getting more fearful by the day, or is optimism slowly starting to return? That's the real question. So, practically speaking, what you want to do is track this thing over time. So, let's say you see the ratio creeping up. It goes from, 1.1 to 1.2, and then to 1.3. That's a clear signal that the mood is getting more and more bearish. And if you see it start to fall, well, that tells you the opposite. The mood is getting more bullish. It's all about the change, not the one-time snapshot. Okay, so we've covered a lot. We know what the ratio is, how to read it, and, most importantly, how to actually use it. But listen, like any tool, it's not perfect. It's got one pretty big blind spot we need to talk about. Just to recap real quick, the put-call ratio is fantastic for giving us that big picture overview of market positioning. It's a simple head count, right? It tells us the balance of power between the bulls and the bears. But here is the catch, and it's a big one. The ratio only tells us about the quantity of the bets. It just counts the number of puts and calls. It treats a tiny $100 bet exactly the same as a $1 million one. It tells us nothing, absolutely nothing about the conviction or the sheer amount of money behind those positions.
And that leaves us with a really fascinating question to chew on, doesn't it? If the put-call ratio is all about the number of bets, how do we get a sense of the pricing, of the real conviction behind them? What other tools could show us not just how many bets there are, but how much money is actually on the line? Well, that sounds like a great topic for another time.
Hey everyone, today we're going to pull back the curtain on a really cool tool that lets you see past all the noise and get a real read on the market's mood. It's called option skew, and honestly, it's kind of like a sentiment gauge that's been hiding in plain sight this whole time. I mean, think about it. We are just constantly bombarded with headlines and opinions telling us where the market is headed. But how do you actually measure something like fear or greed? How can you tell, with data, if the big money is feeling nervous or getting really confident? Well, that's exactly the problem we're going to solve. And it turns out the answer is right there in the options market. Yeah, by just looking at what traders are willing to pay for different kinds of bets, we can get this amazingly clear picture of whether the overall vibe is bullish or bearish. So it all boils down to two basic kinds of options. On one hand, you have a put. A put is basically a bet that the price is going to fall, so it's a bearish bet. And on the other side, you've got a call, which is, you guessed it, a bet that the price is going to rise. That's your bullish bet. Super simple, right? Bears buy puts and bulls buy calls.
Okay, so how do we actually use this? Well, that's where our star player comes in, option skew. The best way to think about it is like one of those mood rings from back in the day. You know, it changes color based on the collective feeling of everyone in the market. So what is it, really? Simply put, option skew is just a measure of demand. It's looking at the price tags on bearish puts versus bullish calls and comparing them.
And when one gets more expensive than the other, man, it tells you a crystal clear story about what the market is thinking.
Now, you're going to see a formula like this, and I know it might look a little intense at first glance, but don't let the symbols freak you out. All this is really doing is comparing something called implied volatility for puts and calls. And for what we're doing today, just think of implied volatility as a fancy Wall Street term for the price of the option. That's it. We're just seeing which one costs more.
And this quote just nails it. At the end of the day, we are just asking a very simple question. How much more are people willing to pay for insurance to the downside, those are the puts, versus how much they're willing to pay to bet on the upside, those are the calls? The answer tells you everything about where the fear and greed is.
So here's the cheat sheet on how to read it. If the skew number is positive, it means puts are more expensive. That signals a fearful, bearish market. People are paying up for protection. But if the skew is negative, that means calls are more expensive, signaling a confident, bullish market. Now, I know that might feel a little backwards at first, but just burn this into your brain. Positive skew is bearish, negative skew is bullish.
All right, that's enough theory. Let's get our hands dirty and look at a real-world chart. We're going to see how this actually works for analyzing something like Bitcoin.
Okay, so what we're looking at here is the 25 delta skew for Bitcoin. Don't worry about 25 delta, it's just a technical term for the specific options traders use to measure this. You can see a few different lines for different time frames, but let's just zoom in on that red line. That's the 3-month skew.
And if you look all the way to the right of that red line, you'll see the current value is negative 8.3%. So what's that telling us? Well, remember our rule? A negative number means call options are more expensive than put options. In this specific case, they're about 8.3% more expensive. This is a dead giveaway signal of bullishness from options traders.
But here's where it gets really powerful. It's not just about that one number, it's about the trend. See how that red line has been trending lower and lower, getting more negative over the past few months? That tells us that bullish sentiment hasn't just been present, it's actually been increasing. And if you were to lay a Bitcoin price chart over this, you'd see this growing optimism has lined up really nicely with the actual price action.
So you can start to see how this becomes this incredibly useful real-time sentiment gauge. But you should also know that this is really just scratching the surface of a much bigger world that professional traders use to look at the markets.
Yeah, this whole idea of skew is actually just one piece of a bigger puzzle. Traders will look at implied volatility, remember the price, across dozens of different options, and when they plot it all out, it creates a pattern that they call a volatility smile or sometimes a smirk. It's a whole other rabbit hole, but a super interesting one for another day.
But for today, if you remember just one thing, let it be this. Forget the crazy headlines. Forget the loud opinions on TV. Option skew gives you a direct, data-driven window into what the market is actually thinking based on where people are willing to put their hard-earned money.
So there you have it. You now have the tool. You know how to look at this indicator and interpret what it's saying. So the only real question left is, the next time you look at the market, what is the skew telling you?
If you're into crypto, you have definitely seen the wild price predictions all over the place. It can feel almost impossible to tell what's real and what's just, well, hype. So we're going to dig into a way to cut through all that noise and see what the market actually thinks might happen. I mean, come on. We've all seen headlines like this, right? We're so used to these absolutely massive price predictions that they almost start to sound normal. And you know, that's the real danger. These extreme claims can totally warp our expectations without us even realizing it. So that brings us to the big question. How do we actually get past all the hype? Is there a way to figure out where the price might realistically be heading using, actual data instead of just trusting some random influencer on social media? Well, you might be surprised to hear this, but the answer is kind of hidden in plain sight, in the options market. This is where professional traders are constantly making bets on future prices. They're buying contracts that give them the option to buy or sell down the road at a price they agree on today. It's all about calculated risk. And this right here is the key difference. On one side, you've got all the public hype, just a ton of noise on social media and TV. But on the other side, you have what the market is actually doing. When big players, institutional funds, put real money on the line to buy options, well, that's a much more honest signal of what they truly believe than anything they might say in an interview. So, how in the world do we get from the price of an option to an actual price prediction? Well, it turns out we can do this thanks to a pretty powerful idea from statistics. But don't worry, you absolutely do not need a math degree to get the core concept here. It's called a probability density function, which I know sounds super complicated, but really it's just a fancy term for a chart that shows which outcomes are more likely than others. Honestly, just think of it like a weather forecast that shows a 70% chance of sun and a 10% chance of rain, but for prices. And this visualizes it perfectly. Using a famous formula called the Black Skulls model, which the source material hilariously calls the Black Skulls model, you can take market data and work backward to create a price distribution like this. As you can see, the outcomes in the middle of the curve, under the hump, are seen as way more likely than the extreme outcomes way out on the tails. Now, here's the best part. You don't have to dust off your old graphing calculator or do any of this math yourself. There are actually tools out there that crunch all this complex data and make it super easy to understand. Okay, so let's check out a real-world example from skew.com to see how this works in practice. Along the bottom, you have the Bitcoin price. On the side, you have the probability. And each of these colored lines represents a different expiration date in the future. Let's just pick one to see what it can tell us. All right, let's look at that green line from this historical chart, which was for December 2020. If you follow it, you can see that at the time, the options market was pricing in about a 28% chance of Bitcoin being above $22,000 by that date. But watch what happens as we move further to the right to $24,000. The probability drops all the way down to 19%. And that makes perfect sense, right? The higher the price target, the less likely the market thinks it is to actually hit that target in a specific time frame. Okay, so we can read the chart, that's cool, but what's the real takeaway here? How can you actually use this information? So here's the bottom line. This thing is not a crystal ball, but it is an incredibly powerful reality check. It helps you ground your expectations and see what the pros are really thinking with their own money. So, if someone's on TV screaming that a coin is going to 10x by next month, you can pull up this data and see that the market might only be pricing in, say, a 2% chance of that. It's just a really, really useful piece of the puzzle to add to your own analysis. And that brings us to this really important warning, which is actually a direct quote from the source material. This is not a Bible, it's not a guarantee, it's just one measure of probability that's been pulled directly from market data. So think of it as one powerful tool in your toolbox, but not the only tool. So now you have a new way to look at the market, a way to get a clearer picture that's free from all that hype. It's almost like getting a sneak peek at what the smartest money in the room is thinking. The only question left is, what is it telling you today?
Hey everyone, have you ever been staring at the charts and suddenly the crypto market just lurches? I mean, a big move up or down that seems to come out of nowhere? Well, a lot of the time, the answer isn't random at all. Today, we're going to pull back the curtain on one of the biggest drivers of that volatility, options expiry dates. Let's dive right in.
Right? It's the question that's on every single trader's mind. You're watching everything, it all seems pretty calm, and then bam, a huge sharp move. It can feel totally out of the blue, but sometimes there's this predictable force working just under the surface, and it's all tied to specific dates on the calendar.
And this is your big clue. When you're scrolling through Twitter or in a trading group and you hear people talking about a major options expiry coming up, this quote right here, that's your signal. It's a heads up that a whole bunch of contracts are about to close out, and that forces traders to make some big moves.
All right, so let's get into the nitty-gritty and actually put a name to what we're talking about here. People call it the expiry date anomaly. And this isn't some weird crypto-only thing. No, it's a known market phenomenon that's been around in traditional finance forever, and now it's making a huge impact on assets like Bitcoin. So here's the bottom line. Around these expiry dates, you're going to see a lot more volatility in the spot price. And the key thing is, for people who are watching, this isn't a surprise. It's a regular event, all tied to these options contracts, which are really just bets on a future price, right? And what's super interesting is that you often start to feel the effects like 2 days before the actual expiry date. That's when traders start getting their ducks in a row.
Okay, so we know when it happens, but now for the big question, why? What is actually going on behind the scenes that makes the price swing so much when these options expire? Well, it really just boils down to two main things. And this slide, this gets right to the heart of it. It all comes down to connecting the options world with the regular spot market, where you actually buy and sell crypto for immediate delivery. So on one hand, you've got traders who literally need to buy or sell the actual crypto to settle up their expiring contracts. Then on the other hand, you have the big guys, the market makers. They're constantly buying and selling to hedge, basically to balance out their own risk as these options expire. See, both of those actions create real, tangible buying and selling pressure.
And this is the single most important thing to remember. What happens in the options market directly impacts the spot market. It's a straight-up cause and effect relationship. Now, if only a few options are expiring, the impact is tiny. You probably won't even notice it. But when there's a huge amount of open interest, we're talking a massive number of outstanding contracts, the effect on the spot price can be absolutely enormous.
Okay, so knowing this is all happening is one thing. That's great. But can we actually get a sense of which way the market might be leaning? I mean, can we get a hint of where the pressure is building? The answer is, yeah, kinda. With a little bit of digging, we can get a pretty decent idea.
So, which way is the price going to move? I mean, that's the million-dollar question, isn't it? And look, while nobody has a crystal ball, what we can do is look at the data to see how the market is positioned. Are more traders betting on the price to go up, or are they betting on it to go down?
And this slide lays out a super simple but really effective 3-step game plan. First, you head over to a major options exchange like Deribit and take a look at the order book. Second, you narrow your focus. You only want to look at the options that are close to the money. That just means their target price is pretty close to the current market price. And third, you just compare the total open interest for calls, those are bets the price will go up, versus puts, which are bets the price will go down. It's basically just a simple tally of the bullish versus bearish bets out there.
Theory is great and all, but let's make this totally real. We're going to walk through this exact analysis step by step using actual data for a Bitcoin expiry on December 21st, looking at the books on the Deribit exchange.
Okay, so here's the data we pulled. For this specific expiry date, the total open interest for call options, remember, those are the bullish bets, was about 4,200 Bitcoin. At the same time, the total for put options, the bearish bets, was around 1,770 Bitcoin. I mean, you don't need to be a math genius to see which way the sentiment is leaning here, right?
In fact, when you run the numbers, there are almost 2.4 times more call positions than put positions. Now, what does that tell us? Well, theoretically, it suggests that as we get closer to this expiry, the market is positioned more bullishly. There's potentially a lot more buying pressure ready to hit the spot market than selling pressure.
Okay, now hold on. This is incredibly important. Before you run off and start placing trades based on that 2.4x number, we have to talk about the limitations. This analysis is a tool, a really useful one, but it is not a crystal ball.
You got to remember 3 things. First, this data is always changing, so an analysis you do a week out might look totally different a day or two before expiry. You have to recheck it. Second, this is not a perfect science. It's an indicator of sentiment, a clue. It is not a guarantee. And third, and this is a big one, there are other massive forces at play. You've got the futures market, you've got huge whale orders. Any of those can easily overpower the pressure from options.
So, the big takeaway here is this. Use this analysis to prepare for volatility, not to predict the price. The goal isn't to be a fortune teller. It's to be aware that a big move could be on the way, so you can manage your risk and not get caught off guard.
And this quote just sums it up perfectly. Honestly, there's nothing worse than getting caught completely flat-footed by a huge price gap, whether it's up or down. By simply having these dates on your calendar and understanding what might happen, you're already way ahead of the curve. You're prepared, not surprised.
So now you know the signs. The next time you see a major options expiry coming up on the calendar, you'll know exactly what to look for. You've got the framework to check the data, gauge the market's positioning, and get ready for the potential fireworks. The only question left is, what story will the numbers tell you next time?
Today, we're going to learn how to read a story. Not from a book, but one that the market itself is telling us every single day. It's a story of conflict, of turning tides, and ultimately of hope, all told through something called bullish candlestick patterns.
So, how can a bunch of little bars on a chart possibly tell such a dramatic story? How can they show us hope when a market is falling? That's what we're digging into today. We're going to see how these patterns can signal the exact moment when the sellers start losing their grip and the buyers begin to take over.
But you know, before we can read the story, we have to learn the language. Every story is made of words, right? Well, in our market story, the words are these things we call candlesticks. So let's break them down.
Just think of one single candlestick as a snapshot of one day in the market. It's a quick, super visual summary of that constant tug of war between the buyers, who are trying to push the price up, and the sellers, who are trying to push it down.
Okay, so every candlestick is packed with clues. First, you've got the thick part, the body. That tells you the main event, where the price opened and where it closed. Then you have those thin little lines, the wicks. They show you the extremes of the battle, the absolute highest and lowest prices of the day. And the color? Well, that's the scoreboard. Green means the buyers won, and red means the sellers took the day. Simple as that.
All right, Act 1 of our story begins. This is where we look for those first, subtle hints that the sellers, who have been totally in control, are starting to get a little tired. Now, it's really important to remember these are clues, not guarantees. They're just signals that something might be changing.
And here comes our first hero, the hammer. You'll usually spot this at the bottom of a downtrend. It looks exactly like its name, and that's basically what it's trying to do. Hammer out a bottom for the price. The story this single candle tells is actually pretty powerful. See that long lower wick? That means that during the day, sellers tried to crush the price, pushing it way down. But then, the buyers stormed back in, said not today, and drove the price all the way back up. It's a classic comeback story all packed into a single day's trading.
Next up, we have its cousin, the inverse hammer. Yeah, it looks kind of upside down, but don't let that fool you. It tells a very similar story of bullish potential.
So the dynamic here is a little different. That long upper wick shows that the buyers were actually testing higher prices. And even though sellers fought back, they just didn't have enough juice to push the price all the way back down. This is a huge sign of seller exhaustion, and it suggests the buyers are getting ready to take charge.
So really, they're just two sides of the same coin. With the hammer, buyers are playing defense, rejecting lower prices. With the inverse hammer, sellers are on the attack, but they fail. Even though the mechanics look different, the message is the same. The momentum is shifting away from the sellers.
And that brings us to Act 2. This is where the plot thickens. The fight for control gets way more intense, spilling over into 2 full days. And this is where the buyer's comeback starts to look a lot more decisive.
Take a look at this, the bullish engulfing pattern. I mean, the name pretty much says it all. This is a really powerful 2-candle signal where the second day completely and totally overshadows the first.
This pattern tells the story of a dramatic power shift. On day 1, you've got a little red candle. Sellers are in control. But on day 2, it's like the buyers just kick the door down. They come in with so much force that the big green candle's body completely swallows or engulfs the previous day's red candle. It's a huge, obvious statement that the tide has turned.
Here's another strong 2-day player, the piercing line. This pattern also shows a really significant comeback by the buyers, but in a slightly different way.
The key here is the incredible comeback within the second day. So you start with a long red day, heavy selling. The next day opens even lower. It looks pretty bad. But then the buyers step in and drive the price all the way back up so that it closes well into the top half of the previous day's red candle. It literally pierces through the prior day's negativity, and that signals some serious buyer commitment.
And now for the climax of our story. These 3-day patterns, well, they offer some of the strongest confirmation you can find that a bullish takeover isn't just a possibility anymore. It's happening.
Meet the Morning Star. The name is just perfect because it's like a sign of hope after a long, dark downtrend. It's basically a classic 3-act play all by itself.
Let's break down this little play. Act 1, a long red day. Total seller dominance. Act 2, a tiny little candle, the star. This is the moment of indecision. The seller's momentum has just stalled out. And then, Act 3, a long, powerful green day, where the buyers confirm the reversal with force. Decline, pause, and then a powerful reversal.
And finally, we've got one of the most unambiguous signals you can find, the 3 white soldiers. There's nothing subtle about this one. It's a clear, steady march forward for the bulls. What this pattern is screaming at you is just overwhelming strength. There's no hesitation, no second guessing. It's just 3 long green candles in a row, with each one building on the success of the last. This isn't just a reversal anymore. This could be the start of a whole new sustained advance.
So we've learned the language and we've read a few of the market stories. What's the main takeaway from all this? It's that these patterns aren't just abstract shapes. They are literal narratives of human psychology playing out on a chart for everyone to see.
Ultimately, what these stories tell us is where that balance of power might be shifting. They signal where a downtrend is running out of steam and where buyers are stepping in to create a floor, a level of support. They're clues, not crystal balls, but man, are they powerful clues.
And all of this leaves us with one final big question to think about. If these charts are just visual representations of our collective human emotion,
our fear, our greed, our hope, then what does that tell us about our ability to find any kind of order in the chaos of the markets? Something to chew on.
All right, today we're going to put together a kind of field guide to bearish candlestick patterns. Now, these are the visual clues on a chart that can signal a pretty big shift in market sentiment. Think of them as a powerful tool for spotting when a market that's been climbing might just be about to turn around. Let's dive in.
So picture this. You're riding a fantastic upward trend, everything's looking great, but there's that nagging question in the back of your mind, right? When is this going to end? How can you possibly spot the very first signs that the tide is about to turn? Well, that's exactly the problem we're going to tackle.
So, here's the game plan. We'll start with the basics, what these patterns are actually telling us. Then we're going to build up our knowledge, starting with simple one-candle warnings, then moving on to two-candle reversals, and finally getting into the really detailed stories told by three-candle formations before we wrap it all up.
Okay, so before we dive into all the cool-looking patterns, let's get on the same page. What are we really talking about when we say bearish pattern?
So, what does that really mean in plain English? Think of them as warning flares on a chart. They usually pop up after prices have been going up for a while, and they suggest that all that optimism, all that buying pressure is starting to run out of steam. It's kind of like reading the market's body language, and it's telling you a change might be coming.
All right, let's ease into this. We're going to start with the simplest signals to spot, the patterns that are formed by just a single candlestick. These are often the very first whispers you'll hear of a potential reversal.
And here's our first one, the hanging man. Just look at that distinctive shape. You've got the small body way up at the top with a long lower wick, and it shows up right at the peak of an uptrend. That shape is everything. It tells the whole story.
So, what's the story this candle is telling us? Well, during that day, a huge sell-off happened. That's what creates that long shadow at the bottom. Now sure, the buyers managed to rally and push the price back up by the end of the day, but that massive sell-off is a major warning sign. It's like seeing a crack in the foundation. It tells you the bulls, the buyers, are starting to lose their grip on the market.
Okay, next up we've got one with a great name, the shooting star. You'll notice it's pretty much the inverse of the hanging man, a small body down to the bottom with a long wick pointing up. And the name is perfect, isn't it? It just suggests something falling from a great height.
The story here is all about a failed rally. The market tried to soar to a new high, and that's what creates that long upper wick. But then, wham, the sellers stepped in with so much force they pushed the price all the way back down. It's a classic sign that the upward momentum has just been exhausted.
Okay, so single candles give us a hint, right? A little whisper. But two candle patterns. Now we're getting some real confirmation. This is where the story on day 2 directly responds to what happened on day 1, giving us a much clearer picture.
And this first one is a real showstopper. It's called the bearish engulfing pattern, and the name pretty much says it all. You have a small green candle continuing the uptrend, but then the next day, boom, a massive red candle opens higher, then closes so much lower that it completely swallows the body of the candle from the day before.
The story here is a total power shift, and it's dramatic. Day 1 looks fine, just another day in the uptrend. But day 2 is a hostile takeover. The sellers didn't just stop the price from rising. They completely reversed all of the previous day's gains, and then kept going. It's a huge sign that control has changed hands, and the lower that red candle goes, the stronger that bearish signal becomes.
All right, our next two candle pattern is the dark cloud cover. It's a bit more subtle, but just as important. The key thing to watch is what happens with the opening and closing prices across the 2 days.
There's a great quote that describes this perfectly. A black cloud over the previous day's optimism. That just paints the picture, doesn't it? Day 1 is all sunshine and green candles, but day 2 casts this ominous shadow over everything. So here's the rule of thumb, the thing you have to look for. That red candle has to close below the midpoint, the halfway mark of the green candle before it. That's the signal. It shows that the bears didn't just reject the attempt to go higher, they managed to erase more than half of the previous day's gains. And if you see short wicks, that tells you the sellers were in charge pretty much the entire day.
Okay, we've seen one candle, we've seen two, now it's time for the big ones, 3 candle formations. This is where you get a much fuller story, a developing narrative that unfolds over 3 whole trading sessions, giving you an even stronger signal.
And first up is the evening star. I really like thinking of this one as a 3-act play.
Act 1, the uptrend continues. Act 2, we get some drama and indecision. And then Act 3, the big reversal. So let's walk through it. Day 1, you get a big, strong green candle. The bulls are confident, everything looks great. Day 2, you get this tiny little candle. It's like the market slammed on the brakes, nobody's quite sure what to do next. And then Day 3 is the clincher. A big red candle shows the sellers are now firmly in charge, often wiping out most of Day 1's gains. And now for a pattern that sounds exactly as bearish as it looks. The 3 black crows. I mean, just look at it. There's no mistaking this one. 3 long red candles marching steadily downward. It's pretty ominous.
What's really interesting here is that this pattern often isn't just a warning of a downtrend, it is the start of the downtrend. There is zero subtlety. For 3 days in a row, the sellers have just taken complete control, pushing the price lower and lower each day. It's a story of relentless, sustained selling pressure.
Whew, okay, so we've covered a lot of ground. 1, 2, and 3 candle patterns. Let's just pull back for a second and tie this all together, because there's a common thread running through every single one of them.
And really, this is what it all boils down to. It doesn't matter if it's 1 candle or 3, if it's a hanging man or an evening star. Every single one of these patterns is telling the exact same story. The balance of power is shifting. The bulls are running out of steam, and the bears are starting to take over.
And this table here is a fantastic cheat sheet. To kind of put it all in perspective, you can really see the progression. We move from a simple warning, like the bulls losing control with a hanging man, all the way to a full-blown confirmation, like the start of a bearish downtrend with the 3 black crows. Each one tells the same story, just with more and more conviction.
So at the end of the day, it's so important to remember that these aren't just random shapes on a screen. They're stories. They're little snapshots of the fight between buyers and sellers, a window into market psychology. And now you know how to read them. So the real question is, what story are you going to be looking for in the charts tomorrow?
You know that feeling, right? When you're staring at a trading chart, it feels like you're trying to read some kind of secret code. You see the prices moving up, or maybe down, but then, poof, they just stop. They start going sideways. And that, right there, is where the real challenge begins. And this leads us to the million-dollar question every single trader has to ask. Is this pause the beginning of a massive reversal that could wipe you out? Or is it just a temporary pit stop before the trend gets going again? Getting this wrong is, well, it's costly, but getting it right, that can be incredibly profitable. This is where something called a continuation pattern becomes like your best friend. These are the signals that help us answer that really critical question. Think of them as a decoder ring for what the market is thinking, telling us when it's just catching its breath. Okay, let's dive into this. So first up, we're going to look at the simplest signals that a trend is pausing. These are the patterns that show pure, raw indecision. Picture it like a momentary, perfectly balanced tug-of-war between the buyers and the sellers. So say hello to the doji. It's one of the most fundamental and, honestly, one of the easiest to spot candlesticks out there. Just looking at it, it screams neutrality. It's basically the market giving a big shrug. But how do you know for sure that's what you're looking at? Well, the rules for spotting a doji are actually pretty simple. The number one feature is that the open and close prices are pretty much the same. That's what creates that super thin, almost non-existent body. Then you've got the wicks, those lines sticking out the top and bottom. They can be long or short, doesn't matter. That tiny body, though, that is the dead giveaway. So what's the story this little shape is telling us? Well, during this trading period, both the buyers and the sellers were pushing the price all over the place. But by the end of it all, neither side could claim victory. It's a perfect stalemate. Now, a doji on its own is a neutral signal, but seeing one tells you loud and clear that the momentum has stalled out. All right, next up, we have the spinning top. And it looks a whole lot like a doji. It tells a really similar story of indecision, but there's one key little difference in how it looks. Unlike the doji's teeny tiny, almost not there body, the spinning top has a short but visible body. And this is crucial. It's centered between an upper and a lower wick that are pretty much equal in length. That symmetry is the defining feature you're looking for. The story here is a classic battle, The bulls, that's the buyers, they tried to push the price way up. But the bears, the sellers, they fought back hard and shoved it right back down. So in the end, the price closed near where it started, which just shows that nobody is in control. This is often seen as a period of consolidation. or just plain old rest. So let's put them side by side. The difference is crystal clear. Doji, almost no body, wicks can be any length. Spinning top, a short body with equal wicks. But here's the bottom line. They are both flashing the exact same signal. The market is undecided, and the current trend is simply taking a break. Okay, so we've covered the single candle signs of a pause. Now let's see how these little moments of indecision can actually build into more complex patterns, ones that tell a much richer story. This one is called the falling three methods. It's a 5-candle pattern that usually predicts that a downtrend is going to continue. Yeah, it looks complicated, I know, but it's actually a very logical little story playing out right there on your chart. Let's break that story down. First, you get a big red candle that shows the sellers are completely in control. Then you see 3 small green candles try to push the price back up, but look, they can't even get past where that first candle started. This is a super weak counterattack. And finally, a second big red candle shows up, totally wiping out that tiny rally and confirming the sellers are back in charge. So the takeaway here is simple, and it's powerful. When you spot this pattern, it's a really strong signal that the buyer's attempt to reverse the downtrend has totally failed. The pause is over, and that original downward trend is very likely to continue. Now, as you can probably guess, there's a bullish version of this exact same pattern. It's called the rising 3 methods. And yeah, it works in the exact opposite way. You can see they're perfect mirror images of each other. The rising 3 kicks off with a long green candle in an uptrend. Then it's followed by 3 little red candles showing a weak attempt by sellers to take over. But they fail, and a final long green candle pushes the price up to new highs, signaling that the uptrend is back on. It basically tells you that despite a little selling pressure, the buyers are still firmly in the driver's seat. So we've covered 4 key patterns that help you figure out when a trend is just pausing. But knowing what they are is one thing. Using them effectively, that's the whole other side of the coin. Here's a quick cheat sheet to pull it all together for you. The doji and the spinning top, those are your simple signals for pure indecision. The falling and rising 3 methods, those are your more complex story patterns, confirming that a bearish or bullish trend is ready to keep going after a short break. Okay, now before you run off and start trading based on these patterns, this is probably the most crucial part of this entire explainer, so please listen up. First, practice is everything. Seriously, use a test account to get good at spotting these without risking real money. And second, please remember that these patterns are clues. They are not crystal balls. They're powerful, for sure, but they should always be used with other analysis tools to confirm what you think you're seeing. Never, ever rely on just one signal. So the next time you see the market just go flat and sideways, don't just see a boring line. Now you know how to read the story that it's telling you. You can spot the indecision, you can identify those failed counterattacks, and you can get ready for the trend's next move. You've learned how to read the pause. So the only question left is, what are you going to do when the action resumes? Okay, so let's talk about the one thing everyone wants to know. What is the real secret to trading success? We're going to get into it in this explainer, but I'll give you a heads up right now, it's probably not what you think it is. Right, let's just jump straight into it. What do you think the secret is? Some magical top secret indicator? Maybe a super complex algorithm? Or, getting some kind of inside tip? Well, before we get to the answer, we kind of have to face a pretty tough truth. And here it is. This is the big, scary number you hear about all the time. Something like 90% of all traders end up losing money. That means only a tiny sliver, just 10%, are actually making consistent profits. So the real question isn't just what's the secret? It's what on earth are those 10% doing that the other 90% are not? To really get what makes someone successful, you've got to flip it on its head and look at why most people fail first. So let's break down the all too common path that traps almost everyone who tries to get into trading. And this journey probably looks pretty familiar, right? It almost always starts on social media. You see the fancy cars, the laptops on the beach, this idea of easy money. So, driven by that, you open up a brokerage account, throw some money in, and then you start clicking buttons, making random trades based on a hunch or something you read online. And the result? It's almost always the same. You blow up the account, and just like that, you've joined the 90% club. And that's the whole point, isn't it? The difference isn't luck. The traders who are consistently profitable aren't just giving lucky over and over again. No way. They have experience, they have a system that they've tested, and they have a rock-solid plan. Bottom line, they actually know what they're doing. Which, honestly, brings us to maybe the most important analogy you'll ever hear about trading. You really have to decide, are you going to be the pilot, in control of the plane, or are you just going to be a passenger, hoping for the best? I mean, just let this sink in for a second. Of course not, right? The answer is so obviously no, it's almost silly to ask. You wouldn't even think about it. So, why do so many people treat trading, another incredibly complex and high-stakes profession, like it's any different? Look at this. It just lays it all out, plain and simple. Becoming a pilot, becoming a surgeon, it takes years of dedicated study, tons of practice, and a clear, tested plan. Well, guess what? Becoming a profitable trader requires the exact same level of commitment. It's the same blueprint. There are no shortcuts. Let's be super clear about this. If you try to jump into the cockpit of a 747 without any training, you are going to crash. It's not a maybe, it's a certainty. And it's the exact same thing with your trading account. Trading without a real education pretty much guarantees one thing. You're going to blow it up. Okay, so we've established it. You need an education, you've got to treat this seriously. But now what? Where do you even begin to look for that education? And this is a question that comes up all the time. It's a huge debate. Do you have to shell out cash for some expensive course, or can you actually learn everything you need to know for free online? The truth is, both options have some real benefits and some serious downsides. All right, so let's actually look at the pros and cons here. With paid courses, you've got skin in the game, which, let's be honest, makes you take it more seriously. They're usually focused on one strategy and can offer great support. But they cost money, there are a lot of scams out there, and sometimes they're so focused on one thing they miss the bigger picture. Then you've got free education. The biggest pro? It's free, no financial risk. The downside is that it can be a total mess, and you have to do a ton of work just to figure out what's good information and what's total junk. So what's the answer? Well, the smartest approach isn't choosing one or the other. It's actually using a hybrid approach. You combine them to get the best of both worlds. So with that in mind, let's actually build a real step-by-step roadmap. This isn't just theory anymore. This is the professional's path that you can actually follow. Okay, this is it, the professional's journey. And the order here is everything. Step 1, start with all the free stuff you can find. Learn the absolute basics, charting, risk management, all that. Don't pay for what you can get for free. Step 2 is a gut check. After all that, are you still into this? What style seems to fit your personality? Then, and only then, do you move to step 3 and start researching paid courses that fit your goals. And seriously, do your homework here. If a course promises you'll be a millionaire next week, run. The most critical part, look at that last step. Only then, after you have a system and a plan, do you even think about trading with real money. That's a huge shift from how most people start, right? Okay, so we've looked at the trap the 90% fall into, and we've laid out the professional's path. Now it's time to come full circle and answer that big question from the beginning. What is the real secret to success? It's not some secret software. It's not a magic indicator you buy online. The real secret to success is... First up, and I know this isn't glamorous, it's just plain old hard work. If this were easy, that 90% number simply wouldn't exist. Everyone would be rich. Next, and we've been hammering this home, it's education. A real, deliberate, and continuous process of learning, just like any other serious career on the planet. And finally, this is the one you just can't skip. It's experience and practice. It's the screen time. It's the time you put in testing your ideas and sharpening your skills before you put your actual hard-earned money on the line. So let's boil this all down to a final checklist. These are the things you gotta remember. Treat this like a profession, not some hobby you do on the weekends. Never, ever stop learning. Don't fall for the shortcuts, like random treat alerts or some magic software that promises to do all the work for you. Just educate yourself and do it the right way. And that really leaves you with one last big question to ask yourself. So when you sit down at your screen, what are you really doing? Are you building a serious, sustainable career that could last a lifetime? Or are you just buying a lottery ticket and hoping you get lucky? Because the answer to that question changes everything. All right, welcome. Today, we are cracking open the market's crystal ball. It's this concept called implied volatility, and it's honestly the closest thing we have to a forecast for the financial weather, telling us if we should expect, calm seas or a full-blown storm ahead. But that begs a pretty big question. I mean, seriously, how does a huge decentralized market actually put a number on the unknown? How can it possibly measure the potential for these massive price swings before they even happen? It sounds impossible, right? But the answer is actually surprisingly elegant. So our journey into this really starts with something called an option. Now, don't worry, we're not going to do a super deep dive into options trading here, but we do need to get our heads around one really crucial thing about how they're priced. See, an options price isn't just some random number pulled out of thin air. No way. It is a very carefully calculated value that literally contains a prediction. It's like the market's collective wisdom, or maybe its collective fear, all bundled up into a single price tag. So, to decode that prediction, we first have to understand how that price is even cooked up. The best way to think about it is like a recipe with a few key ingredients. Okay, so this is a simplified look at the famous Black Skulls model, which is pretty much the go-to recipe for pricing an option. Now, the first few ingredients, super straightforward. The underlying price is just the current stock price. Easy. The strike price and the expiration date, they're written right on the contract. We can see all these things right now. They're knowns. But there is one ingredient in this recipe that's totally different from all the others. It's not a fact we can just look up. It's a guess about the future. And this right here, this is the core of the problem. On one side, you've got all these known facts we can see and measure right now. But on the other side, you've got future volatility, which is just a fancy way of saying how much is the price going to swing around between now and when the option expires. And that, well, that's a complete mystery. So if we're missing a key ingredient, how in the world can we have a final price? Well, this is where the market gets incredibly clever. It solves the whole problem by just flipping it on its head. So how do you do it? How do you put a number on the unknown? How do you quantify the market's collective hopes and fears and anxieties about what's coming next? The solution is as simple as it is genius. That's it. That is the secret sauce. Instead of trying to guess future volatility to come up with some theoretical price, the market takes the actual real-world price that people are paying for that option right now, and it works backwards. So we take that real market price, we plug in all the other ingredients that we do know, and we just solve for the one thing we're missing. The number that pops out of the equation is the level of volatility that must exist to justify that price. It is the volatility that is implied by the market. And that, my friends, is implied volatility. It's the market's consensus forecast, right there in a number. Now, this is absolutely crucial. We have to distinguish this future-looking guess from something else you might have heard of called historical volatility. They sound similar, but honestly, they are worlds apart. The best way to think about it is this. Historical volatility is like driving your car while only looking in the rearview mirror. It's a mathematical fact. It tells you exactly how much a stock's price has moved in the past. But implied volatility, that's looking out the front windshield. It's a prediction about how much the market thinks it's going to move in the future. And that forward-looking view is exactly why it's the one that directly affects an options price today. Okay, so what? We have this theoretical number that we basically reverse engineered from a price. Why is this so important? Well, because it's the language the market uses to talk about risk and uncertainty. This quote just nails it. When you hear on the news that traders are bracing for big moves, that's not just a hunch they have. It's a direct translation of the data. It means the price of options has gone up, which, as we now know, means the market is pricing in bigger future swings. So you can really think of it this way. A high implied volatility means the market is pricing in the potential for chaos, a lot of big moves. A low implied volatility, on the other hand, suggests the market is forecasting a period of calm. It's an incredibly powerful, real-time indicator of what the market is feeling. And that kind of brings us to our final thought here. Now that you know how to read the market's crystal ball, you can ask a powerful new question. When you look at implied volatility, you're not just seeing numbers, you're seeing the market's expectations for what's next. So what is it telling you today?
If you've ever traded options, you've definitely come across the term implied volatility, or IV for short. But what is it really? It's not just some Wall Street jargon, it's like the market's way of whispering its predictions about a stock's future. And today, we're going to learn how to actually listen in.
So, here's the million-dollar question, right? How does the market even begin to predict where a stock's price might end up? I mean, there's no crystal ball, no magic 8-ball, but there is a really powerful clue. And that clue, you guessed it,
is implied volatility.
Okay, so before we dive in and start crunching the numbers, let's just take a second to talk about why this matters. Why is IV such an essential tool for any trader? Because honestly, it's way more than just data. It's a strategic insight that can literally be the difference between a winning trade and a losing one.
So, why should you be paying attention to IV? Well, for starters, it's a huge piece of an options price. It's basically the market's consensus on how much a stock is going to move, whether that's up or down. This lets you compare what you think is going to happen to what the market thinks. And most importantly, it gives you a data-driven range for where that stock price could land.
All right, so how do we actually map out all these possibilities? It all starts with a classic concept from statistics, the normal distribution. You've probably seen it before. It's that famous bell curve.
So this curve, the bell curve, it's all about visualizing probability. The basic idea here is that small, everyday price changes are super common. That's the big hump in the middle. But those huge, dramatic price swings, they're much more rare. This leads us to something called the 68-95-99.7 rule. All that means is that about 68% of the time, the price movement should fall within a predictable range, which we call one standard deviation. But, and this is a really big but, we have to be honest here. This model isn't perfect, not by a long shot. In the real world, markets have what's called fat tails. It's a great term, right? It just means that those crazy out-of-nowhere price swings happen a lot more often than this neat little model would suggest. So think of the bell curve as a fantastic starting point, a great guide, but definitely not an unbreakable law of the universe.
Okay, enough theory. Let's put this into practice. We're going to walk through a calculation step by step to see exactly how implied volatility gets turned into one of those predictable price ranges.
And here it is, the formula. Now don't let it intimidate you. I promise it's way simpler than it looks. We're really just multiplying three things together: the implied volatility itself, the price of the stock, and then this little time factor at the end. That square root part, that's just how we take the annual IV and scale it down to the specific number of days we're looking at. Simple as that.
Okay, so to make this real, let's use a hypothetical stock. We'll just call it XYZ Corp. Now, let's get some numbers and plug them in to see what the market thinks is going to happen with this thing.
All right, first up, let's say our stock XYZ Corp is trading at a nice round $100. Next, we've got the IV, the market's collective forecast for its volatility. Let's say it's sitting at 40%.
And finally, the time frame. We're looking at an options contract that has exactly 30 days left until it expires. So those are our three key ingredients.
Okay, so we plug those three numbers into our formula, and what do we get? We get an expected move of plus or minus $11.50. So what does that actually mean? It means there's a 68% probability, that's our one standard deviation, remember, that XYZ Corp will be trading somewhere between 88.50 and 111.50 over the next 30 days. That's our expected range.
Now, if we want to be even more confident in our range, we can look at the two standard deviation move. This widens the goalposts a bit, but it gives us a 95% probability that the stock will end up somewhere between $77 and $123.
So that's our 30-day forecast. But what if we're looking at a longer time horizon? What happens if we say double the time to 60 days? Do you think the range gets bigger or smaller? Let's find out.
And would you look at that? Time is a huge factor here. The 60-day range is way wider, stretching all the way from $84 to $116. And this just makes sense, right? The more time you give a stock, the more runway it has to make a big move.
Okay, so we've done the math, we've seen the charts, but what does this all mean for you? What's the practical takeaway here? How can you actually use this in your own trading?
Well, probably the single most important thing to remember is that this is a model. It's a guide. It is not a guarantee. Like we said, real markets are messy, unpredictable, and they have those fat tails. Those wild, unexpected price swings can and absolutely do happen more often than the model thinks they should.
But here's the good news. You're probably never going to have to whip out a calculator and do this math yourself. Seriously. Most modern trading platforms, your broker, they calculate the expected move for you. Your job isn't to be a mathematician. Your job is to be a strategist who can look at these numbers and understand what they're actually telling you.
And, this brings us to the ultimate question, the one every trader has to grapple with. Is implied volatility a genuine prediction of the future, or is it really just a measurement of the market's current mood? A kind of fear gauge that's baked right into the price of options. Figuring out that distinction, well, that's the key to using IV not just as a calculator, but as a real strategic edge.
Hey everyone, welcome. If you're into options trading, you know implied volatility is a huge deal. It's basically the price tag on an option. But here's the million-dollar question. How do you know if a volatility number, say 40%, is actually high or low? Well, that's exactly what we're going to tackle today as we break down a super powerful tool called Implied Volatility Rank. All right, let's get into it.
So, here's what we've got on tap. First, we're going to start with a little puzzle that shows a really common problem with just looking at raw volatility numbers. Then, we'll introduce the solution, IV rank. We'll see how it works, explore how traders actually use it, and then, we'll wrap it all up with the big picture.
All right, first things first, let's dive into this thing I'm calling the volatility puzzle. You're about to see why just looking at a number on a screen can totally lead you down the wrong path.
Okay, so I've got to ask you, is an implied volatility of 40% high? It seems like a simple question, right? But the answer is, well, it totally depends. On its own, without any context, that number is pretty much useless.
All right, let's put some numbers to this to see what I mean. Check out these two assets. We've got asset XYZ with an IV of 40% and asset ABC at 30%. Now, just looking at this, your brain probably goes, okay, XYZ has the higher volatility, its options must be more expensive. But that's not quite the whole story.
But what happens when we pull back the curtain just a little bit? What if I told you that asset XYZ is normally a super volatile stock and its average IV is actually 70%? All of a sudden, that 40% doesn't seem so big, does it? In fact, for XYZ, that's actually kind of low.
And what about our other friend, asset ABC? What if its typical volatility is only around 20%? Well, now its current level of 30% is actually way higher than what it normally is. You see what just happened? The whole story just flipped on its head.
And this right here, this is the heart of the problem. Just because one asset has a bigger IV number, we can't just assume its volatility is high for that specific asset. It's all about context.
So here's the bottom line. Without knowing an asset's history, a raw implied volatility number doesn't tell you a thing about whether its options are cheap or expensive compared to where they usually are. Clearly, we need a better tool for the job.
And that, my friends, brings us to the hero of our story, Implied Volatility Rank. This is the simple, really elegant tool that gives us all of that missing context we've been looking for.
So what exactly is this thing? Well, IB rank basically takes a look at the past year of an asset's implied volatility. It finds the absolute highest point and the absolute lowest point, and then it tells you where today's IB sits within that range. Think of it like a percentile score for volatility.
All right, that sounds great in theory, but how does it actually work under the hood? Well, it all comes down to a really simple and intuitive scale that goes from 0 to 100.
And this is where it gets really elegant. The beauty of Ivy rank is that it's just so simple. It's always a value somewhere between 0 and 100, which makes it incredibly easy to understand with just a quick glance.
So what do 0 and 100 actually mean? It couldn't be simpler. If you see an IV rank of 0, that means the current implied volatility is literally at its rock-bottom lowest point for the entire past year. And if you see 100, you guessed it, it's at the absolute peak. Everything else is just where it falls in between.
Now, for all you math nerds out there who want to see the engine, here it is. You basically take the current IV, subtract the 52-week low, and then you divide that by the total range for the year. It's really just a fancy way of squishing the current value onto that simple 0 to 100 scale.
But listen, and this is the best part, you can probably just forget you ever saw that formula, because pretty much any good trading platform out there is going to do all that heavy lifting for you. It'll show you the IV rank right there on the screen, and some even let you scan the market for stocks based on their rank.
Okay, so we know what it is, we know how it's calculated, but who cares, right? Well, this is the part that really matters. How can we actually use this to make smarter trading decisions? Let's turn this context into some real strategy.
At the end of the day, it really boils down to two simple situations. What you might think about doing when IV rank is low, and what you might do when it's high.
So, let's say you see a low IV rank, maybe something under 20. That's your signal. It's telling you that implied volatility is scraping the bottom of its yearly range. In other words, options are on sale, relatively speaking. And for a lot of traders, that signals a potential opportunity to buy options.
And you can probably guess what's on the other side of the coin. A high IV rank, especially anything over 50 and definitely near 100, is screaming that options are relatively expensive. Volatility is pumped up near its yearly highs. This is when the ears of option sellers perk up, because selling that expensive premium can be a really attractive strategy.
All right, let's zoom out and put a bow on this. Let's quickly go over the most important things to remember.
So when it's all said and done, why should you even care about Ivy rank? Well, first, it solves our puzzle. It adds that crucial context. Second, that 0 to 100 scale is just dead simple to read. It helps you instantly spot if options are cheap or expensive, which can point you toward potential trades. And finally, it's a real practical tool you can use to scan the market.
So think about where we started. We went from a single confusing number to a really clear relative metric. We now know how to tell if volatility is truly high or low for any given stock. Which brings me to my final question for you. Now that you can measure relative volatility, how are you going to use it?
You know, we all like to think we're making super rational, data-driven decisions when we trade, right? But what if I told you that one of the most common gut feelings out there is actually a huge mental trap? Yep, a flaw in our own thinking that costs traders a ton of money over and over again. Let's dive into it.
Okay, so picture this. You're watching a stock, right? And it has just been tanking for 5 straight days. That little voice in your head starts whispering, it's got to go up soon, right? It's just due for a win. Sound familiar? If you've ever felt that, trust me, you are not alone. It's a super common feeling.
But here's the kicker. That feeling, that really strong intuition that a rebound is just around the corner, well, it's not some special insight. It's actually a cognitive bias, a well-known bug in our mental software that can lead us to make some pretty costly mistakes.
All right, so let's really get into this. Why are our instincts so off the mark here? What is going on inside our heads that makes us feel so sure that what happened in the past has to affect the future, especially when our own money's on the line?
The simple truth is, we're just not as rational as we'd like to believe. This was the whole idea behind the work of Nobel Prize winners Daniel Kahneman and Amos Tversky. They showed that our brains love to take shortcuts, these biases, to make quick decisions. And when you're talking about probability and risk, which, let's be real, is what trading is all about, those shortcuts can send us completely in the wrong direction.
And this specific mental trap that we're talking about? Oh, it's got a name. It's one of the most classic, most studied errors in human judgment, the gambler's fallacy.
So what is it exactly? Well, at its core, it's this mistaken belief that a streak just has to end. That if something happens a bunch of times in a row, the opposite is somehow more likely to happen next. You see the roulette wheel hit red 5 times, and your brain just screams, bet on black, it's due. That, right there, is the fallacy in action.
What's really happening is we're just getting the math wrong. We start, as it says here, incorrectly over or understating the likelihood of an event based on a series of past events. We're trying to connect dots that, honestly, just aren't there. We're forcing a pattern onto what is pure, simple randomness.
This slide just lays it out perfectly. Look on the left, the classic coin flip. Let's say it lands on heads 10 times in a row. What are the odds the next flip is tails? It's still 50-50. That coin has no memory. Now look to the right, because this is the big jump for traders. A stock doesn't have a memory either. The fact that it went down yesterday has absolutely no impact on the independent chance it goes up or down today. Every single day is a brand new event.
I know. Our intuition is probably still screaming at us. It just feels wrong. So, you know what? Let's push intuition to the side for a minute and look at the cold, hard math. Because once you see the actual numbers behind streaks, this whole fallacy just completely falls apart.
Let's try a little thought experiment. Imagine you've got this awesome trading strategy. I mean, it wins 70% of the time. That's incredible, right? So with odds that good, what would you guess are the chances of you hitting 10 winners in a row? Just take a guess.
It's less than 3%. No, really. Let that sink in. Even with a fantastic strategy that wins most of the time, the chance of stringing together just 10 wins in a row is tiny. Our gut feels like it should be so much higher, but the math is just unforgiving. And this chart really shows you what's happening. See, you start at a 70% chance for that one win, but just look at how fast and how steep that probability drops. By the time you get to just a few wins in a row, the odds have already taken a nosedive.
And this might be the most shocking part of all. Using that same 70% win rate strategy,
what do you think the odds are of getting just 2 wins in a row? It's already less than 50-50. It is statistically more likely that you won't win twice in a row than that you will. Wild, right?
And hey, this same logic applies on the flip side, to losing streaks. Let's say your strategy has a 40% chance of losing on any given trade. The odds of hitting a long losing streak are also super low. I mean, just look at the chart on the right. The chances of racking up even a few losses back to back just shrinks to almost nothing, really, really fast.
Okay, so the math is clear, the psychology behind it is clear, so the really big question now is, how do we actually use this to avoid falling into the trap? How do we start trading based on logic and probability and not on wishful thinking?
So here's what you need to remember. First, and this is the big one, you have to burn this into your brain. Your next trade is a totally independent event. Second, you have to accept that losses are just a normal part of the game. A few losses don't mean a win is due. And that's why having solid risk management on every single trade is a must. And finally, you got to know the difference between just random bad luck and a real problem. A couple of losses, normal. But if you hit a really long losing streak, like more than 10 in a row, that might be a red flag that something's actually wrong with your strategy itself.
It really all boils down to this one quote. The probability of winning on any single trade is not lower just because you won on the last 10 trades. You can't let a winning streak make you feel invincible, and you can't let a losing streak make you desperate. The odds of the very next trade are always, always independent of what just happened.
And that right there is the mental switch you have to flip. You absolutely have to separate the probability of a single event from the probability of a sequence. The chance you win your very next trade, that's one thing. The chance you win the next 10 in a row, that is a completely different and way, way smaller number. Don't ever get those two confused.
So the final question here is really for you to think about. Take a good, honest look at how you trade. How many of your decisions are really based on the cold, hard logic of your strategy? And how many might be secretly driven by the hope, the fear, and the flawed thinking of the gambler's fallacy?
All right, let's talk about something, a psychological trap in trading that, let's be honest, gets almost every single one of us. It's called confirmation bias. So I want you to do something for me. Think back to the last trade you opened. The very second after you clicked buy or sell, what did you do? Did you find yourself almost automatically looking for news, articles, anything really, that told you, yep, you made a brilliant move? You know that feeling, right? That little itch to prove to yourself you were right? Well, that's exactly what we're going to dig into today. And, it feels great to get that validation. But here's the thing. In the world of trading, it can be a really, really dangerous trap. And hey, let's be super clear about this. This isn't some flaw in your character. It's just how we're wired as humans. The minute we commit to something, anything, our brain just goes on this little mission for reassurance. It wants to know we made the right call. So what does this actually look like when you're trading? It's that classic move of scanning, like a dozen different indicators until you find the one that agrees with you. Or maybe it's that endless scrolling on social media just looking for that one post that says, you got this. See, you're not really researching at that point. You're filtering. You're only letting in the good news. Now, this little habit isn't just some random quirk. It's actually a super well-known psychological thing. And, just knowing what it's called is the first step to beating it. So here's the official scoop. Confirmation bias. It's our brain's tendency to hunt for, interpret, and even remember information that just backs up what we already think is true. It's like our brain takes a shortcut and builds this little echo chamber just for us. And why is it so powerful? Why do we fall for it? It's simple, really. It just feels so good to be right. I mean, the source material says it perfectly. Finding something that agrees with you is a good feeling and certainly can boost your confidence in a position. And that's it right there. That little hit of dopamine, that little confidence boost, that's what makes it so hard to resist. But, and this is a big but, that amazing feeling of being right, that's exactly where the trap is. That's how a simple mental shortcut can turn into a massive, account-draining nightmare. Okay, so this is the real kicker. While you're out there patting yourself on the back, collecting all this evidence that you're a trading genius, you're putting on blinders. You're completely ignoring all the red flags, all the signs screaming that maybe, just maybe, this trade was a bad idea from the start. Think about it like this. On one hand, you've got everything you want to see, right? The positive social media posts, the indicators that are giving you the thumbs up. But on the other hand, you've got what you need to see, the signs that something's wrong, the evidence screaming against your trade. That's the stuff you're tuning out. And let's be real for a second about where we're getting this so-called confirmation. The source nails it. Go on Twitter, search literally any stock ticker, and I guarantee you'll find someone who agrees with your trade. But what does that actually mean? Pretty much nothing. All right, so we get it. We know what it is. We know it's dangerous. So now for the big question. How the heck do we stop doing it? How do we avoid the trap? Well, the game plan is actually pretty simple. It really boils down to two key things. First, you've got to have a crystal clear set of rules and indicators that you follow every single time. No exceptions. And second, you got to get off social media when you're making trade decisions. Just tune out the noise. And you know, the beauty of having a system like that is that it's totally objective. When you have your rules set up before you even enter a trade, you don't need to go hunting for validation afterwards. The system does the heavy lifting. Your rules are in charge, not your feelings. It's the best defense you have. So that leaves us with one last thing to think about. We've just walked through how easily this one bias can mess with our heads and lead to some pretty bad calls. So, if something this common can fool you, what else could be hiding in the way you make decisions? Today, we're going to talk about a really sneaky psychological trap that gets even the smartest traders. It's called the law of small numbers. And honestly, it's the reason our gut feelings, based on just a little bit of information, can steer us completely in the wrong direction. So, let's dive in. So, let me ask you, does this sound familiar? You get all excited about a new trading strategy, you try it out for a few trades, maybe you lose one or two, and you immediately just think, nope, this is garbage, it doesn't work. If you're nodding right now, don't worry. We've all been there. You just fell for the exact bias we're talking about today. And here it is, the culprit itself, the law of small numbers. It's basically a glitch in our thinking. It's a fallacy where our brain just kind of assumes that a tiny little snapshot of data, like a handful of trades, is enough to see the whole big picture. We end up jumping to these massive conclusions with hardly any evidence at all. I mean, this quote really puts it into perspective, doesn't it? Imagine you walk up to a roulette table, you place one bet, you win, and you walk away declaring to everyone that roulette has a 100% win rate. It sounds absolutely ridiculous when you say it like that, but that is pretty much what we're doing when we judge a trading strategy after just a couple of trades. So, the big question is, why is this trap so dang easy to fall into? Well, it's because our brains are basically hardwired to make quick judgments. And what's really interesting is that we're kind of misusing a very real, very powerful statistical rule. Let's dig into that confusion. Right, so the fallacy, the law of small numbers, it's like the intuitive but totally wrong evil twin of a real statistical principle, the law of large numbers. The real law, the correct one, says that as you get more and more data, your results will start to look more and more like the true average. It takes patience. The fallacy, on the other hand, well, it feeds on impatience and gut feelings. Okay, so if large numbers are the key, what does that actually look like? Why is getting more data the only way to get real answers? This next visual is going to make it crystal clear. Okay, now take a look at this chart. It's super interesting. What you're seeing is the average result of rolling a die over and over again. That straight blue line, that's the true mathematical average, which is 3.5. Now look at that green line over on the left inside that red box. It is all over the place. It's complete chaos. That is the law of small numbers in action. But watch what happens as you keep rolling the die. See how the green line starts to calm down and hug that true blue line? That, right there, is the power of large numbers. So here's the bottom line, the most important takeaway. In the beginning, with just a few trades, your results are pretty much just random noise. A couple of wins, a couple of losses. It literally means nothing. It's just a statistical blip. It's only after you get a big enough sample size that a real, true pattern, the actual performance of your strategy, can start to show itself. And this, of course, leads us to the million-dollar question. It's great to say, yeah, just get more data. But how in the world are you supposed to do that with a brand new strategy without risking your entire account in the process? It feels like a total catch-22. But don't worry, there is a very clear, very simple solution. And here is that solution. Let's call it the 20-trade litmus test. Think of it as a simple but really powerful rule that's designed to help us fight against our own flawed intuition and force us to get just enough data to make a smart decision. 20, that's the number. You have to commit to a minimum of 20 trades before you even allow yourself to form an opinion on a strategy. Not 2, not 5, not 10, 20. This is your absolute minimum sample size to get started. Now, this is really important. During these 20 trades, you have to completely change your mindset. Your goal is not to make money. Let me say that again because it's crucial. Your goal is not to make a profit. Your one and only job is to test the strategy and collect data. You have to treat this like a scientist running an experiment, not a gambler buying a lottery ticket. So how do you run this experiment the right way? Well, it all boils down to a pretty straightforward 3-step action plan that you can start using right away. Here they are, the 3 absolute must-dos for this test. First, you have to trim your risk way, way down. Second, you have to be completely mechanical, like a robot. And third, you've got to keep a detailed journal of absolutely everything. Let's break each one of these down. All right, step 1 is all about psychology. You have to cut your position size down so small that you honestly don't care about the financial outcome. I'm talking so small that you could lose on all 20 trades and it wouldn't cause you any real financial pain or emotional stress. This is how you take fear out of the equation so you can actually be objective. Step 2 is all about consistency. Think about it. If you're not following the exact same rules every single time, then what are you even testing? You need to write down your rules for entry, exit, and risk management so clearly that there is zero guesswork involved. You have to execute flawlessly, because if you deviate, you're not testing the strategy anymore. You're just testing your mood that day. And finally, step 3, collecting the data. If you don't write it down, it might as well have never happened. After every single one of those 20 trades, win, lose, or break even, you have to open up your journal and document what happened. This isn't optional, folks. This is the whole point of the exercise. And here's exactly what you should be tracking. You need the raw data. What was your entry price? Your exit? What was the ideal profit target for the trade? And how much did you actually have at risk? How long was the trade open? Tracking these specific details is what turns random trades into a rich set of data that you can actually use. You see, by following this process, you make a huge shift in how you operate. You go from being a gambler who's just relying on guesswork and gut feelings to being a systematic analyst who makes decisions based on cold, hard data. And that's the real prize here. After you've done your 20 trades, you don't just have a vague feeling about the strategy. You have a spreadsheet. You have a collection of data you can look at objectively to decide if this strategy actually has an edge, if it needs a few tweaks, or if you should just throw it out. You're not guessing anymore. You're making an informed decision. So I'll leave you with this final twat to chew on. This whole idea, it isn't just about trading, is it? Think about it. In your career, your relationships, your life, what other huge decisions are you making based on just 1 or 2 data points? Where else might the law of small numbers be tripping you up? It's a really powerful question to ask yourself. Today, we're going to pull back the curtain on a hidden mental trap that quietly shapes how you see the world. Everything from the stock market to your favorite success stories. It's called survivorship bias. And really, it's all about what we see and the huge invisible story of what we don't. Let's dive in. So, think about this for a second. Whenever you look at a chart of the stock market or maybe some big mutual fund, what do you see? The line generally goes up, right? It kind of feels like a sure thing, you know? That if you just hang in there long enough, you're pretty much guaranteed to win. But is that really the whole story? Well, as much as that feels right, it's actually a massive misconception. It's a really powerful illusion, and it's created because we're looking at a dangerously incomplete picture. Here's the problem. The stocks and funds you can look up today, they're already the winners. They've been pre-filtered for success. That company that went totally bankrupt, poof, it's delisted, gone. The mutual fund that had terrible returns, it was quietly shut down or merged into another one. You're literally only seeing the survivors. This huge mistake in our thinking, it actually has a name, and it's the core of what we're talking about today. So let's get a clear definition. What exactly is survivorship bias? So at its heart, it means we're making these big judgments based on a totally skewed sample. It's like trying to understand why people succeed by only interviewing lottery winners. We analyze the victors without ever stopping to think that the real lessons might be hidden with the ones who failed. And that's the absolute key right there. Lack of visibility. The failures are invisible. They don't make the news, you can't find their long-term charts, they are just wiped from the data we use to make decisions. So what you don't see is actually misleading you. Now, the ideas we're digging into today, they come straight out of this fantastic book, Trading Psychology. It does an incredible job of breaking down just how these mental biases can trip us up, especially when it comes to our money. And look, this isn't just some vague theoretical idea. The sheer scale of these unseen failures is absolutely massive. In fact, a major study put some hard numbers to this, and while the results are pretty eye-opening. So the folks at Vanguard did a deep dive. They looked at a whole bunch of large-cap mutual funds over a 14-year stretch. And they weren't just tracking which ones did well. They were also tracking something even more basic. Which ones even managed to survive the whole period? All right, before I show you the number, just take a quick guess. Seriously, if you put your money in a fund back in 1997, what are the odds, what percentage of those funds do you think managed to both stay in business and beat the market by 2011? Maybe 50%, 40%, 22%. That's it. Just let that sink in. That means that almost 80% of funds either disappeared completely or couldn't even keep up with the market. The so-called winners that we see today are just a tiny, lucky fraction of the original group. And hey, this isn't just about Wall Street, not by a long shot. This bias completely warps how we see success in pretty much every part of life, from business and startups to art and even just personal growth. You know how we love to read books about billionaires and legendary founders to find the secret to their success, right? We look for those common traits, thinking, hey, if I just act like them, I can be successful too. But that is a classic textbook survivorship bias trap. And this illustrates the point perfectly. We praise the successful entrepreneur for taking huge risks. But what about the thousands who also took huge risks and went bankrupt? We celebrate the college dropout who built an empire, but we completely ignore the millions who dropped out and struggled. The traits are often exactly the same. The only difference is the outcome and probably a whole lot of luck. You know, that old saying really nails it, doesn't it? History is written by the winners. It's as true on the battlefield as it is in the stock market. We only ever get to hear the stories from the ones who survived to tell the tale. So after all this, what's the big takeaway? The most important thing is to train yourself to always ask one simple question. What am I not seeing here? Who didn't make it? What data is missing from this picture? So the next time you're reading one of those top 10 habits of billionaires articles, or you're looking at a company with a perfect track record, or you're even just admiring an old building thinking, wow, they sure don't build them like they used to, just pause. Ask yourself, what am I not seeing? What failures got filtered out to make this picture look so perfect? Because learning to spot that invisible filter, that's the first step to making a much smarter, more realistic decision. And what you can't see often matters a whole lot more than what you can. You know, our brains are basically pattern-finding machines. It's how we survived, how we make sense of everything. But that amazing strength, it can also be a huge weakness, leading us right into what's called the correlation trap. We're going to break down why seeing two things move together doesn't always mean what you think it means. So let me ask you this. When you see two things happening in lockstep, maybe in the news, in the financial markets, anywhere, what's the real story? Is one actually causing the other? Or is something else going on behind the scenes? I'm sure you've heard this phrase a million times. It's like rule number one of critical thinking. And yet it's a rule we all break constantly, usually without even realizing it. So let's actually dig into what this really means. Okay, so first things first, what even is correlation? Well, it's pretty simple. It's just a connection. When one thing changes, another thing tends to change with it. They move together. That's it. That's all it's telling you. And this right here, this is the key. Correlation just shows a connection. Hey, these things are moving together. But causation? That's a much bigger claim. It says this thing makes that other thing happen. It's a cause and effect relationship. And getting those two confused is where all the problems start. So how do we get this so wrong? Well, the first trap is something called reverse causation. This is where we see a perfect connection, but we completely mix up the cause and the effect. We get it backwards. Let's use a really obvious example to make the point. Imagine you tracked two things, the number of umbrellas being used in a city and the amount of rainfall. You'd see a really strong correlation. As one goes up, the other goes up. I mean, the pattern is undeniable, right? The data lines up perfectly. So, does opening your umbrella actually cause the rain to fall? Yeah, of course not. We all know that's silly. We've got it backward. The rain causes people to pull out their umbrellas. Now, this example is super obvious, but this exact same mistake happens all the time in more complex areas, like economics or medicine, where the real cause and effect aren't nearly as clear. Okay, but what if you're sure you've got the cause and effect in the right order? Well, there's another trap waiting for you. This is the hidden cause. It's when two things look connected, but really, a third, invisible factor is pulling the strings on both of them. Think about this. Say you're watching the stock market, and you notice two different oil stocks just move in perfect sync. When one company's stock goes up, the other does too. When one goes down, the other one follows right behind it. So, you have to ask yourself, is the movement in one stock actually causing the other one to move? Is one company's success directly making the other company's stock rise? Not really, right? The real driver here is that hidden variable, the global price of oil. When the price of crude oil goes up, it tends to lift the value of all oil companies. The stocks aren't causing each other to move. The price of oil is the hidden cause making them both move together. This brings us to the last and maybe the most confusing trap of all, pure coincidence. This is when two things are correlated, sometimes very strongly, but the link is totally meaningless. It's just random chance. And you're gonna love this example. For more than a decade, an analysis found a surprisingly strong connection between how much chicken Americans eat and how much crude oil the US imports. And we're not talking a weak connection. The correlation was nearly 90%. That is an incredibly strong relationship, statistically speaking. For over 10 years, as one went up, the other followed. So, should we be looking at chicken sales to predict the oil market? Absolutely not. This is a perfect example of what's called a spurious correlation. If you look at enough data in the world, you are guaranteed to find things that move together just by pure coincidence. There's no real link there at all. So, from umbrellas and oil stocks to something as random as chicken, these examples all point to a really critical lesson. Let's wrap this up and talk about why spotting these traps is so important. So, here are the 3 big traps to watch out for. First, always ask yourself if you've got it backwards. That's reverse causation. Second, always be on the lookout for a hidden factor that could be influencing everything, the hidden cause. And finally, you gotta be willing to accept that sometimes a pattern is just a random coincidence and nothing more. And that really gets to the heart of it. Finding a correlation is the easy part. A computer can do that all day. But proving that one thing causes another, well, that is a totally different story. That takes real work, real investigation, and a lot of critical thinking. So I'll just leave you with this question. What correlations in your own life might you be misreading? The next time you see a chart or a headline showing a neat and tidy connection, just stop for a second. Ask yourself, what's the real story here? Because it's probably not the first one that comes to mind. I knew it all along. Come on, we've all said it, right? But what if that feeling, that little bit of hindsight, is actually one of the biggest things holding you back? Today, we're jumping into the hindsight bias. It's this cognitive trap that can seriously mess with how we see things and, honestly, sabotage our future decisions. Let's get into it. And boom, Nobel laureate Daniel Kahneman just nails it with this quote. He's basically exposing this major flaw in our thinking. See, we are just wired to judge a decision based on how it turned out, not on the process we used to make it. This means a total lucky guess that pays off can make you look like a genius, while a super well-thought-out, calculated risk that just happens to fail gets written off as a dumb move. This, right here, is the absolute heart of the hindsight trap. So what is hindsight bias, really? Well, think of it like your brain is a movie director. After the movie's over, it goes back and reshoots the past to make the story seem way more predictable. It just smooths out all the random stuff, connects a few dots that weren't really there, and then it whispers in your ear, "See, it was totally obvious." And listen, this isn't just some little mental quirk, it's a fundamental distortion of our ability to actually learn from what happens to us. And this is where that little bias becomes genuinely dangerous. It actually sets a trap for us. Let's call it the retrospect trap. This is the point where a simple mental habit morphs into a real, tangible roadblock to getting better, especially in high-stakes games like trading. The bait for this trap is so simple. You equate a good outcome with a good decision, and a bad outcome with a bad one. You win money? Oh, that was a smart move. You lose money? What a dumb mistake. It's a really seductive way to think, but you have to know it's a complete illusion. It totally ignores the two most critical factors in any decision you make with uncertainty: probability and just plain old luck. So this really shows us the fundamental choice we have in how we look at our own performance. On one side, you've got this emotional roller coaster, right? Focusing only on the outcomes, the short-term high of a win, the crushing low of a loss. But on the other side, you have a much more disciplined, analytical approach that's all about your process. The question completely shifts from, did I win, to did I actually follow my plan? And that is the crucial pivot from being a gambler to becoming a strategist. All right, let's put this dangerous illusion under the microscope. What really happens when we let the results, and only the results, dictate how we judge our past decisions? Let's make this real for a second. Imagine a trade opportunity just pops up on your screen. The clock's ticking. Now, based only on the information you have in that moment, is it a good decision? How do you even begin to answer that question? Okay, here are the numbers. The trade has a 70% chance to make you $200 and a 30% chance to lose you $100. I mean, the math here is undeniable. The odds are heavily, heavily in your favor. So from a purely probabilistic view, this is a fantastic trade. End of story. But here's the catch, and it's a big one. Even with these amazing odds, you are going to lose this trade 3 out of every 10 times. A single bad outcome does not and should not invalidate a sound decision-making process. Over the long run, this is absolutely a winning strategy. And this right here, this is the core of the hindsight illusion. When one of those 3 losing outcomes happens, your brain's alarm bells just start screaming. All of a sudden, that loss feels like it was inevitable, and your well-reasoned, logical decision gets completely reframed as a foolish mistake. That's the power of hindsight. That's how it distorts our perception of reality. And you see this illusion everywhere in trading. It's exactly why scrolling back on a historical chart makes every single pattern look like a crystal clear signal. We tell ourselves, oh, of course, that was a breakout. But in the moment, at the hard right edge of that chart, when you're staring into the total unknown, all that clarity just vanishes into a fog of possibilities. Okay, so if we know the trap is there, how in the world do we disarm it? The solution actually isn't that complex, but it does demand discipline. It requires a fundamental shift in your focus, away from the unpredictable outcome and onto the one thing you can actually control, your process. This is it. This is the single most important thing to take away from all this. To get out of the hindsight trap, you have to surgically separate how you evaluate your decision from how that decision turned out. You need to build a firewall between the quality of your process and the randomness of the result. But how do we make this practical? How do we turn this big, abstract idea into a concrete tool we can actually use? Well, let's build a simple but really powerful anti-bias checklist to take back control over how we learn. This checklist completely shifts your focus to what you can control. So step 1, the plan. Did you even have one? Was it clear? Step 2, execution. Did you stick to the plan? This is where your discipline really gets tested. Step 3, the why. If you deviated, you need to be brutally honest with yourself. Was it fear, greed, maybe impatience? And finally, step 4, improvement. What is the one actionable lesson you can take for next time? This whole process turns every single trade, win or lose, into a unit of learning. So, I'm going to leave you with this challenge. The next time you're reviewing a past decision, doesn't matter if it ended in a huge win or a total disaster, force yourself to answer this one question. Are you judging the decision itself, or are you just judging the outcome? Because the ability to tell the difference between those two is not just a skill, it's the absolute key to unlocking genuine, lasting improvement. Breaking free from the hindsight trap starts right there, with that single honest answer. Have you ever felt like investing is a battle? Well, it turns out the fight isn't just with the market's crazy ups and downs. Nope. The real opponent is actually a lot closer to home. It's the way your own brain is wired. So why is it that even when we have a solid, well-thought-out plan, our own brains seem to go rogue, urging us to make exactly the wrong move at the absolute worst time? If you've ever felt that pull, trust me, you are not alone. It's a fundamental puzzle every single investor has to solve. But here's the most important thing to get right away. This is not a personal failure. It's not that you're just bad at investing. It really all comes down to two very powerful, very human glitches in our mental hardware that affect pretty much all of us. Okay, so let's pull back the curtain on the first culprit behind so many of our investing struggles. It's a sneaky little cognitive trap called recency bias. So what is it exactly? Well, it's our brain's weird tendency to give way too much importance to things that just happened. It's like our short-term memory gets a giant megaphone, and it just completely drowns out all the wisdom we could get from looking at long-term history. And this bias, it creates this really dangerous emotional cycle. You've probably seen it. During a long bull market, when everything's just going up, 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 we get kind of complacent. We forget that risk is even a thing. But then, after a crash, whoa. The pendulum swings to the other extreme. We're terrified. We start seeing disaster around every corner, often right when the best opportunities are actually starting to show up. And that's the real problem, isn't it? Recency bias makes us feel like geniuses when we should probably be cautious, and it makes us feel terrified when we should be thinking rationally. The longer any trend goes on, the more our brain gets locked into expecting more of the same, which makes any kind of reversal feel like a total shock to the system. But you know what? Recency bias doesn't work alone. Oh no. It's got a partner in crime, an equally tricky habit of the mind called the attribution bias illusion. This bias comes from a simple fact. Our brains hate, and I mean hate, randomness. We have this deep, intense need to assign a cause, a story, to everything that happens. We just crave a why, even if the story we make up has absolutely nothing to do with reality. And guess who knows this? This is exactly where the financial news media comes in. I mean, their entire business model is practically built on satisfying our craving for these explanations. They are story-generating machines, and they are designed to feed our attribution bias 24/7. So you end up with this really powerful and frankly predictable feedback loop. A stock price moves. Right away, our brain demands to know why. The media instantly serves up a nice, tidy story to explain it. And because we need that feeling of certainty, we just eat it up and accept it as fact, even if that story completely contradicts what they were saying yesterday. So while we're getting lost in all these complex stories about inflation or what some CEO had for breakfast, the truth is usually so much simpler. You know, the best, most fundamental reason a price goes up is that there were simply more buyers than sellers that day. That's it. That's the reality, once you strip away all the drama and the storytelling. Okay, so we've just identified these two really powerful mental traps that are constantly working against us. So the big question now is, what do we actually do about it? How can we start to see past all the noise that our own minds and the market are constantly creating? All right, here's your mental toolkit for fighting back. First, just be a little skeptical of your short-term memory and the emotions it brings up. Second, learn to question those super simple, clean cause and effect stories you hear on the news. And finally, always remember this: trust the long-term data, not the short-term drama. And that really leaves us with one final thought to take with you. The next time the market makes a big emotional move and you feel that powerful pull to just do something, ask yourself this one simple question. Am I responding to the actual reality of the situation, or am I just playing a part in the market's latest, most convincing story?
All right, let's talk about something that's a real account killer, the sunk cost fallacy. It's this sneaky psychological trap that can quietly wreck even the best trading strategies, turning what should be small, manageable losses into absolute disasters.
Come on, be honest with me. Have you ever been in a trade? It's deep in the red, and you know you should get out, but you just don't. You just hold on, telling yourself, oh, it's got to turn around soon. If that sounds even a little bit familiar, well, you're not alone. That right there is the sunk cost fallacy in action.
So let's peel back the layers here. What is actually happening inside our heads when we do this? We're going to break down the core bias that drives this really common and very human behavior. So here it is.
It's our brain's stubborn tendency to just keep going with something, not because it's a good idea now, but simply because we've already poured so much into it, whether that's money, time, or just pure effort. We get way too attached to what we've already spent instead of focusing on what's best for the future.
You know that little voice in your head? The one that whispers, you've put too much in to quit now. That's it. It's the gut feeling that says walking away with a loss is a waste, and that maybe, just maybe, if you wait a little longer or even double down, you can justify that initial decision.
Okay, so how do you break free from this? Well, believe it or not, there's a super simple mental tool you can use to slice right through all that emotional noise. Think of this as your moment of clarity, a single powerful question that can save you a world of hurt.
This right here, this is the golden rule. You have to ask yourself, forgetting what I originally paid for this, would I buy it right now at its current price? If the answer is no, then what are you doing still holding it? It's really that simple and that powerful.
And here's why that question works so well. The money you've already lost, it's gone. Poof, it's a sunk cost. It should have absolutely zero impact on your next move. The only thing that matters is where the price is likely to go from this exact moment forward.
It sounds so illogical when you lay it out like that, right? So why on earth do we all fall for it so easily? Well, the answer isn't that we're bad traders. It's just that we're human. Let's dig into how this little glitch is basically hardwired into our psychology.
And look, it's really important to get this. Falling for the sunk cost fallacy is not a personal failure. It's a cognitive bias, and it's tied to this thing called loss aversion. Basically, the pain of a loss feels about twice as strong as the pleasure of an equivalent gain. So when you close a trade for a loss, you make that pain real, and our brains will do almost anything to avoid that feeling, even if it leads to, well, even bigger losses.
This slide just lays it out perfectly, doesn't it? On the left, you've got that emotional, past-focused brain. It's all about ego and not wanting to admit we were wrong. But on the right, you have that rational, present-focused mind. It treats every single moment like a brand new decision, totally separate from the past. And that is where you want to live as a trader.
Okay, so we get it. We know what the problem is, and we know why it happens. Now for the most important part. What in the world do we do about it? Because just knowing about it isn't enough. You need a real toolkit, a set of strategies to keep this bias from taking over.
Just knowing this stuff is a huge first step, don't get me wrong. But let's be real. When the market's moving fast and your own money is on the line, just knowing about a bias often isn't enough to stop it. We need to build actual systems and habits to protect ourselves.
So, here's your defense mechanism. These 5 steps are your shield against that irrational part of your brain. It all starts with planning before you ever get into a trade, then managing your environment, and always keeping an eye on your own psychological state.
And that first step, the trade plan? Oh man, it's absolutely non-negotiable. A real trade plan isn't some vague idea in your head, it's a script. You decide your exit points, both for your target profit and your stop loss, before you ever click the buy button. That way, the decision to get out becomes mechanical, not emotional.
Now, having a plan is awesome, but you also have to know when you're most likely to throw that plan right out the window. Trying to make a decision in a hurry, trading when you're angry or frustrated, or when you're just plain exhausted. These are the moments when biases like the sunk cost fallacy just love to creep in. Recognizing your own high-risk situations is half the battle.
So as we wrap this up, let's just boil it all down to one core idea. If you remember only one thing from this whole explainer, please let it be this.
It all comes down to this. Your future decisions should never ever be held hostage by your past investments. The money is spent, the time is gone. It's in the past. Your only job now is to make the absolute best decision you can for the future with the information you have right now. Don't let a past mistake chain you to a losing position.
And I'll leave you with this final thought. Because this doesn't just apply to trading, does it? Think about it. Your career, projects you're working on, maybe even relationships. What other parts of your life are being controlled by sunk costs? Taking a moment to answer that honestly, well, that could be the most profitable trade you make all day.
All right, let's talk about something that's absolutely critical but often overlooked: trading psychology. Today, we're going to break down the mental framework that really separates the consistently profitable traders from, well, pretty much everyone else. And look, this isn't about finding some new magic strategy. It's about unlocking the power of the one you might already have. So let's start with this massive paradox in trading, one that just drives people crazy. I mean, in almost every other part of your life, the formula is simple, right? You put in more effort, you get better results. But if you're a trader, you know that soul-crushing feeling. You put in hours and hours of analysis, you do all the homework, only to watch a trade go against you. So why is that? And here's the fundamental disconnect, laid out plain and simple. In a normal job, your input has a pretty predictable output. You work more hours, you get more pay. Simple. But the market, Oh, the market does not care how long you stared at the charts. The outcome is all about probability, not how hard you worked. And that, right there, is what makes trading such a psychological minefield. Yeah, and this sets up this huge emotional trap. Because it's your money on the line, your hard-earned cash. Every little move against your position feels personal. It's incredibly tough to stay rational when you see your account balance dropping. And that emotional knee-jerk reaction, it leads to absolutely disastrous decisions, things like revenge trading or just throwing your plan out the window. It can wipe out weeks of good work in a single bad trade. Okay, so if the normal rules of work hard, get paid just don't apply here, then what does? Well, it means we need a totally different way of thinking. We need a framework that's built on the market's strange and counterintuitive truths. These are it, the 5 fundamental truths. These form the absolute bedrock of a winning trader's mindset. Getting these ideas deep into your bones is the key to trading with fear, to making disciplined, almost mechanical decisions. So let's break them down one by one. Truth number 1 is that in the market, literally anything can happen. And why is that? Well, because the market isn't some machine. It's just millions of people all acting on their own beliefs and fears. And with that many people involved, pretty much any outcome is possible, even if it's not very probable. Accepting this basic fact protects you from being blindsided by the unexpected. Now, if you accept that anything can happen, that leads you straight to the second truth. And honestly, this one is maybe the most liberating of all. You do not need to know what's going to happen next. In fact, trying to predict the future is a total dead end. So you're probably thinking, how on earth do you make money in an environment that's completely uncertain? The answer is, you have to start thinking like a casino. Seriously, a casino has no idea if the next spin of the roulette wheel is going to be red or black. And you know what? They don't care. They might lose on that one spin. They might lose on the next 10 spins. But they know for a fact that over thousands and thousands of spins, their small statistical edge guarantees they come out on top. Your trading system, that is your casino edge. And that casino idea leads us right here. Even when you have a proven edge, your wins and losses are going to show up randomly. You could have 5 losing trades in a row, then boom, 7 winners. The sequence itself is totally unpredictable. If you can truly, deeply believe this, you'll never get thrown off your game by a losing streak again. Think of it like a coin toss. It's that simple. If you flip a coin and it comes up heads, does that give you any clue about what the next flip will be? Of course not. It's a 50-50 shot every single time. And if you truly accept that, you'll never feel like the market is out to get you after a loss, because you'll understand every trade is just a fresh, independent event. So let's be crystal clear about this, because it's a crucial point. An edge is not a guarantee. All it is a slightly higher probability of one thing happening over another. That's it. It's the casino's tiny advantage on the roulette wheel. It doesn't mean you win every time. It just means that over a big enough sample size of trades, you should come out ahead. And the final truth that ties it all together is this. Every single moment in the market is unique. No 2 moments are ever exactly the same. For that to happen, every single trader in the world would have to have the exact same thoughts and positions as they did at some point in the past. That's impossible. And what that means is you can't rely on some past pattern to play out perfectly this time around. Okay, so we've just covered the 5 big truths. That's the philosophy. But that's all just talk if you can't put it into practice, right? So how do we turn that mindset into a concrete, practical action plan that you can use on every single trade? It all boils down to your trading plan. And the number 1 most important, non-negotiable rule is this. You create the plan before you put any money on the line. You do it when you are 100% calm and rational. Your plan has to cover everything. Your exact entry point, your exit point if you're wrong, your profit target, your position size, your risk-to-reward ratio. Every single detail is decided before you get into the heat of the moment. And that brings us to the golden rule of risk management. For your long-term survival as a trader, this number right here is probably the most important one you will ever see. Here's the deal. You should never, ever risk more than a small percentage of your total trading capital on any one trade, ideally less than 3%. Why? Because you now know that losses can come in random streaks. Trading small is what ensures that a string of bad luck doesn't wipe you out. It keeps you in the game long enough for your edge to actually work. It's the exact same reason casinos have table limits. You know, when you combine these 2 things, a predefined plan and a small position size, something amazing happens. You genuinely accept the risk before you even click the buy button. And if you can do that, the result is profound. As the book says, you will never, ever have trouble sleeping at night, no matter what happens with the trade. So let's bring this all home. We've talked about having a system, an edge, a plan. But the real engine that makes all of that stuff actually work, it's your psychology. So I want to leave you with this question. If you have a trading system that you know on paper has a real edge, but you still can't seem to be consistently profitable with it, where does the problem really lie? Is it the system, or is it the person who's executing that system? And that leads us to the final, most crucial takeaway of all. Your mindset isn't just some nice accessory that goes along with your strategy. Your ability to truly accept those 5 truths and to execute your plan flawlessly over and over again, that's not just part of your strategy, it is the strategy, and mastering it is the only real way to win this game.
Have you ever looked at one of your trades and just thought, man, that was pure luck? Yeah, we've all been there. If you feel like your trading is more about guesswork than logic, then you are in exactly the right place. We are about to break down the single most important tool you can have, a real, solid trading plan. Let's do this.
This quote, man, it just says it all, doesn't it? One of the biggest, and trust me, most expensive mistakes that new traders make is just jumping into the market with no strategy at all. That's not trading, you know? That's just guessing. And that is a really dangerous game to be playing with your hard-earned money.
So what happens when you trade blind? Well, it's that horrible, sinking feeling you get when a trade that was winning suddenly flips and turns into a loser, all because you didn't have an exit plan. It's making those gut reaction, emotional decisions that end up costing you real cash. But here's the good news. There is absolutely a way to fix this.
And that solution is your pre-trade checklist. I want you to think of it like a pilot's flight check before they even think about taking off. It's a simple, repeatable process that forces you to think about every single critical part of a trade before you put a single dollar on the line. This is what separates the pros from the amateurs. This is what gives you back control. Okay, so here's our roadmap. It all boils down to just a few key steps. First, we're going to get into the core math of any trade, defining your risk, setting your reward, and really understanding that all-important ratio between the two. Then we'll look at the bigger picture, scanning for any market events and picking the right time frame for your strategy. It might look simple, but I'm telling you, this process is incredibly powerful.
So let's start with the absolute foundation of it all, the numbers. Before you even think about hitting that buy button, you have to know what you stand to gain and, just as importantly, what you stand to lose. We're taking emotion out of the equation here. This is just pure math.
For every single trade, you need 2 critical numbers locked in up front. No exceptions. First, your max loss. This is your line in the sand. It's the point where you admit, okay, I was wrong on this one, and you get out to protect your capital. Second, your profit target. This is what stops greed from taking over and turning a perfectly good trade into a losing one, just because you were hoping for a little bit more.
And that brings us to a super simple but powerful rule of thumb, the 1-to-2 risk-to-reward ratio. All this means is that your potential reward should be at least double your potential risk. So if you're risking $1, you should be aiming to make at least $2. Why? Because a ratio like this puts the odds in your favor over the long haul. It means you don't have to be right all the time to be profitable.
But, rules of thumb have their exceptions, right? And here's a key one. If a trade setup has an extremely high chance of working out, it can actually make sense to accept a lower reward. The math still works out in your favor if your win rate is high enough to make up for those smaller gains. It's all a balancing act.
Okay, so once you've got the math all sorted out, it's time to look at the world around your trade. See, your trade doesn't exist in a bubble. You have to consider your timeline and any outside events that could come along and completely change the game. So you have to ask yourself this critical question. What could disrupt my trade? What are the hidden icebergs out there on the horizon? Figuring out these potential problems before you enter a position is what the pros do. It saves you from those nasty surprises that can sink an otherwise perfect setup. And here are some of the biggest things to keep an eye out for. A company's earnings report, any upcoming dividend payments, or big economic news releases. These can all cause huge, unpredictable price swings. Now, you don't necessarily have to avoid trading around them, but you absolutely have to know they're coming and account for that extra volatility in your plan.
And finally, you have got to define your time frame. Who are you as a trader?
Are you a day trader, getting in and out before the market closes? Are you a swing trader, holding for a few days or weeks? Or are you a long-term investor, looking months or years down the road? Deciding this upfront is what keeps you from making a long-term decision based on a short-term panic.
So, what's the big takeaway here? A trading plan literally transforms you. You go from being a gambler just rolling the dice to a strategist who is executing a well-thought-out plan. It replaces all that emotion and guesswork with a logical, repeatable process. This checklist is your single greatest tool for building consistency in your trading.
So I'll just leave you with this one question to think about. After seeing this checklist, what is the very first change you're going to make to your own trading approach? Because remember, a plan isn't just some list you write down. It's the difference between hoping for a win and actually trading for one.
You know, we all dream of that one brilliant trading idea, the one that's going to make us a fortune. But what if I told you the real secret to consistent success isn't the idea at all, but the process? Today, we're going to break down 5 key steps to build a rock-solid trading process, the kind that helps you trade smarter, not harder. Come on, we've all been there, right? You feel the thrill of a new trade, you're full of hope for a big win, and then that crushing disappointment as it just turns against you. It's a feeling every trader knows, and it's usually where a whole downward spiral of emotional decisions and really costly mistakes begins. So the key here is to shift your focus. I mean, really shift it. Stop chasing that perfect trade and start building a perfect process. A process that tells you exactly how you're going to enter, manage, and exit every single trade. It's all about replacing that emotion with pure discipline. All right, so how do we get there? We're going to walk through 5 simple but super powerful steps. We'll start with planning before you trade, then we'll pinpoint the #1 mistake that trips up most traders. After that, we'll get into how to place your orders like a pro, automate your discipline, and finally, how to create a feedback loop so you can learn from every single trade you make. Okay, first things first. This is probably the most important step of all. You have to have a plan before you even think about hitting that buy or sell button. Think of this plan as your shield, your antidote to all those emotional decisions that can absolutely wreck your portfolio. So what does a good plan even look like? Well, it's a lot simpler than you might think. First up, your entry plan. What price are you getting in at? How big is your position? Second, your exit plan. Where are you going to take profits? And what's your trigger to cut your losses? And finally, just a few notes on why you're even making this trade in the first place. Man, this quote it nails the psychology of trading perfectly. The second your money is on the line, your brain literally changes. You're not an objective analyst anymore. You're an emotional participant. And that's why you need that plan before you ever get in. This is exactly why you need to physically write it down. I'm serious. The simple act of putting it on paper or typing it out forces you to slow down, to actually think it through, and to justify the trade to yourself. It's really the ultimate defense against those impulsive, gut-feeling trades that almost never work out. All right, so you've got a plan. Now it's time to execute. And this, my friends, is where most traders make their biggest and most expensive mistake. They use market orders. So what's the big difference? Well, a market order is basically you yelling, "Get me in right now. I don't care what the price is." Yeah, it's fast, but you'll often get a really bad deal. A limit order, on the other hand, is you saying, "I will only buy at this price or better." You're the one in control. And trust me, it's always better to miss a trade than to get a bad entry. Okay, so we're using limit orders from now on. Great, but what price should we actually set? Well, to answer that, we need to understand a really fundamental concept called the bid-ask spread. It sounds a little technical, but think of it like a flea market. The bid is the highest price a buyer out there is willing to pay. The ask is the lowest price a seller is willing to accept. The gap between those two numbers, that's the spread. And that's where market makers earn their keep. And here it is, the pro tip that'll change your trading forever. Always starts by placing your limit order at the mid-price, that sweet spot right in the middle of the bid and the ask. You would be shocked how often you get filled there, and it will save you a little bit of money on every single trade. And look, those little bits of money, they add up, big time. Over the long haul, just aiming for that mid-price can save you thousands of dollars. That's what trading smarter, not harder, is all about. So, We've got a plan. We know how to get into the trade. But how do we make absolutely sure we stick to our exit plan? Honestly, the best way is to take yourself out of the equation completely, and we do that through automation. Let's look at two really powerful tools for this. A good till canceled order, or GTC, lets you set a profit target and just forget about it. Say you buy a stock at $10 and you want to sell it at $12. You can set a GTC order to sell at $12, and it just sits there, active, until it's filled. Even better is a bracket order. This lets you set both a profit target and a stop loss. So same stock, you buy it at $10, you can set a bracket order to sell at $12 on the high side or $8 on the low side. If the stock hits $12, you take your profit and the stop loss order is automatically canceled. If it drops to $8, you cut your loss and the profit-taking order is canceled. It's brilliant. This is pretty much the holy grail of disciplined trading. By automating your exit plan, you're ripping emotion right out of the equation. No more second guessing, no more hesitating. The machine simply executes the plan you made when you were calm and thinking clearly. And finally, the last step. This is the one that separates the traders who grow from the ones who just stagnate. It's the review. The trade is not over when you close it. In fact, some of the most important work happens right after. Okay, time for some tough love. You've got to ask yourself, did I actually follow my plan? If not, why? What could I do better next time? And hey, even if you did stick to it, was it a good plan? How could it be improved? This is how you create that feedback loop for constant improvement. Now, the absolute best tool for this is a trading journal. It gives you an objective record of your performance, totally free from all the biases that can cloud your judgment after a win or a loss. It's the ultimate tool for getting better. So I'll leave you with this one question. Is your trading built on a system, or is it built on hope? The answer to that question will probably determine your entire future as a trader. It's time to stop hoping and start planning.